Theme. We'll watch the mining sector, of course, because of the news around Rio Tinto going after Glencore. Will this actually get done? It's been 10 years that we've been talking about this, but we'll certainly focus in on that. Interesting dynamics around copper and Chinese demand to talk about as well. And Sainsbury's certainly in focus. After yesterday's disappointing numbers from that sector, today looks perhaps a little brighter. So we'll watch what happens to the Sainsbury's share price, Guy.
Okay, our markets, our asset classes, a coiled spring, waiting to bounce or maybe drop sharply. I don't know. We've been in ranges. It's going to be really interesting to see what the rate story looks like today. I don't think you're going to see much action in equities as we work our way towards the key risk events that are going to be there. London does have something to think about, though, which is what is happening in the mining space, what is happening with Rio and Glencore, I think is going to be interesting. So it's interesting that London is kind of drifting a little sideways today. Are we going to go positive and negative? It's going to be interesting. I think we're going to be in and out of positive, negative territory. I'm waiting to see what happens with Glencore. The CAC's up a little bit. The IBEX is up a little bit. I'm not sure there's much to see here at an index level. Tom, what do you got at the sector level?
Yeah, unsurprisingly, as you were hitting on, Guy, energy is higher. It's top of the list across the sectors so far with gains of 1.4%. Tech is also getting a lift. And again, to Anna's point, not unsurprising given the numbers that came through from TSMC and the read across, then tech up 0.6%. On the downside, healthcare softer by 0.3%. It's a bit of a mixed picture across these sectors, Anna.
Yes, it is, and we haven't got the full mining sector story yet, do we? So Rio Tinto is open, and it's down by 2.2%. That's less than it was down in the Australia session, so maybe they'll take that as a win. And interesting that the market sees it that way, because I was reading some comments from analysts that weren't saying it was about the deal, because we frankly don't know enough about the details of any deal, and there is no deal yet. But it's more about what happens to other bits of the business and a lack of clarity around coal assets, for example. So a bit of nervousness there, so the stock goes lower, but only by 2%. On the other hand, Glencore's not yet open, and so we'll see what kind of upside we get, and that could really shift things around from a sector perspective, of course. Basic resources, not one of the best performing sectors right now, but we'll see what the opening of the Glencore share price will do to that.
What is interesting is Antofagasta's higher. So there is kind of, you are seeing some churn as a result of this story. So the copper story does go a little bit higher. So we'll wait and see what happens on that front. I am struggling to discern a clear kind of narrative that comes out of this morning. A little bit of volatility around some of the energy names. They're moving back higher a little bit, BP, Shell.
Because as you pointed out earlier on, over the week, oil prices are higher.
Yes.
So we had a drop actually on Monday on the Venezuelan news, anticipation of more supply perhaps into the US markets. But actually on the week, oil prices are higher, and it's, yes, Venezuela, very confusing, trying to get a handle on that. But there's also Iran, there's activity around Russia and Ukraine, and the market watching those developments very closely.
Well, let's bring in Max Kettner right now then, Chief Multi-Asset Strategist at HSBC. Happy Friday, Max. How are you feeling? What is drawing your attention? What's going to move these markets today in terms of non-farm payrolls or Supreme Court? What are you focused on?
No, I just heard about clear narratives and I thought, what am I doing here? But there we go.
Give us one.
Give us one. No, but look, I guess, what's the clear narrative? I think one of the clear narratives is still that actually earnings, near-term earnings expectations and near-term growth expectations, I think, continue to be a little too low, right? And that's particularly for the US. When you look at the US, for example, I mean, consensus saying 1% for Q4 and then barely a rebound in Q1. So even if you did say, hey, because of the shutdown, there will be some temporary setback in growth in Q4, but then the logical reaction should be, okay, Q1, therefore, will be the rebound. That's barely in the numbers. So I do think really for the next
earnings expectations get revised.
That's both for earnings and for GDP, right? For both, actually.
And then valuations look less concerning.
Yeah, and I do, and it's not just a tech story because when you look outside of tech, actually, you look at the S&P. 8 of the 11 sectors now for the reporting season that's about to start, 8 of the 11 S&P sectors are expected to be down quarter over quarter. And I'm sort of thinking, sure, fine, there's been a government shutdown, but let's be honest, if you're one of the 500 largest companies in the US, do you care? Even if you're a consumer, let's be honest, if you were there in October and you said, oh, I'm going to buy a car, did you really a month later say, oh my goodness, the government is shut down, I'm not going to buy a car now? Really? Like, why would you? And we see that in the hard data, no? We see that in credit card data. We see that in the Chicago Fed cards data. We see that in a lot of high-frequency hard consumption data, that there wasn't, particularly on the cyclical stuff, right, the cyclical big-ticket items, that there wasn't really much of an impact.
So the US economy doing pretty well then, by your analysis, Max, and the market not necessarily reflecting all of that. So what does that mean for payrolls today when we get that? Does that mean that the market should be looking for a stronger number and for an unemployment rate that does tick down?
Yeah, I think it could be ticking slightly down, no? Because I think some of the high frequency and some of the proxies, right, from the Chicago Fed also point to a slight, slightly going down. The bigger picture, I think, here is that the level of rates or the level of rate expectations where it starts hitting risk assets has clearly moved down over the last 12, 15 months. No? So to me, the worry that I have is we don't need 3-4 months of more hawkish CPI, more hawkish payrolls. I think one or maximum 2 months is enough. Because obviously, if you look at long end, the long end and then very sort of big ultimate terminal rate expectations, which we always look at sort of the 3-year, 1 month, so short end expectations in 3 years' time, that's already at 340. And effective Fed funds is at 365. So effectively, right, you need one rate move priced out, one rate cut priced out, and you're starting to price in a tail risk of a hike. That is not great for anything, for spreads, for equities, for FX, nothing.
So do you think the Fed is done then? And how will, but we have a very busy White House right now, and the president's not afraid to interfere in markets, and we know he wants lower mortgage rates, and we know he wants a cheaper cost of borrowing, and we know he wants lower interest rates. What does that set us up for in 2026?
I think that story is a bit overplayed, to be honest. It's great to talk about, but then at the end of the day, I remember 2.5 months ago, there was lots and lots of concern about, but Fed decisions have always been unanimous, and what if it's not unanimous? Isn't that going to introduce all this volatility? And then we had 9-3 in December. I mean, we're all still, it's not like any of you just,
the Fed can withstand rebellion.
So what? Is that rebellion? I mean, would we call the Bank of England being like, oh, no, they had a split vote? If the Bank of England is 9-0, none of you sit here on the table it's like, oh, my God, that was contentious. No, fine, then it's 7-2 or 6-3 or 5-4. It's the same thing with the Fed. Fine, then it's an 8-4 or a 9-3. Who cares?
Okay. Front end of the bond market, is it mispriced?
Yeah.
In the US?
Yeah.
By how much?
I think up to 50 bips, to be honest. Okay. You look at the front end in the US, let's say December 2026, we're at almost 3%, 305.
So selling twos, yeah?
Yeah.
Okay.
I think
selling tens?
Yeah. That's by extension, right? 30s is probably a different case because of because of supply and other kinds of things. The issue, I guess, with the very long end is that the Fed is already buying paper again. They're telling us, we're not doing QE, we just happen to buy 55 billion of paper a month. But it's not QE, which is, which makes it really tough. And I get it, because I feel very much in the space of every month when we write our allocation updates. Gosh, is this like another Control-C, Control-V update where I'm just like, I'm saying the same thing as in the last few months. Yeah, don't say that, I repeat it. Too late. No, no, but it's the issue then, of course, is if I want to say, but rates could be picking up, or what if payrolls are a bit high? Okay. Sure, maybe on the day there's a negative reaction, but if the Fed buys so much, you can't
reprice the front end by 50 basis points.
Then we're...
Okay, what do equities do?
Then we're talking. No, if we really
you just told me that they're mispriced by 50 basis points.
Sure, but it depends on the path.
Okay.
No, it's not about where we end up in 12 months. In 12 months' time, or over the next 6-9 months,
Yep.
is the front end mispriced by 50 bips? Yeah, potentially.
Okay.
Is that really going to be something that's going to be repriced by 50 bips in 2 months? No, because that's the other good thing. We've got this K-shaped economy, so there isn't this clear picture where you can say, okay, payrolls today might be surprising.
But rates are going higher.
Yeah.
You started this conversation with Anna telling us that equity markets are going to do well because actually earnings estimates are too low. Which is more important, higher rates or earnings estimates for the equity path this year?
I think for this year, it's a bit like 2018. I think it's actually the rate side of things.
Okay.
Right? Because...
That sounds negative equities to me.
Yeah, of course. But it's is it one where you say, okay, we are definitely going to price in hikes at some point? No. I think it's probably much more sort of a ping-pong game where you say, oh, God, there could be a tail risk of hike priced in because we have 1 or 2 months of stronger payrolls or 1 or 2 months of higher CPI, and then the month after you realize, oh, actually, no, there are still these cracks. Let's price it out again. So it's sort of this ping-pong.
Choppy.
Right?
Yeah,
It's
choppy.
choppy.
Max, because earnings will come through stronger, is your expectation, but rates will come up higher.
Yeah.
Okay. So
Which means valuation probably going overall a bit down, right? But that's not going to be the earnings side of things. It's going to be the driver now at the beginning because the earnings expectations are so low. But overall for this year, the other thing which I think is completely missed, which I don't understand in the 2026 outlook. So one of the things I really struggle with the 26 outlooks is people saying, oh yeah, AI is going to broaden and the Fed's going to cut rates once or twice more. So basically, wherever you invest, you're going to make money, whether it's rates, whether it's EM, whether it's carry, whether it's cyclical currencies, whether it's equities, whether it's tech or non-tech, doesn't matter. Just buy something, right? It's basically the outlooks. The worry I have is, let's be honest, the big beautiful bill, right? The next 3-4 months, really positive. Because we get the tax rebates, right, in February and April. We get the consumption effect probably, so it's really good for consumption.
Yeah.
The CapEx incentives, really good for AI. The issue I see is, when we think from 26 to 27, we're forward-looking, right? We can't just always look at, the 6th of or 8th of January, sorry. 9th of January.
Yes, I know, it's moving
See,
fast.
and I live in the past.
Yeah.
But, you look at the 9th of January, it's like, this is what I care about. No, I think there is going to be a time around the summer where we think, hold on, isn't there a potential that actually monetary is done? We won't see any more rate cuts coming in 2027. There might be a risk of a rate hike. So we're moving from monetary tailwind to headwind in 27. Fiscal, the same. We get a negative fiscal impulse and a negative capex impulse. That's the worry I have around really from an earnings perspective, also in the summer.
Okay, and that ties in a little bit to the energy space and what we expect to see there, and there's been plenty of news flow around that, drifting higher oil prices. You've told us that you're underweight energy oil. Is that a conviction around, the surplus story just continues to play out and that's all that matters?
Yeah. Pretty much. It's very little to do with politics, to be honest, because the problem is on the political side, or let's say Venezuela and all I don't have any insight in that. And like you said, let's say if on Monday or on Sunday we would have known what had happened, would we have been short oil this week? Yeah. And we would have lost money.
Right.
No? So the political side is very hard to gauge. I think the surplus and the fundamental story on oil is probably much easier to gauge. So can we, go maybe tactically a little bit below 60 on Brent? Yeah. Okay. Is that the space where I would close it out? Yes, absolutely. I think we almost have no oil in our allocation. We're almost completely out, and we've been like that for almost 12 months. But I think once you get to the sort of 55 levels, it's tough to get even lower because, of course, shale doesn't make money at these levels.
I think we're done. That was quite a tour de force. Max Kettner, thank you very much indeed. Max Kettner, Chief Multi-Asset Strategist, joining us from HSBC. Let's take a look at what is happening with European equities. There's a few interesting moves out there this morning. Certainly the mining space is fascinating. There's a few big moves in the banking space as well, which are worth watching out for. But broadly across the board, we are bid, as you can see. Tech is actually leading us. ASML is up by over 2%, well over 2%. Schneider's rallying a little bit as well. But yeah, it's a good day, pretty much for everything by the looks of things. Let's try and figure out whether that is really across these markets a good thing. Let's find out with Chloe Melly.
Good morning, Guy. We are seeing for the mining sector shares go into two different directions for Rio Tinto and Glencore after the two announced plans, talks to create the world's largest mining company. And we are seeing Glencore shares reacting really positively to that, with shares up almost 8%. But then Rio Tinto is a little bit weaker this morning. This deal is all about gaining more access to copper, which is a metal that's been hitting new record highs and is really important for both the energy transition and also the AI boom. And it seems that Glencore Glencore investors are quite keen on this. Rio Tinto investors maybe a little bit less so. We'll be keeping an eye on that going forward. Moving on, but staying in the mining sector, and Antofagasta was raised at Goldman, and then also it is benefiting from the fact that the Trump administration is planning to overturn a mining ban in Minnesota, and so that would benefit one of the big projects that that company has in that state, and therefore we are seeing those shares move a bit higher this morning, up about 2% for Antofagasta. We're also seeing some positive movements for the chip sector. This is due to the positive read across from TSMC, with the numbers coming in ahead of estimates, which reassured investors about AI spending, given all those fears around this AI bubble. And therefore, we are seeing ASML in particular, which is a key supplier to TSMC, move higher almost 3% this morning. Moving on to L'Oreal, we also have a green there as well. It was upgraded to a buy by UBS analysts, and therefore we are up 3.6%. And finally, the only stock that we're talking about today that is in the red is Sainsbury's, because it reported weaker than expected sales. This is following these similar numbers that we had from Tesco yesterday, and shows that maybe shoppers in the UK wanted to get cheaper groceries for their Christmas shopping and went to Aldi and Lidl a little bit more than they went to Sainsbury's and Tesco, and therefore we are seeing some weak Christmas trading for those companies, for those supermarkets, and we are down 4.3% for Sainsbury's this morning.
Okay, Chloe Mully on some of the stocks on the move today. Chloe, thank you. Coming up, and Chloe, we're talking about the mining stocks, of course, Glencore soaring and Rio slipping, as the two are in talks to form the world's biggest miner. Those conversations are back. We're going to take a look at the likelihood of a deal and what it all means for the broader industry. That's next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
17 minutes past the hour, 18 minutes past the hour. This is what equity markets look like. A little positive. Could be worse. There you go. Up again. There's some interesting stories, obviously, in London today. There's actually some interesting upgrade stories which are affecting the market as well. Look at what is happening. Some of the French banks definitely on the move. As a result, some upgrades, downgrades. So just keep an eye on kind of what broker notes are doing as well to the market this morning. But the really interesting corporate story this morning is what is happening in the mining space. And London-listed shares firmly in focus. Reports that Rio is once again in talks to buy Glencore, create the world's biggest mining company. The new entity would have a combined market value of over $200 billion. The news, of course, today comes a little over after a year after the last set of talks collapsed. So are these ones going to be any more successful? Is there anything changed here, significantly changed here? Is it going to be harder, maybe, to get a deal done? Bloomberg's Mark Burton, who leads our EMEA mining and metals coverage, joins us around the table. We've been here before. Why is this time different? Could it be different? Are the challenges greater or less?
We have been here before. We've been here twice. 2014, there was a move by Glencore to put itself in play, discuss that deal. That ended quickly and acrimoniously with both of the companies kind of engaging in a bit of a shouting match. That underscored the gulf between the two cultures of the company. 2024, they I think had more kind of robust and comprehensive discussions about how a deal might get done. And I think the stumbling block there, among other things, was principally around valuations. Copper deals are a great thing to do, but they're also incredibly difficult to get done because the industry is universally bullish on copper, and it means that whenever these two kind of companies come together, the bidder doesn't want to overpay, and the target doesn't want to be accused of leaving money on the table in an environment where everyone is kind of picking their targets for where copper prices might go.
Absolutely. And that's very much a talking point at the moment, isn't it? More on that perhaps in a moment. What about the fact that we've got a new CEO at Rio Tinto? What does this tell us?
So I think, they both had investor days in December. Glencore was setting out its stall as a copper company, has a huge amount of growth after periods of kind of slumping output in its copper business. It was basically saying, look, this is our focus. This is what we offer you. People have kind of interpreted that as a process of it opening itself up for a company like Rio to come and take over. Rio, meanwhile, under its new CEO, presented a much more kind of internally focused proposition where it was going to be developing its own assets. It's just brought this massive new iron ore mine into production. It was a much more kind of conservative pitch to investors. Now we have a different proposition, potentially creating. Yes, exactly. So, but then behind the scenes there were, I think there's an effort to simplify the business in a similar way to focus on copper, and I think there's for both kind of Rio and its rival BHP, there's a kind of period of softer growth in copper ahead, and I think among their investors there's perhaps a greater mandate to go out and do these types of deals to quickly bring on copper at a time when prices are roofing it.
Okay, thanks very much, Mark. Plenty to talk about this morning. Mark Burton from Bloomberg with the latest on M&A in the mining sector. Plenty of risk events on the agenda for today as traders look ahead to US payrolls, the US Supreme Court opinion day, possibly, on tariffs. Let's bring in Bloomberg's Valerie Teitel to set us up for all of that. You were more excited earlier on about the Supreme Court. A couple of guests who
put
very
focus. Controversial.
Oh, is it? We have a couple of guests who put focused on non-farm payrolls. You think the drama in the Supreme Court then, Valerie?
Well, I think... okay, there we go. There we go. I've got someone on my side. But no, I think that there is going to be lasting, historical ramifications from this decision today in terms of the limits of presidential power. And I tie that into the news of the day that Trump obviously cares about the mortgage market. He wants to buy these mortgage bonds. He's talked about declaring the housing market an emergency. He would do that by using IEPA. And IEPA is what is on the bench for this Supreme Court decision today. Has Trump overstepped his use of this Emergency Powers Act in order to enact these tariffs? So I'm interested in it from that big point of view. I'm also interested in it because, if these tariffs are smacked down, what does all these other countries do who have signed these trade deal commitments with the U.S.? If Trump does enact Section 122, which is essentially another placeholder that he can enact if these IEEPA tariffs are struck down, that is a blanket 15% tariffs on everybody. So those who are maybe negotiated a lower one, what do they do? Those who negotiated, and this is maybe a deal for them, how do they react? So I think it does start to pose some bigger questions on more volatility, at least when it comes to the tariff situation, the trade deal situation with the Trump administration.
When it comes to jobs, and I know that's less of a focus for you than the tariff story, but in jobs, is it the headline number, is it wages, or is it the unemployment number?
Look, I'm looking at the unemployment rate, and I say that for a few reasons. The headline number has been very volatile of late, has had a lot of revisions. I know we've all talked about the lack of quality in the data. So look at the household survey when it comes to the unemployment rate, because I think that what the market is vulnerable to is a massive narrative shift. If the narrative all of a sudden shifts to the fact that maybe the labor market isn't weakening, maybe it's healed from the weakening track it was on last year, perhaps it's starting to tighten again amidst all of this economic positivity, the AI trade maybe becoming more of a positive for the labor market, that could cause some big changes to how we're viewing the Fed this year. I mean, that could really put hikes on the table for the Fed, and I think that's what the market is vulnerable for. If we see the labor market healing, the unemployment rate drop down to the 4.3 kind of territory, I mean, there would be an argument to be looking at hikes.
Max Kepler thinks 50 basis points mispriced at the front end.
In which direction?
Up.
Up, yeah.
Does he think, how much of a cold spring is the market? You get out of the recent ranges, how quickly is this all...
The data on the labor market has been very cloudy of late. It's been very hard to tell whether we're still weakening or not. And once we get that kind of clarity, if it's in the direction of the labor market strengthening, you have, these bullish GDP figures already from the Fed for this year. Add into that what the Trump administration is planning on spending, this fiscal boost, there could be real arguments that the U.S. economy is about to take off.
Valerie, stay with us. What are you up to for the weekend? We have time to talk about...
We don't ask Valerie that question.
Our weekend. We have time to talk about our weekend, which for some people will feature skiing and plenty of sport. Probably not for Valerie. I would advise against. But watching the Golden Globes, that seems like a safe activity.
Yeah.
You'd have to stay up late for that, don't you?
You do. That's on a Sunday, actually. Yeah, so I won't overcommit to watching the Golden Globes.
Monday morning, that's what we're going to be talking about.
Yeah. I see Guy as an alpine skier. Salopets?
Yeah, just
very much
just come back. Where are we this weekend? I can't remember where we are this weekend. Anyway, yeah, the downhill's going to be on. That's
you
going to be
didn't break anything skiing,
I nearly
the
did,
headline.
but anyway, that was kind of neither here nor there. But yeah, loads of sport this weekend. Fantastic sport this weekend.
It's the quarterfinals of the Africa Cup of Nations. So Mali, Senegal today. Cameroon and Morocco today as well, 4 p.m. and then 7 p.m.
He's been doing research.
Quarterfinals.
My research is just focused entirely on the Golden Globes, so I have nothing to add on that front.
So you're going to be the fashion correspondent on Monday morning.
Absolutely. I know, I'm all about the front runners for the Oscars. It's very competitive this year. Tom's been watching the tech story, though, as ever.
Talking of entertainment.
So we're done. So our weekend starts now.
Say goodbye
our weekend starts now. This is fantastic.
You can go off and enjoy your weekends. That's it for the opening.
Val's away for a few months. In fact, she's got somewhere to go.
Yes, maybe the hospital, but only for good reasons.
Yeah, absolutely.
Congratulations.
The tech show is next.
The tech show is next. Entertainment, music, AI, will.i.am, exclusive interview. That's coming up. Bloomberg Tech Europe takes a deep dive into how AI is shaping the music industry, what it promises, some of the consequences for the makers of music, of course. That's all coming up. Exclusive conversations. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. And Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
You are watching Bloomberg Tech Europe. Coming up, the future of music is here, and AI is at the center of it. Whether it's artificial artists or remix records, AI is expected to have pretty far-reaching effects on music making. But is AI a threat to the established music model, or should it be seen simply as another tool for creatives? Grammy winner will.i.am reveals how he sees artificial intelligence reshaping the industry.
It's not doom and gloom for the music industry. I'm more worried about my accountant than I am my drummer. I'm more worried about my lawyer than I am the singers that sing with us.
So we will be joined by music heavyweights as we zero in on the challenges, the opportunities as well lying ahead for an industry facing arguably its biggest test since the onset of streaming. Welcome to Bloomberg Tech Europe. From streaming apps then to recording studios, artificial intelligence. It's not just remixing the music industry, it is rewriting the entire score.
How was I supposed to know what love looked like when my first man left before I learned to fight?
Could you tell that wasn't created by a human? The track was generated by Zania Monet, an AI artist who made history as the first AI-generated musician to chart on the US Billboard rankings. If you couldn't tell, you're not alone. French music streaming service Deezer found that nearly all listeners cannot distinguish AI-generated songs from those made by humans. A new wave of AI music companies is leading the charge. Platforms like Suno, Udio, Loudly, and Musico let anyone create fully produced songs in minutes. No instruments, vocalists, or studio time required. The global market for AI-generated music is booming. Research firm Grand View predicts growth from $440 million in 2023 to nearly $2.8 billion by 2030. But not everyone is harmonizing with the trend. Artists warn that AI could flood platforms with synthetic songs, drown out human creators, and mimic famous voices without permission. That concern has fueled a growing campaign against AI music, including calls for clearer copyright laws and protections for artists' likeness and style. Still, the industry isn't just fighting, it's adapting. Major labels, including Warner Music Group, are partnering with AI companies like Suno to explore songwriting, production, and fan engagement tools. For now, AI music sits at the intersection of innovation and uncertainty. Whether it becomes a powerful collaborator or a disruptive rival, the industry is bracing for a future where humans and AI share the stage. So, AI is a divisive topic then for the creative industries. Some musicians seeing it as existential. But for will.i.am, artificial intelligence is an opportunity, not a threat. The Grammy-winning singer, songwriter and producer first found fame, of course, in chart-topping hip-hop group Black Eyed Peas. He is also the founder and CEO of FYI AI. It's an AI assistant specifically aimed at creatives.
Absolutely. You're being interviewed by Tom McKenzie from Bloomberg, focusing on the dynamic intersection of AI and creativity. It's a deep dive into how innovative AI solutions can coexist with and enhance artistic expression, while also addressing broader industry implications like job displacement and data practices. You've been sharing insights about FYI's approach to harmoniously integrate AI with human creativity and discuss the pioneering work with ASU involving the Agentic Self course.
I spoke to will.i.am then about how he sees AI shaping the future of music.
It's a renaissance. The same way the Renaissance, catapulted, dimensionalized the creative industry in the past. The Renaissance, this new Renaissance, will do it for this era that we're in. So it's the age of the hyper creative.
So there's a copyright law change that the UK government is thinking about making to ensure that the models and the AI companies here can innovate quickly and use copyrighted data more freely with less risk of legal response to that. And so the artists, including Damon Albarn and Annie Lennox, put out this silent album in February as a protest to say this is gonna be a problem.
Yeah, so the artists that are protesting have every right to, right? Because say, for example, Coca-Cola wants to license your music, or McDonald's, or Starbucks, or, some politician running for office. They want to use your music for their campaign. You have to license that, and the artist has to sign off on that. So if artist music are in some overall catalog, and the artist didn't say, yes, you could use it for however you need to use it, whether it's to play it, associate it, or train on it. The artist should do that. The thing the artist also has to know is we're at a point where they don't have to train on our music. Theory is theory. And the model's going to get so sophisticated that it's just going to train on theory. And because it can predict.
Yeah.
And songs can be broken down into predictions based on theory.
But licensing of copyrighted music is possibly a solution for these AI models that are training. And so far, a number of them are trained, the allegation is, a number of them are trained on copyrighted music without compensating those artists. And licensing could be the solution.
Licensing is a solution. But what is the value of those recordings and those copyrights? And so that's the heavy one. We licensed our music to Spotify. They don't value it the way that it should. Then that brings upon another conundrum. A song is worth how much? A stream. So you could license it, but let's hope that the folks that are, divvying up its value and its worth love it and appreciate it and price it for what it actually costs, as far as time. But the model is It's getting better and better and better. It doesn't have to learn from the past to create.
Are there specific guardrails that you think about that should be implemented when it comes to protecting creatives in this time of momentous change as a result of AI?
Yeah. First off, the reason why we're having this situation and the conundrum that we're in is because the data practice overall. The data practice, not just for music, everything needs to be thought, and humans need to be protected. You came at it from like, hey, what about music? What about your job? How you interview. Bloomberg says, you know, we really like how you do that. We want an avatar agent to do do you own how you ask questions? So right now, the easy way to look at it is like you musicians and your songs. Like, yes, everybody. Everyone needs to be protected. The sellers, the storytellers, the lawyers, the finance people, human resources at the company, everyone. It's a human, like, urgent matter to where we need governance and regulations ASAP, not to stifle creativity, but just to make sure the business model, it's the business model that's the issue, not the tech, bro.
In 10 years' time, are we listening to more AI-created music than human-created music? How do you think about that?
You like fruit?
Yeah.
You go to the supermarket, do you say, hey, where's the organic oranges?
Sometimes.
But then you just buy oranges.
Yeah.
So if you're not buying organic oranges, then what the were those oranges that aren't organic?
Yeah.
And why would you have to call these organic and those just oranges?
Yeah.
If these are organic and that, what are those? Only reason I'm saying that is just processed to the point where you need to identify organic from non. The same will be for music. The same will be for everything.
It'll be on us, the consumer, to identify what is synthetic, what is AI-made music, and what is human-made. Or does it need to be labeled?
I'm trying to elevate this conversation to everything. I'm starting with oranges to organic oranges, to music to organic music, to interviews to organic interviews.
There's going to be a premium in terms of the human experience in this new AI world. Things like live experiences, live concerts, live sport. Is there going to be a premium for that kind of entertainment?
It's called lived experience. The AI is not living. So when you go see yes, there's going to be lots of music. There's going to be AI bands. That's true. It's going to be like an AI freaking Bruce Springsteen. There'll be an AI Lana Del Rey. There'll be an AI freaking Adele. Yeah, and it's going to sound great. People like it. And you're going to go see it perform live. And the team that makes the live performance is going to be freaking, it's going to be dope. And then there's going to be human lived experience that you're still going to love. It's not doom and gloom for the music industry. I'm more worried about my accountant than I am my drummer. I'm more worried about my lawyer than I am the singers that sing with us. Because that's law, memory, and numbers. There's a $100 billion industry, if not more, launching freaking agents and co-pilots. Then there are the record industry launching AI artists. Get out of here, bro. Let's break it down to the real what's going on. So I'm more concerned about my assistant than my guitarist.
And you've worked clearly, you work in philanthropy, in music, in design, across all of those different sectors, as well as tech, of course. Of course, all those different sectors. Where do you expect to see the most disruption as a result of AI? Or is it across the board the same?
The creatives are going to be all right. Hey, we're going to be cool. They like this, they like this. They want the heart. And stop chasing the algorithm on TikTok. Like, rinse your soul out. But people want that. We're going to be cool. But as cool as we are, we're going to be writing songs called Where Did the Humans Go? And then they're going to come to our concerts to hear that.
The one and only Will.i.am, the founder and CEO of FYI AI. Coming up, Streaming then, currently the dominant model for the music industry, but will that last in the AI era? I'm going to discuss with Jessica Powell, co-founder and CEO of AudioShake, a firm whose AI software can separate and then reimagine existing audio recordings.
Again, I think one of the big challenges is how are 100% AI-generated tracks treated on the streaming platform? That, I think, is the biggest challenge and something that really does pose a potential threat to artists.
Plus, we will be joined by Helene Lindvall, songwriter and president of the European Composer and Songwriter Alliance. Can the industry survive and thrive as AI takes hold? That is next. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to Bloomberg Tech Europe. So, artificial intelligence is being used across the music industry. We've established that. One company that is thriving is AudioShake. Its platforms use AI to split audio recordings into individual parts, separating music, voices, and effects. Its customers then can take those recordings that were once locked in their final form and reimagine, remix, and repurpose them. Jessica Powell, AudioShake's co-founder and CEO, says the threat is not from AI tools, but the mass rollout of music made solely by artificial intelligence.
The real controversy tends to be with generative AI, both in terms of how that music was trained, which tends to be it was scraped from the internet, but how it was trained, and then the fact that the outputs could potentially be regurgitating original lyrics or compositions, and two, are those tracks, those outputs, competing with the people who created the inputs, the human artists? So that's where it's a sort of different debate from what happens with a lot of the more day-to-day AI tools that are being used by the industry.
Are you comfortable with those AI music models, those generative AI models training on copyrighted material?
The part that I think is really interesting, and I think we're going to have to see how it plays out, is how AI-generated tracks exist in a marketplace, meaning streaming platforms, alongside human-created works. And when I say human-created works, that can also mean works that humans created with the assistance of AI, but where, let's say, humans are driving the majority of that track. I think the real threat around generative AI is not a producer who uses a generative music system and, generates a vocal when they've built this amazing track, or adds this element, asks a generative music system, find me a beat, create a beat for me that does X or Y, right? And then they're building and adding all this human creativity on top of it. I mean, that is the history of music technology, right? The people interact with tech, they build new and crazy things. I think all that is going to be fine. But again, what happens when you are able to use technology to generate music at scale and hit streaming platforms with a tremendous amount of music, and that music is competing for listeners? There's already a problem in the music industry today around streaming fraud. That was already a problem. It preceded generative AI, again, also enabled by technology. It's essentially fraudulent tracks that are just there so that bots can click on them and then collect revenue. So that, to me, is the most interesting question, which is, how do you take existing music industry problems, right, like streaming fraud, and the inability to always be able to detect remixes? All of those kinds of problems are all just amplified by the existence of generative AI. And so I think that's the really big challenge here.
So how, in the here and now and then into the future, Jessica, do you see these kind of tools, these kind of changes, these kind of innovations changing the music industry, the economics of the music industry, not just for artists, but also for the labels?
Again, I think one of the big challenges is how are 100% AI-generated tracks treated on the streaming platform? That, I think, is the biggest challenge, and something that really does pose a potential threat to artists. Already did, but now is amplified through technology, which in this case is generative AI. And so if you look at Taylor Swift, I think it's very hard to automate Taylor Swift, right? Because it's not just the music, it's also everything else she does and her interaction with fans and her tours and so forth. And so there will be AI artists, definitely, but I don't think human artists are going to completely disappear.
That was Jessica Bao, the CEO and co-founder of AudioShake. So the record industry is, of course, as we've been discussing, in the midst of a deal-making spree as well when it comes to AI. Major labels, including Universal, Warner and Sony, have either struck deals or settled with AI music companies in recent months. Many of these agreements will allow users to remake popular songs using artificial intelligence tools. That has drawn the attention of the European Composer and Songwriter Alliance. It says licensing is a good first step, but has called for greater transparency over the deals. I'm joined now by the group's president, Helene Lindvall, an award-winning professional songwriter, musician, and columnist. Helene, thank you for taking the time to come in, and your role, of course, on that front, and the lobbying role that you're taking. What do you make of these deals, then? Is this not important in terms of trying to address some of the concerns of songwriters that the labels and some of these model and AI companies are now partnering?
Absolutely. I mean, licensing is the first step. Without licensing, there is no money flowing back to music creators. But transparency is so important, both on the AI company side, so we know what is being scraped and what is being used, but also when it comes to the labels, how are these deals, how's the money that is flowing in going to be distributed? Is it going to be distributed to composers and songwriters? Where's the transparency here in what is being used? Because in the end, it is about supporting the roots of the industry, which is the composer and songwriter.
Yeah, and we saw evidence recently of just how far this technology is evolving in terms of its partnership and how it's working with music for the upside and the downside, and we can talk about that. Universal, for example, partnering with NVIDIA, and they're saying that this is about music discoverability. I mean, and NVIDIA, given its role in terms of AI chips, How important? What do you make of a deal like that? Is that a move in the right direction, or does that cause you concern?
To be honest, we have no idea really what the deal entails. There was a lot of things about creativity as well. And then obviously on the composer and songwriter side, we're looking at, well, if a music label owns the catalog, are they going to train on that catalog eventually themselves and push out those pesky music creators that come and complain about their money not flowing through?
What is the impact right now that you're seeing across the industry?
Well, there's a lot of fear, obviously. There's a lot of passion among songwriters and composers. We are seeing, obviously, on streaming services that there is a lot of AI. Deezer said last year that they have between 50 to 70,000 fully AI-generated tracks being uploaded every single day. Now,
are they being labeled? Do we know as consumers?
Not being labeled at all. Many times with Spotify, for example, I realize that I'm having fully AI-generated tracks recommended to me. And I only find out because maybe I look at the name and I'm like, oh, I haven't heard about this artist before. And I try to Google and I realize that actually it's not a real artist. And I think that's really, really important. As a music fan, as a consumer, as Will.i.am said earlier, you know, do you want to have organic food or do you want to have like processed food? But in a much more, like, do you want to have a human creator behind it? I think it makes a difference to a lot of music.
And one of the points from Will.i.am is this has to be targeted at the business model. The regulation has to be targeted and focused on the business model rather than stifling innovation. And his concern is clearly that innovation could be stifled. The EU AI Act, is that the right way? The tools there in Europe to protect songwriters?
Well, the AI Act in Europe is very toothless. It's very insufficient when it comes to copyright. They have the code of practice, for example, is voluntary. So you don't have to sign up to it. And even if you do sign up, it's a very weak copyright commitment with that. And the transparency in the AI Act is very high level, very general. So it's impossible for us to see if our works have been used or not. We are looking at it and saying, and a lot of EU member states are looking at the situation and say, well, let's face it, we can presume that copyrighted works have been used because there's been hundreds of millions of works that have been scraped across the internet.
There's been a lot of buying of music assets in recent years by private equity firms and companies like Hypnosis, buying the rights to names like Bob Dylan, for example, Neil Young, amongst others. Do those assets become more or less valuable?
Well, it depends, doesn't it? I think this is where they're in the same boat as us. They need to support copyright and support music creators, songwriters, and composers. I think a lot of the time, the songwriters and the composers get lost in this discussion because, oops, sorry.
That's okay.
Because we are invisible to a certain extent, and a lot of people think, oh well, a piece of music is created by one person, and there are people that are actually behind these songs.
Really important insights. Thank you very much indeed. Helen Lindvall, President of the European Composer and Songwriter Alliance. And on the next episode of Bloomberg Tech Europe, we're going to dive into the world of quantum computing. Can it supercharge the AI boom, or is it all bluster? We're going to speak to the company's leading efforts to master the cutting-edge technology. Catch that episode on February the 13th here on Bloomberg TV. That's it for Bloomberg Tech Europe. The Pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Beirut, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Glencore jumps after confirming that it's in talks to be taken over by Rio Tinto in a mega merger to create the world's biggest mining company. Now, the U.S. president says he plans to meet Venezuela's opposition leader as soon as next week, as the U.S. military prepares to hit drug cartels on land. Plus, TSMC, the go-to chip maker for NVIDIA, reports better than expected sales, reinforcing hopes that global AI spending can be sustained. Now, good morning, everyone. Happy Friday. It's been a very long week. I know many traders will probably need a second espresso this Friday morning. Look, a lot of traders are bracing for 2 back-to-back risk events today that may sway the mood of the market in the near term, marking one of the biggest tests possibly for global equities. One, it's the U.S. payrolls for December. Very important to give us clues. You can see S&P futures practically flat. The U.S. 10-year 4.1831. And then the other story, of course, is the Supreme Court could decide the fate of most of Trump's tariffs as soon as today, but that could also be delayed. Brent crude, we keep on staying on top of the geopolitics, 62.48. Let's also take a look at the European markets map. We're expecting, actually, the main bulk of the move to come from the U.S. because of the Fed, and that will probably filter through to European markets as well. We're seeing a bit of green, but they're really practically unchanged. Maybe the CAC and the FTSE here in the UK are doing a little bit better than the others. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, London-listed mining shares are on the move, with Rio Tinto falling, Glencore jumping, as the two discuss a tie-up to create the world's biggest miner. Now, the new entity would have a combined market value of more than $200 billion. The news today comes a little over a year after earlier talks collapsed. Well, joining us now for more on all of this is Mark Burton, who leads our EMEA mining and metals coverage. Mark, first of all, is it a done deal, or actually are there quite a lot of hurdles?
I think it's fair to say there are a lot of hurdles. Yeah, these are very preliminary talks. I think the reaction that you've seen, particularly in the Australian market, to the initial news with Rio shares falling reflects the fact that there's very little known at this point as to the precise terms of the deal. And I think that if and when we get a full offer, we'll be able to kind of gauge more clearly what the viability of this deal might be. On the face of it, there are a few kind of long-running obstacles that have kind of thwarted a deal like this in the past. In 2014, they briefly gave it a go. In 2024, they did so again. Then I think valuation was one of the key issues, and I think it will remain so this time around. The logic for combining the businesses is to
copper,
build...
I mean, Mark, this industry, right, your industry, it's never dull because they're kind of like in a M&A fever.
Yeah.
And that we've heard BHP was trying to buy Rio. That didn't happen. They went for it twice. Rio's looking at other stuff. I mean, it's all about copper. Everybody wants copper because we need more copper for the energy transition.
Yeah, absolutely. And the Anglo-Tech deal, I think, has kind of sharpened that focus on copper, and throughout the industry, there's kind of universal bullishness on the outlook, which is it underpins the logic for doing this kind of deal, but it also creates that potential valuation gap where everyone has very high expectations for the prize.
Right. And it also means that others could come in. I mean, could they?
Well, I mean, it's such a huge deal that to buy Glencore as is, enter a bidding war with Rio Tinto, the number of interlopers is probably fairly small, but BHP obviously is the current incumbent, the world's largest mining company. I think that's the one that everyone would look to. It similarly is very focused on copper, like Rio Tinto. I think its investors are more open to a big bang acquisition that would very immediately boost its copper production, even though BHP is huge in copper already today, and that is another aspect of it. A fresh angle is just the intense geopolitical focus on copper as a scarce and incredibly important industrial resource. So governments will be watching on.
Mark, thank you so much. Of course, we'll have plenty more from this huge potential deal with Mark Burton. Now, it could be an especially volatile day for the markets as we wait for a pivotal U.S. jobs report and potential Supreme Court ruling on President Trump's tariffs. The December non-farm payrolls data is being seen as the first reliable reading on the economy after weeks of data affected by the government shutdown. Well, the Fed Governor Stephen Miron told Bloomberg that his rate cut expectations for this year to boost the labor market.
I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation.
Well, let's bring in Ludovic Subran. He's Chief Investment Officer and Chief Economist at Allianz. Ludovic, first of all, Happy New Year. It feels like we've had like 3 months in the last week. So congratulations for making it to Friday. How big of a deal this is? I mean, this could, it could kind of change what equities do, given it's a big, important payroll number for the Fed to give us estimates of what they expect to do next.
Look, it will give us certainly a little bit more of information after what we call the fog of war when it comes to the data releases in the U.S. over the past few months, right, including on GDP, on jobs, on inflation. So I guess we expect the non-farm payroll to confirm that the job market is far from stellar, and that will certainly continue to groom a bit of the dissent on the Fed board that there needs to be more cuts, what markets have been expecting all along, right? So this whole idea that it could be an additional 50 basis points of cuts in 2026 compared to what was expected initially. We are still in the camp that the U.S. economy is still running hot, especially when you look at markets and when you look at growth. But again, those numbers are to be taken with a grain of salt. And it is very hard because remember, the Fed is all about data dependence. When the data is not dependable, you have a bit the situation now, which is going to be very politicized space. And you heard Steve Miron on his view, which is a very dovish Fed going forward, for sure.
You say the U.S. economy is increasingly running on 2 speeds. Does that accelerate and bifurcate even more?
Look, clearly the geopolitical situation, plus the AI transformation, plus the policy mix of the U.S. is exacerbating the K-shaped economy of the US. I mean, markets are really taking the lion's share of the growth created in the US right now, mostly because the expectations are in a sector that is a listed sector, and that is, you know, capital gains trumping wage gains going forward at a time where inflation is not under control in the US. So yes, I do believe that this dual speed economy will stay and will continue to be a major impediment to the good conduct of policy, fiscal and monetary going forward for the US, for sure.
Ludovic, I mean, when we see everything that's been happening over the last week, and actually executive orders, a lot of the things, you know, Venezuela taking a lot of chunk of time, not being priced into any real market, does it change your outlook economically in 7-8 months if these things accelerate, if we have more shocks, or is the world strong enough to deal with it?
Look, clearly, from an investment perspective, we have a risk of tilt that is clear, mostly because, you know, this K-shaped economy is not something that lasts often. So there is a risk of correction that is there. What would be the trigger and how would it be unfolding is very open. There is the talks of the AI bubble have been put to the back scene because now geoeconomics is back. But the question of hedging all of that is really, I think, what most investors should be worried about. I just give you one example. What's going to happen on the Fed and the May pivot of the Fed will be essential to understand anything from govies to credit to equity to the contagion that the US economy could have on the rest of the world, because the Fed is still the nexus of all the financial cycle, and the monetary and financial conditions have been behind a lot of the chutzpah on markets, right? So yes, it is something, you know, the next months are going to be critical, but I have the impression we've been saying that for now a year or year and a half. So it's something that still keeps us a bit of a breath, or at least on our toes, and this is also a good place to make money. So this is a bit the double-edged sword of the situation. You need to be very agile, but there are good opportunities, and there are also things that needs to be completely scrutinized, yeah, for sure.
Yeah, Ludovic, I mean, for me, the two big surprises of 2025, apart from the fact that a third one is that Italy's so bad at football, but, you know, the two ones is, first of all, when you look at tariffs and trade, actually the world moved on and it was fine. And when you look at, you know, maybe some of the surprises, they were much better than expected. And the second one is also that if you look overall at the global economy, I mean, it's much more resilient than we thought. Does this continue into 2026?
To answer your question, you need to understand the reasons behind. I think on trade, for example, I still do think that there is a second layer to the trade cake that is going to be very visible and very bitter in 2026, especially as middle-class Americans fight against inflation in an environment in which the Fed will maybe be more dovish just because of the cast on the FOMC. So I'm not sure that it's completely done, but the reason behind is because the trade at stake is less than 10% of global trade. So the reason behind the trade war not being the tariff is 12% effective rate, but the amount of goods at stake is much less because the rest of the world has been rewired, right? So will that continue? I think so, unless, you know, China really steps up the trade war, but they don't have an incentive to do so. On your other point, which is, you know, this resilience on the growth numbers, I think we can explain this with the AI boom. In the US, when you look at the non-AI economy, it's a flat line. And so this is also something that is there to stay. Will it continue with the same cadence? I'm not sure. And so that's something that will certainly be a bit the headwinds of 26, is that those drivers, the policy circumscription and the AI boom will not be as much there in 26. That's why there is more of a soft landing type of situation, right? In the prices, at least, yeah.
We've been focusing so much on productivity for AI. We're starting to hear at the margins companies saying, look, I'm going to hire less, and maybe that's because of AI, because they need less people, but also because we're just investing so much on some of these AI models. Does that come into play in the economy this year, or does it take longer to, you know, to look itself through?
Look, I think what is clear is that on the job market, for example, it's not AI which is in the driving seat. It's really more the need to continue to overperform market expectation when it comes to earnings. And so because there is a big need for CapEx for AI, it's eating everything on its way, right? Including the slack that you were able to keep on your balance sheet as you were a corporate that has been very cash rich for the past 5 years, let's put it this way. So I think that's a bit the indirect effect of AI. On the productivity itself, I think adoption of AI is strong, but it's not groundbreaking yet. And of course, because it's very new, and if you listen to people that are very expert on the topic, like Yann LeCun from Meta, he tells you LLM is only a very small part of what AI is going to bring. The non-language related change is yet to happen, and that would be much more grand in terms of productivity and displacement of jobs. This being said, there are sectors, especially in services, especially in clerk job, where I think you can feel already that for the junior hires, it's a dead end right now. So we're going to have a bit of this polarization embedded in the job market that is going to be very strong. But for the rest, I think the economy is mostly driven by where are the margins of corporates today, and they're still very strong, and they want to keep them strong. And so to defend the margin, they're ready to cut a bit on the cost. And so that's a bit what the job market is seeing. In Europe, same thing. Germany, unemployment rate up. It's mostly because of the industrial recession. So everywhere I don't see AI, I see more this soft landing phenomenon being behind the job market softness, including in the US, to be fair.
Ludovic, what's your take on China? We saw some numbers, CPI numbers, that were maybe a little bit better than expected, but are we going to still continue seeing deflation, which could be exported to the rest of the world?
Look, I think if it's not natural deflation, so driven by the confidence shock and therefore the real estate crisis and the fact that the real estate bubble pricked, and so it takes on average 8 years for a country to recover from that. And China is two-thirds of the way in, so there's still 2-3 years of strong deflation. But it's also organized deflation, and we see that on the trade dumping. I mean, at least in Europe, we're really on the receiving end of that, and you can really see that prices have been pushed down voluntarily on a series of sectors. That's the second China shock, and you can really see it, I think, in the transition goods. So I think China, to a certain extent, for the better, is continue to export deflation to the rest of the world. But there is an aftertaste, which is jobs at stake in Europe, for example. I think in the US it's less so, but I think in the retail sector in Europe, I mean, you see all the drama around Shein and so forth in Europe. This is a big issue. And so somehow people are happy because it's cooling down the inflation. I think energy prices are playing a much bigger role than China. But there is an aftertaste, which is this is continuing to displace a lot of manufacturing jobs. And clearly Europe is not yet at the level of industrial policy engineering that the US is when it comes to protecting their jobs. And this is something that is very political in the union right now. Yeah?
Ludovic, as always, thank you so much. Ludovic Subran, Chief Economist and Chief Investment Officer at Allianz. Now, coming up, we'll dive deep into the world of organized criminal groups and what the fall of Maduro's regime means for geopolitics in Venezuela. All of that and much more to come with our next guest. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, U.S. oil bosses have been summoned to Washington as they come under pressure to return to Venezuela. All but Chevron ended their activities in the country when the late Hugo Chavez seized their assets in 2007. Bloomberg Originals has been looking at what sort of advantage that might give Chevron. Here's a preview.
The United States has carried out a series of strikes against Venezuela, announcing the capture of Nicolas Maduro and his wife.
Nicolas Maduro stood in federal court and pleaded not guilty to narco-terrorism charges.
Donald Trump said his military buildup in the Caribbean and destruction of civilian boats there was about alleged drug trafficking. But following the U.S. attack on Venezuela, another reason has taken center stage.
The oil business in Venezuela has been a bust, a total bust, for a long period of time.
Everything that we've seen during his second administration has been consistent with his view that the U.S. energy dominance is key to his agenda.
We're going to have our very large United States oil companies go in, spend billions of dollars, fix the badly broken infrastructure, and start making money for the country.
But one U.S. oil company is already there and has been for decades.
Chevron produces about 25% of Venezuela's oil today, is the largest investor in the oil industry and in the country.
We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela.
This is a story about the extent to which a U.S. oil company is willing to go through the trials and tribulations of geopolitics in order to stay in a country that has the world's biggest oil reserves.
Chevron has virtually no competition. It has no oversight. And so it's really a very unique situation.
So how did Chevron manage to stay in Venezuela when everyone else left? And what role could it play in the country's future if Trump gets his way?
Well, subscribers can find out that question by watching the documentary on the terminal at Bloomberg.com and the Bloomberg Originals YouTube channel. Now, President Trump said he's planning to meet with Venezuelan opposition leader and Nobel Peace Prize recipient Maria Corina Machado as soon as next week. With us now, Irene Mia, Latin America Senior Fellow at the International Institute for Strategic Studies. Thank you for joining us so much, Irene. When you look at what happens next in Venezuela, a lot of the focus, of course, is on oil. How difficult is it to have some kind of peaceful transition where the U.S. gets what it wants, but it's a good deal for the people of Venezuela, too?
Good morning, Francine. Well, the short answer would be extremely difficult, right? There are so many uncertainties, so many pieces which need to come together. So on the domestic side, let's say that clearly we haven't seen regime change. We have seen, if anything, regime configuration. So basically, it's really the same people in charge, with the difference that it's a very unstable, I would say, coalition of the three main power broker, namely the now interim president, Delcy Rodriguez, Cabello, who controls the Interior Ministry, and the Defense Minister, Padrino Lopez. That's complicated internally, I think, because the president is actually not controlling the military. So she will need the help of both Cabello or, at the very least, Padrino Lopez, who is now the defense minister. And clearly the dynamics, even in the past, among the three characters were already quite, in some cases, quite difficult. So that's one. Second one is that clearly you have a very fragile security situation in the country. As we know, Venezuela has been for many years a hub of transnational crime and not just also geopolitical transnational crime, I would say, including its involvement in the Shah. Yes.
Yeah, we're also getting, so President Trump is writing on Truth Social, so it usually is around this time. He has said two things so far, saying that they canceled the second wave of attacks on Venezuela, and he's also saying that the U.S. and Venezuela are working well together. Again, what would be the best transition in a very difficult situation? So who do you see in charge over the next 4 to 5 months, and what does happen to that oil?
So I think from what we see, the current Chavista government remain in charge. I think it has to stay within very clear parameters set by the U.S., which have to do with, obviously opening the oil sector to mostly to the U.S. corporates, but also migration. I think is an important one. Probably will be repatriating more Venezuelan. You have the narco trafficking, which is obviously an issue, even if Venezuela is not central for narco trafficking dynamics towards the US, but more in general, it is important. And I think as long as really the government stay within those parameters, the US government will work with it. But as I said, there are a lot of spoilers, internal spoilers, and also more general organized crime spoilers.
I mean, if you're a Latin American partner right now of the U.S., what would you be thinking? Does the region become much more unstable given the Don Roe doctrine? What happens next? Do you think, Irene, that the president actually wants not more influence, wants the rest of South America?
Well, I think it's very clear that, in his kind of zone of influences, foreign policy, the Western Hemisphere is basically U.S., right? It's part of the America First. So I think that's something that has been made abundantly clear. The problem, I think, for Latin American partners and in general for the region is how to react to that. I mean, at the moment, we have seen not much reaction apart from, kind of declaration. But then again, there has been different level of success. If you look at the case of Brazil, for instance, Lula has not actually bowed down to Trump, and still, tariffs have been removed. I think it will depend really how close the country is to the U.S. in terms of economic and political and geopolitical position.
What happens next for the war on drugs? I mean, is there any doubt in your mind, Irene, that this is about oil?
Well, no, it's my mind has always been this is about oil, right? For Venezuela, definitely it's about oil because basically, as I mentioned, Venezuela is not important for the U.S. in terms of war on drugs, right? Fentanyl doesn't come from Venezuela; it comes from Mexico. Cocaine also doesn't come necessarily through Venezuela to the U.S. I think 8% only is coming through the Venezuela route to the U.S. So clearly, for Venezuela, it was about energy security.
President Trump is still going on, or still writing actually on Truth Social, saying Venezuela prisoner release is an important gesture. How do you see? How critical do you think that this is for policy?
Well, I think it is probably something that needs to be seen within the transition, which, to be honest, at the moment, I don't think, especially for Trump, transition to a democratic elected government is a priority, right? So I think it's probably more of a rhetorical kind of declaration, and it maybe comes more from Marcos Rubio.
When you look at, of course, Irene, a lot of the things that a lot of the oil majors, I imagine, in the U.S. would want is, again, political stability. Do you have any insight on what kind of deals or terms they could get, or is it still just up in the air because the situation is very fluid and there's just also very rudimentary infrastructure to get the oil out to other countries?
Yeah, I mean, I think all those factors are important, but also I think what is if I were a corporate, what I would look at is also the state of the legal certainty, right? Because at the moment you have lots of investment from China and from Russia. There are contracts there for oil and also for natural gas and other resources. So what happens to this contract? And more in general, what happens to the contract which are now, say, established with new corporates, right? Are they going to be valid once there is a new government? What is the status? I think it's a big uncertainty for a corporate, I would say.
Yeah. Irene, thank you so much for joining us. Irene Miale, our Senior Fellow at the International Institute for Strategic Studies. Coming up, we'll talk to Dwayne Lysite, a co-head of EMEA M&A at JP Morgan, as global deals top $5 trillion in 2025. So what does that mean for momentum? That's next, and this is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Glencore jumps after confirming that it's in talks to be taken over by Rio Tinto in a mega merger to create the world's biggest mining company. Now, the U.S. president says he plans to meet Venezuela's opposition leader as soon as next week as the U.S. military prepares to hit drug cartels on land. Plus, TSMC, the go-to chip maker for NVIDIA, reports better than expected sales, reinforcing hopes that global AI spending can be sustained. So deal makers closed out 2025 with a staggering $5.1 trillion haul, the second best year on record, with huge takeovers across a number of industries. Now, many advisors anticipate that 2026 could set a new high for M&A as Wall Street optimism persists despite brewing trade tensions and, of course, talk of a market correction. Dwayne Lysite, co-head of EMEA M&A at JP Morgan, joins us now. Dwayne, thank you so much for joining us. I always look forward to our chat at the start of the year because it gives us a good indication of why people would be merging, right? Is it to create value? Is it desperation? Is it just that bigger is better?
Well, first of all, thank you for having me on, and great to see you, and Happy New Year to you. Bigger is better. I think there's 2025 is a year of the return to the mega deals. We had probably about 40 in 2024 globally, 71 last year. And a record level of volume. And that really drove your 5.1 trillion up from 3.6 trillion in 2024. We see that continuing, Francine, for all the reasons you say. It's not scale for scale's sake. I think the market is rewarding focused scale, so the right type of scale, but it's also down to the synergies that can be created, the opportunities, the innovation, the attraction of top talent into bigger, more dynamic businesses. They're the drivers.
There was an issue before about valuation, right? That people said, we want to merge, but actually you're expecting too much, and I think you're worth less. Has this, is there a better match now because of some of the stress we're seeing out there? It could be geopolitics or just people feeling a little bit more anxious.
I think valuations in some ways have settled, allowing, or steadied, if you like, allowing people to strike kind of better combinations. The use of stock is on the increase versus cash, which does help you bridge that valuation debate. But I think more than anything else, I think there is a focus on driving growth into the long term and looking for those opportunities. And in that way, it does help you bridge that value divide.
What does Rio Glencore tell you?
I think it's back to that kind of the mega deal trend that is there for the right reasons in terms of seeking the right type of scale. But it is a continuation, I think, of the theme last year. And I think that's going to continue into 2026 and potentially beyond, as people are looking for opportunities to expand their business globally or otherwise.
Will it touch defense companies? I mean, again, it's strategic, but they're actually quite small in Europe. So if you had one big one, maybe they'd have more weight.
I think you've got the geopolitical overlay on that in terms of every government will have its own view as to what it needs locally or otherwise. So I wouldn't try to predict what happens there, but you have to suspect that there will be consolidation on a country-by-country basis or within specific regions, depending on their alliances.
But is Rio Glencore, I mean, this is about copper, so does this go back to geopolitics or is it AI? Both?
It could well be both. I think we're going to see more of that type of deal in terms of scale transactions.
So in what sector?
If you look at the sectors last year in 2025, tech-led, industrials followed, FIG, healthcare, and consumer retail. They're probably, certainly 2 or 3 of those are my top choices, particularly tech and industrials. Combined, they're over 42% of global M&A volume. And that's where the bigger deals are getting done. And that is what has driven this real rise. That will continue in 2026, we suspect. Whether it goes in beyond that is another matter. But you have to see tech. It's at your AI point. Where is that AI money getting spent? Do I need to consolidate to really be the leader in the long term in that area?
I mean, I know I'm oversimplifying, but there's good M&A or bad M&A, right? So there's good M&A when you say, look, we want to be better, we were stronger together, and then there's bad where you think, actually, I'm in a spot of trouble, I'll be better under a bigger umbrella. What kind of AI deals do you see? Because I hear a lot of, when you look at valuations, people say there's going to be maybe a washout, and the big companies that will be fine no matter what in AI will take over the smaller ones.
I think you see that in every developing sector historically. I could take you back to, 99, 2000, 2001, 2002, expansion of the internet age, and then the slowdown, and then the consolidation. I would say that's probably happened most industries over the long term. Do we expect it necessarily to be any different with AI? Potentially not. Let's see. I'd love to be able to predict it as well, but I'm just not that good, I'm afraid.
No, you are very good. Are there more companies that try to go private? Will there be more in Europe, especially, which has been slower than the U.S.?
Yeah, I think there will be. Europe had a good run of take privates last year. And it was a global trend, as you say. We think that, yes, that will continue. We see real value in Europe. And I think that is the opportunity there. Maybe a undervaluation in public markets provides the opportunity, particularly if as growth rates, and we expect growth rates will start to rise. And I think people getting ahead of that, buying businesses at the right valuation with growth in the future, I think is actually a great opportunity. So expect more.
Cross-border? I'm glad you're sitting down, because cross-border, are we actually going to see cross-border consolidation?
We saw quite a bit of it last year. Okay. And when we looked at the numbers...
I need to sit down.
When we looked at the numbers at the end of the year, we were probably surprised by how much cross-border there actually was. It was a major driver of those mega mergers. If I look at the 71 deals, I called it, about 18 of those or so were actual cross-border deals of proper scale. And that tells you kind of where we are. People are still thinking globally. I need that global franchise. And as much as we talk about deglobalization, it's actually continuing in terms of the globalization element is continuing in M&A. These companies need to have a global footprint. And there's some great value opportunities out there.
Are European companies looking for the U.S.? I mean, we've seen, again, the wave, right, because of politics and the Trump administration is, I'm going to invest a lot more in the U.S. I think they're also thinking, some of the coffee producers in Europe are saying, I need a base because that will keep everyone happy and I can touch that consumer. Are we going to see more of that in 2026?
I think we are. Actually, it's going to be a continuation of 2025. We saw quite a bit of it in terms of the cross-border EMEA, say, into North America. It was actually very strong, and vice versa. And the leading countries are the countries you'd expect. The UKs of the world, France, Germany, etc. We see that again as a trend. Interesting trend is how much is actually coming from APAC as well, and the Middle East. So markets are evolving and developing and becoming again that more global, internationalized.
Dwayne, thank you so much for the terrific update. Dwayne Lysite there, co-head of EMEA M&A at JP Morgan. Now, TSMC's revenue has topped estimates, reinforcing hopes of sustained global AI spending in 2026. We're just talking about that, despite concerns about an industry bubble. The go-to chip maker for NVIDIA reported a roughly 20% rise in December quarter revenue based on calculations from monthly figures. Well, Charles Schrum, a technology analyst at Bloomberg Intelligence, joins us now. Charles, thank you so much. So what's driving the sales?
I think there are two reasons behind. First, I think obviously it's because the NVIDIA's AI chip demand. It's ramping up the shipment of its new Blackwell AI server in the second half of this year. That drive a lot of orders growth. And another actually unsung hero actually is from Apple. Apple's iPhone sales is actually quite strong, especially its iPhone 17. It has a great traction in China market. Our numbers showing that actually it has grown more than 35% in the first 2 months of the fourth quarter, actually gaining back some of the market share from local competitors like Huawei. So that's actually another reason for the strong sales growth for TSMC this fourth quarter.
And is this growing trend likely to continue through 2026?
Yes, we believe that's definitely the case. So when we're talking about the revenue trend, we are looking at the wafer shipment volume and also the pricing. So for the volume, actually, it's not just the NVIDIA AI chips will drive the volume growth. It's also the other AI chip makers, designers like the Google, Broadcom. These people, they are also launching a new AI chips, and that actually demanding more leading edge nodes from TSMC. But also one thing, and maybe not many people are aware, is actually these days that the AI chips is getting bigger and bigger. That means more wafer volume output for TSMC. And another reason is actually the pricing. Actually, nowadays, actually TSMC is the dominant makers for these AI chips. There's no alternative, so you have an up hand in the pricing power.
Charles, thank you so much for joining us. Charles Schrum, there, technology analyst at Bloomberg Intelligence. Now, UK retailer Sainsbury's is the biggest faller on the stock 600 as growth in food sales over Christmas was undermined by weak demand for clothing and electricals. Grocery sales rose 5.4% in the third quarter, but overall like-for-like sales fell short of analyst estimates. And Elon Musk's artificial intelligence startup, xAI, is burning cash quickly, with losses mounting as it spends to build data centers, recruit talent, and develop software that will eventually power humanoid robots. According to internal documents seen by Bloomberg, xAI reported a net loss of $1.46 billion for the September quarter, up from $1 billion in the first quarter. Now, it spent almost $8 billion in cash in the first 9 months of the year. And this month's episode of Bloomberg Tech Europe has been taking a deep dive into AI's impact on the music industry. The technology has been used for everything from generating melodies to enhancing vocals. But there are concerns that AI models have been trained using copyrighted music without compensating the owners. Tom McKenzie spoke exclusively with the Grammy Award-winning artist will.i.am about why he sees AI as a new renaissance.
The artists that are protesting have every right to, right? Because, say, for example, Coca-Cola wants to license your music, or McDonald's, or Starbucks, or, some politician running for office. They want to use your music for their campaign. You have to license that, and the artist has to sign off on that.
But licensing of copyrighted music is possibly a solution for these AI models that are training. And so far, a number of them are trained, the allegation is, a number of them are trained on copyrighted music without compensating those artists. And licensing could be the solution.
Licensing is a solution. But what is the value of those recordings and those copyrights? And so that's the heavy one. We licensed our music to Spotify. They don't value it the way that it should. Then that brings upon another conundrum. A song is worth how much? A stream. So you could license it, but let's hope that the folks that are, divvying up its value and its worth love it and appreciate it and price it for what it actually costs, as far as time. But the model is getting better and better and better. it doesn't have to learn from the past to create.
There's going to be a premium in terms of the human experience in this new AI world. Things like live experiences, live concerts, live sport. Is there going to be a premium for that kind of entertainment?
It's called lived experience. AI is not living. So when you go see yes, there's going to be lots of music. There's going to be AI bands. That's true. It's going to be like an AI freaking Bruce Springsteen. There'll be an AI Lana Del Rey. There'll be an AI freaking Adele. Yeah, and it's going to sound great. People like it. And you're going to go see it perform live. And the team that makes the live performance is going to be freaking, it's going to be dope. And then there's going to be human lived experience that you're still going to love. It's not doom and gloom for the music industry.
Well, will.i.am speaking to Tom McKenzie for Bloomberg Tech Europe. Now, Donald Trump's trade advisor has told Bloomberg that he thinks American industrial breakthroughs will eventually end China's dominance of the rare earths market. Peter Navarro says it's only a matter of time before Beijing's monopoly is over, and he's been speaking to Bloomberg's Michelle Hussein.
The China relationship is a very difficult one. China has been flexing its muscles now in Europe, in India, in the United States, saying basically, we're going to do what we want, and if you try to stop us, we're going to take away your critical minerals, because they think they have a monopoly on it. But that's just a matter of time. American innovation is going to quickly wipe away that innovation, that threat, that weaponization.
And you can listen to the full conversation between Michelle and Peter Navarro. Just search The Michelle Hussein Show wherever you get your podcasts. Now, coming up, we'll talk to Roland Rudd, global co-chair of FGS Global, about how businesses can navigate a fragmenting global order. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
I think we have to earn that independence, and I think we have to be accountable for this independence. But the independence is critically important to make sure that the decisions are as unbiased as possible and only determined by the macroeconomic analysis and the anticipation of what monetary policy will do.
Yeah, because it can't be, based on an election cycle.
There is a very good reason for that. Typically, monetary policy decisions have an impact down the road. If I hike, cut, or hold, it's not going to have an impact now, nor in 6 months' time, and probably not even in a year's time. So the passing of time is something that we have to take into account. And if in between you have an election cycle and somebody who says, oh, no, you should do this, you should do that, it will be completely counterproductive and counter-cyclical. That's the risk. So central bankers need to have time on their side, which is why most of them have long-term mandate and take decisions that have a target in the medium term, not in the immediate short term, because it's not going to work.
ECB President Christine Lagarde there speaking to me for the latest episode of Leaders with Francine Lacroix. It premieres today at 5:30 p.m. in the UK on Bloomberg TV. You can also watch it on the Bloomberg website and then on the terminal. Now, the post-war global order is fragmenting into spheres of influence as strongmen, leadership, and transactional relationships replace multilateral cooperation. According to FGS Global's Radar 2026 report, we have entered a rewired world defined by intensifying U.S.-China competition across the critical frontiers of trade, technology, and space. Well, Roland Rudd, Global Co-Chair of FGS Global, joins me now. Roland, great to have you on the program. I mean, your report was kind of condensed in the week that was, right? Because we've seen it play out, but with a lot more force than maybe we were expecting. Are you expecting this rewiring to happen quicker?
Well, I think radical change is coming, because if you look at the numbers, it's unprecedented and not sustainable, the level of pessimism. 70%, around 70% are saying they believe their country is incredibly divided, that democracy is fracturing, and that the next generation is going to be poorer. Now, the only sort of good thing about it is if you actually know what the problem is, you've got time to deal with it. And in some ways, it's not that surprising, because also in our report, 47% said they actually are looking towards leaders who have very clear, simplistic solutions. So you can see from the rise of populism and populist parties that there's a massive problem here, which our report shows.
But Roland, there's a danger that a lot of people in charge actually don't mind the division as long as they get 51% of the popular vote.
Yeah.
So what does your report say in how this, where we end up in 1 or 2 years?
Well, so I think what the report is showing is that people are expecting significant different policies to come forward, because they don't think what's happening now is sustainable. And there's some very interesting things there for business in a way, because you wouldn't be surprised that, given the fact that we interviewed 175 prominent business and leaders and whatever their fields are, that they believe that the burden of taxation is falling too much on great companies, which are obviously employing people. But then the public think that by 80%, think that taxation should fall more heavily on business. 64% want a wealth tax. I have to say, Francine, I think a wealth tax is coming, because the numbers of people wanting that have been growing every year, and it's always based on this extraordinary inequality. But it's important that businesses don't take the wrong sort of messages, because 5 years ago we had a lot of campaigns on ESG, DEI. The public is saying, don't be political, don't do these campaigns, but you've got to be agile, you've got to have a strategy, and you've got to be able to show that you stand for more than just profit.
Roland, I mean, you also say, this is a year of strong leaders and weakening institutions. What do weakening institutions mean for businesses?
Well, it's obviously bad news, because if people see the fact that it's better to have strong leaders, and that strong leaders are more important than institutions, that fraying of trust is obviously going to affect businesses too, because people who are prominent in society are no longer having the same resonance that they had before. So you have to actually try harder to get your message across, and you have to be able to speak authentically, and you have to be able to persuade people that you aren't just making a profit or just employing people, which is good, but that you are actually doing something that's beneficial for society.
2025 was also a year where you saw, data on the economy,
Yes.
and the perception actually from chief executives was different because
Yes.
they had, by and large, okay businesses, but they said, but my neighbor's not doing great, or my
Yes.
competitor's not doing great. Will it be different in 2026?
I think potentially it will be. I mean, one of the great things we're seeing here is, the US, of course, is less pessimistic based on the incredible rise in the market. What's underpinning that? AI. But you see, there's an incredible divergence between the elites who think AI is amazing. Donald Trump saying, we're 6 months ahead of China. But the public who, by 40% in the US say they've actually known somebody who's lost their job to AI, and not surprisingly, around 80% in the US want to see greater regulation of AI. So there is a real dilemma here, and it's going to be very interesting how it's worked out. People used to say that AI was the sort of tentpole of the economy. Maybe it's a stick of dynamite.
Yeah, actually, it's a really great report because you also have, you asked a lot of the senior leaders what are the most important issues facing their country. In the US, 42% said government corruption.
Yeah.
In the UK, 49% immigration. Where are we in the UK right now?
Well, I think probably the good news for the government is that the immigration numbers, which in terms of people who are concerned about immigration, have been huge, but are beginning to fall. And obviously, in terms of net migration, that also is beginning to fall everywhere. It's interesting that it's not the number one issue. The number one issue today is the cost of living, inflation and cost of living, but it's still there normally in the top three. So that is a slight sliver of hope for the government in terms of dealing with this particular issue.
Do you see us still want to be in the UK? I mean, there's been a number of things that were taken quite badly with the business community. The taxes, the non-DOMs. What do you expect for 2026?
Well, there are people who've definitely left because of the non-DOM issue, but there are also people who've arrived. Right, a lot of Americans have actually arrived because they don't like Trump's world. And so we're getting that type of, boost. I think the taxation thing is sometimes overdone. There are some prominent people, quite often in private equity, who leave for taxation. But do people really want to live in Dubai? It's a lovely place to go and visit and do business in, but not necessarily actually leave London, which is, after all, the cultural centre of the world and one of the great business centres of the world. So I think that might be slightly overplayed.
Roland, when you look at, we're running out of time, but actually you also talk about this fierce battle for the future. I mean, this is energy. We've lived through this week. Do you see, this big, fossil fuel versus clean energy, fighting this year, or is it more just about access to natural resources?
I think it's going to be more access to natural resources. Interestingly, in the report, people still see the issue of net zero as important, but they don't see the issue of environment and the problems affecting climate change actually adversely affecting them. So it's obviously gone lower down on the agenda. But I think it'd be a mistake to sort of take it off. It depends, of course, how you explain it, because actually people are in favour of renewable energies. They're just a little bit concerned about net zero because it's got a slight political tinge to it. But I think on renewables, people will support it.
Roland, thank you so much for joining us. Roland Rudd, their co-chair of FGS Global, with this new report just out. Now, the U.S. Energy Secretary Chris Wright is on Balance of Power at 10 p.m. London time. That will be a good conversation on oil, Venezuela, and actually what comes next. Up next for us, it's Bloomberg Brief, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Tariffs, I think,
are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. In cooperation, President Trump says the U.S. and Venezuela are working well together and says he has canceled a previously expected wave of attacks. The Supreme Court convenes, markets keenly watching whether we get a ruling on reciprocal tariffs later today. And investors brace for a fresh read, finally, on the labour market, with the whisper number for today's non-farm payrolls at 66,000 jobs created in December. So markets look to be pricing in some risk at the moment. Futures are pointed higher. Yesterday, the S&P finished flat. The Nasdaq was actually down 0.6% thanks to tech. The SOX index down 1.8%, although broadly, defense companies did well, and that sort of held things up. But we are still on track for gains for the week, the first week of the year for the major indices. It's all going to come down to that non-farm payrolls report, and then, of course, any potential SCOTUS ruling on tariffs. Bond universe-wise, we are seeing a lift in yields right across the curve, a couple of basis points here at the 10-year yield, 418.70. We are still in that range, though, between 410 and 420. We haven't tipped that ceiling of 420 quite yet. We're back to 350 plus, though, on the 2-year. And then I just want to point to a Goldman call on copper as well, saying that perhaps we've seen the peak, that prices may actually come down, that President Trump is likely to potentially delay tariffs on copper later this year in what's now becoming a very obvious affordability push. All right, let's get to some individual movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Bonnie. And speaking of that affordability push, we are seeing home lenders rocket higher in pre-market trade off the back of the post from President Donald Trump about asking Fannie and Freddie to buy $200 billion worth of mortgage bonds as the Trump administration targets affordability on housing. We're seeing Loan Depot rise 19% in pre-market, Open Door up 8.25%, and Rocket Mortgage up over 6% on the back of this announcement from the U.S. president. Moving over to the auto space, another write-down when it comes to a change in EV production. General Motors announcing an additional $6 billion worth of a write-down. We're seeing GM fall just shy of 1% in pre-market trade. Vonnie, some of its competitors also have listed write-downs for the rollback of their EV production, and this comes as The Biden-era green policies has been mostly rolled back by the Trump administration, and that EV tax credit came to an end last year. Lastly, let's head to the red-hot biotech space. Financial Times reporting that Merck is looking at a purchase of Revolution Medicines. The cancer drug maker is higher by nearly 16% in pre-market trade. Merck has been on a buying spree lately, trying to fill the revenue hole lost by one of its recent cancer medicines, losing patent protection. Revolution Medicines does have a market value of near $19 billion, so it would mark yet another blockbuster deal in the pharma space this year. Bonnie?
Yeah, and the stock seeing that nice pop. Valerie, thank you so much. Valerie Titel there in London. And coming up this hour, we'll count down to the payrolls report. Veronica Clark of Citi joins. But first, this just in the last hour, President Trump has given an update on Venezuela, writing on Truth Social, quote, Venezuela is releasing large numbers of political prisoners as a sign of, quote, seeking peace. This is a very important and smart gesture. Because of this cooperation, I have cancelled the previously expected second wave of attacks, which looks like it will not be needed. Let's over Washington now and speak with Bloomberg's Kasia Klimaszinska. So, Kasia, did we know that there was a second wave of attacks planned for Venezuela?
Already a busy Friday here in Washington, D.C. President Trump, as you mentioned, posted on Truth Social just within the last hour. So we knew that the ships and the armed forces are in the region, that the U.S. is maintaining its posture, and President Trump says it will remain so, but there wouldn't be the next wave of attacks that he called expected, because he praised Venezuela for releasing prisoners, calling it a smart step. So this is another sign that Trump wants to work with this interim government in Venezuela. In the same Truth Social, President also mentions the meeting that he has with the oil executives here in D.C. today. That will be at 2:30 p.m. at the White House. Almost 20 executives coming over to discuss what Trump described as more than $100 billion of investment into Venezuela to boost its energy sector.
Yeah, and from what we gather, it's not just U.S. executives either, Kasia. It's going to be fascinating. Just on Venezuela, Trump meeting with opposition leader Maria Corina Machado next week, apparently. This potentially could signal trouble, no, for Delcy Rodriguez?
That was surprising. Trump mentioned for the first time yesterday in an interview with Fox News that Machado is coming here to D.C. next week, and he's looking forward to meeting her. Still, he has voiced a lot of skepticism about her, and he has said that he himself and Secretary of State Marco Rubio is talking to the current interim president of Venezuela, Delcy Rodriguez. So I think the collaboration will mostly happen with her, especially as, again, Trump really wants to rebuild this oil sector in Venezuela. He wants to send the U.S. international companies there and start pumping that oil.
Kasia, I can only imagine the anticipation in Washington, D.C. today, and it's not just the non-farm payrolls report, it's also the potential SCOTUS ruling. Tell us what's happening. They're definitely meeting, and we may get a decision, right?
As soon as at 10 a.m. today, but maybe later. Today is just the first day that the Supreme Court has the chance to rule on this key part of President Trump's economic agenda, the global tariffs that he imposed in April of last year, between 10 and 50%. I'm sure you remember stocks plummeted back then. So this could be a big risk event today.
Yeah, we will be waiting for those headlines. And then, of course, we also got another affordability push yesterday with Trump directing the GSEs, Fannie and Freddie, to buy $200 billion worth of mortgage debt. What's the thinking here? It's not going down that well in the market. People saying spreads are already tight at 22 basis points. This won't do much.
Affordability, exactly. This is the word of the year, at least here in the U.S., as President Trump is trying to bring down the cost of homes, makes homes more affordable for average Americans. He announced several steps this week. First of all, he said that corporate investors should not be buying up those homes. And now he is delegating Fannie and Freddie to buy those bonds in this effort to bring down the cost of mortgage for an average American. Those costs are, of course, elevated because interest rates are still high. But on the margin, I think it might make a little bit of a difference, especially as Trump and his administration said that they will announce more. And most importantly, he's about to announce his new Fed chair that he will expect to cut interest rates.
Yes, he said he's already made his decision but hasn't told anybody. Kasia, thank you so much. Kasia Klimaszinska there in Washington. Investors also obviously keeping a close eye out for the payrolls data, 8:30 Eastern. Bloomberg's Sylvia Westall joins us now. So Sylvia, we had a slew of data this week already, but we're still in a range, at least on treasuries, that 10-year is still under 420. What would we need to see today in order to break out of that range?
Sure. Well, the expectation in the market is that it will be quite a good jobs report. They're seeing a stabilising of the job market. So anything that goes against that, we could see a reaction here. I think it's important also to see that coming into this, the market's positioning, people have been buying short-dated debt and they've been staying away from long-dated debt. So there's been this trade that's been there, and people have been holding on to that trade towards the end of 2025 and have been coming into this year. This is really the sort of first data that can really give us some kind of direction going forward. And the expectation is that the Fed will hold coming in, but there is, big question marks over what this data could bring. If we're seeing a weaker jobs market, then it could kind of raise expectations that it could be a cut. Otherwise, the market's expecting that further out into the year. So it's really about how this market that's been very range-bound, as you've mentioned, is going to react to this data, as well as the inflation data coming next week into the market and what implications that has.
Sylvia, you talked about positioning, and traders seem to have been positioning for a potential drop in the 10-year below 4%. What is behind that impetus?
Sure. I think it's the expectation there that further out we are sort of in this cutting cycle as it goes forward. But as you've mentioned also previously, there are a lot of unknowns coming in now. We've got the Fed chair, which has meant people are expecting this dovish pick coming in. We've also got the tariffs coming in. That could be another kind of wild card coming in. So I think there are the expectations going in about the Fed. Gradually there's going to be more cuts coming along. But the question is, how quickly is that going to be happening, and at what pace, and what kind of magnitude are we seeing? So I think given all this, we have seen people trading within this careful range. But perhaps today is the beginning of when we're really seeing data that really gives kind of a kind of clear path for the market going forward, as well as all these sort of unknowns coming into play.
Sylvia, so many cross currents, because we obviously might get the SCOTUS decision today on tariffs, and apparently tariffs have raised hundreds of billions of dollars for the Treasury, right? So they might have taken a little bit of the pressure off. If the Supreme Court decides against the tariffs, will we see an immediate market reaction, particularly on Treasuries and even the dollar?
Yeah, I mean, what we've seen there was kind of reactions to tariffs news last year earlier on, but right now some of the moves have become more muted. So there could be a sort of an initial move there, but generally it's something that will kind of focus more on the longer dated US debt. But as a whole, we're expecting maybe to be a slight blip, but going forward, tariffs news has had less kind of impact on the markets going forward. But again, it throws that into the mix as well. It's again another unknown that's going forward.
Exactly. Today could be just one of those days. Sylvia, thank you so much. Sylvia Westall there. Now to other top stories trending on the terminal this morning. Iran has restricted internet and phone access overnight in an escalation of its attempt to quell protests. Thousands of people appear to have taken to the streets across the country, including in the capital, Tehran. Iran's supreme leader says his country won't back down against mercenaries or those who engage in vandalism. Russia says it struck western Ukraine using an intermediate-range ballistic missile known as Oreshnik. Ukraine's foreign minister has described the attack near the NATO border as a grave threat to European security. Russia also launched hundreds of drones targeting Kyiv and the surrounding area. And China's consumer price growth accelerated last month due to higher food costs as deflationary risks stalk the world's second biggest economy in the absence of more forceful stimulus measures. Producer prices fell 1.9%. That was their 39th straight month of declines, while China's core CPI grew 1.2% for the third straight month. Coming up, a beat for TSMC. Investors breathing a sigh of relief on the chipmaker sales. That's next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Growth hasn't been that bad. What's been bad is the employment growth. Why is 26 going to be different?
The balance of power in the jobs market, I think, has shifted towards employers.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What really is going to matter is the inflation data and the jobs data we get in January.
There's a lot of strength despite some of the weakness that we see in the unemployment rate.
The December jobs report, today on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. TSMC boosting hopes of continued global AI spending this year with an upbeat outlook. Let's bring in Tom McKenzie for more. Tom, so we get full results obviously next week, but we got a little glimpse into how TSMC did at least last quarter.
Yeah, Vonnie, and as we've discussed through this week, if you combine what we've seen in terms of the numbers from TSMC, that key owner of those foundries, of course, that actually crunch out the chips, and what we heard from Jensen Huang of NVIDIA and AMD's boss, Lisa Su, of course, at the CES in Las Vegas, what we hear from all of those parties is that the demand continues. So the top line numbers coming through for TSMC, very strong indeed, coming in above the estimates in terms of what they've been able to ship. They're likely also to have gotten a boost from pretty strong demand for iPhone 17s as well, because they produce those. But it is the GPUs, it's the data center piece that, of course, for the question around AI and the boom there is absolutely central. Top line numbers, 20% rise in quarterly revenue to more than $33 billion US for TSMC, above the estimates. We'll get more details, by the way, Vonnie. January the 15th, we're getting an update from the executives. They'll give a bit more granularity. They'll talk about the demand picture, and importantly, they'll talk about CapEx as well. The team at Bloomberg Intelligence thinks the number could be around $48 billion that they could be spending on CapEx in 2026, and you're seeing that reflected in terms of the upside for some of the kit and infrastructure makers in Europe, the likes of ASML, of course, that makes the lithography machines, lifted in the session today on the back of the numbers coming through from TSMC. They are seeing no let up, TSMC, in demand for what they actually produce, the hardware, churning out those chips, GPUs, for data centers.
Unbelievable, but it's not unbelievable because it's in the data, right, Tom? Now, moving to XAI, we're hearing that Musk is burning almost $8 billion in cash. Can you tell us what we do know about what exactly is going on behind the scenes?
Yeah, and of course these two stories link together, don't they? Because Musk is spending heavily, a lot of that money is going on those semiconductors, on those GPUs, designed by likes of NVIDIA and actually produced and manufactured by the likes of TSMC. So a lot of spend is going in that direction for Musk. But you're right, the superlatives around the spend coming through from XAI are pretty significant. Close to $8 billion US in the last 9 months, 1.4, close to 1.5 billion in the most recent quarter. What we're expecting to see from XAI is this focus, particularly on software, AI software, agentic software that can be parlayed and built into the humanoid robots that the company is making as well. So that is really their aim. It's the humanoid robots, it's the software that goes with that, but they're having to spend heavily on not just the chips, not just the GPUs, but also the talent as well, and the data center build out for those aspirations. Recently, of course, XAI raised about $20 billion US dollars from the likes of Nvidia. There's the circularity question for you. And they are valued at about 230 billion US dollars. They have a bit of runway. They've probably got a runway for another 12 months to spend, but you're right. They're burning a lot of cash. Revenues have increased, so that's the upside coming through from XA, but a long way still from profitability.
Tom, thank you so much. Fantastic reporting. Tom McKenzie there, host of Bloomberg Tech Europe. Mining shares in Europe also on the move, with Rio Tinto falling and Glencore jumping as the two discuss a tie-up to create the world's biggest miner. The new entity would have a combined market value of more than $200 billion. Now, the news today comes a little over a year after earlier talks collapsed. Joining us is Bloomberg's Mark Burton, who leads our EMEA mining and metals coverage. So, Mark, I feel like I have this conversation at least once a year, right? The deal collapsed a year ago. Why would it work now?
It's a very good question, and I think there are very significant hurdles still. This is a kind of a very preliminary discussion that the two companies are having. There have been some changes in the underlying markets, though, particularly copper and coal, and I think that those are the two things that everyone is looking at. Copper is underpinning the logic of the deal. Prices have soared above $13,000 this week. If you kind of look back to 2024, when they were discussing this kind of deal before, copper was around $9,000 at the back end of the year. Importantly, though, we were also in the kind of back end of a massive rally in coal prices, and Glencore's portfolio is copper heavy and it's coal heavy, and Rio might love the copper, but there have been widespread expectations that it would view the coal portfolio much more dimly. Glencore executives are keen on coal. I'm sure they would have been asking for a fairly rich price for it at the time. Yeah. One key question is whether on both sides there's a bit more of an alignment on what to do with the coal business.
Yeah, because Glencore just fairly recently bought Tech Resources coal operations, right? So it is sort of expanded in coal. What about antitrust concerns? Would there be any in any jurisdiction?
Yeah, I think that's the other thing that has it's a continuation of a long-running trend, but it's hard to overstate how important copper is at a geopolitical level, and I think there's kind of widespread recognition that it's one of the most important industrial commodities for the 21st century, and it's also one that's facing acute supply constraints. China, in particular, faces a big import reliance in the sort of supply of primary copper ores. It has looked closely at Glencore's deal to buy Xstrata way back in 2013, and it extracted the sale of one of its core copper assets, and also a long-term deal for Glencore to supply copper to China. That again is a key dynamic in any potential deal that might arrive. At this point, things are so preliminary that it's difficult to know how any regulator might react. Similarly, investors at the moment are just asking exactly what the terms of the deal might be, and then we'll have a little bit more clarity as to whether investors and regulators will feel it's a viable thing to be done.
Yeah, it's always fun to watch a deal in the works, right, Mark? Mark Burton, thank you so much. Yeah. Coming up, more agents head to Minnesota as the U.S. takes over the shooting investigation. A look at what's making headlines in your front page news next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Time now for your front page news. First up on the New York Times, it's leading with reporting that at least 100 more federal agents have been deployed to Minneapolis in the wake of the fatal ICE shooting. The state of Minnesota has withdrawn from the investigation because federal officials have denied it access to evidence. At least 1,000 people marched through Minneapolis streets after dark, chanting and waving protest signs. Next up, the Washington Post reporting President Trump suffered a day of Republican defections in Congress Thursday. At least 24 Republicans voted with Democrats to defy Trump's will in House votes to overturn 2 of his vetoes. And in the Senate, 5 Republicans joined Democrats in advancing a resolution blocking further military action in Venezuela without congressional approval. And finally, from the BBC, Colombia's President Gustavo Petro says there is now a, quote, real threat of U.S. military action against his country. The remarks suggest relations have not significantly improved, even after that phone call with President Trump Wednesday, after which Trump said he would meet Petro at the White House in the near future. And I just want to bring you some breaking news. Rio Tinto said to be open to owning coal assets if it buys Glencore. That was one of the questions we were just asking. Investors obviously asking it as well as analysts. Glencore now happy with the idea that Rio Tinto would want to own its coal assets. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. In cooperation, President Trump says the U.S. and Venezuela are working well together and says he has canceled a previously expected wave of attacks. The Supreme Court convenes, markets keenly watching whether we get a ruling on reciprocal tariffs later today. And investors bracing for a fresh read on the labor market with the whispered number at 66,000 jobs added in December. So let's take a look at those markets now. We are seeing futures higher after a day of no gains, no losses yesterday for the S&P 500 and a day of declines for the NASDAQ 100, primarily though on tech companies. The SOX was down 1.8%. The Russell 2000, which has hit a record this year, the others haven't so much. We are still on track for gains this week though for all of the major indices unless we see something change radically today. Now, economists surveyed by Bloomberg anticipate 70,000 positions added to the U.S. economy in December, but as you heard there, the whisper number is slightly lower than that. So if you look at yields, you are seeing higher across the board, particularly there at the 10-year yield. Still not reaching 420 though, still in that range. And then in terms of metals today, we are seeing gold down just about $8, Bitcoin just above $90,000. And copper, well, Goldman has an interesting call on copper today, saying that President Trump is likely to delay a decision on tariffs into next year because of his affordability push. All right, let's get to some individual movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Ivani. Let's start with that affordability push from the White House. President Trump tweeting that he has instructed Fannie and Freddie Mae to buy $200 billion worth of mortgage-backed securities, and that lowering of mortgage rates is seeing the likes of mortgage lenders such as Loan Depot surge in pre-market trade, up nearly 20%. Open Door Technologies up nearly 8%, and Rocket Mortgage up 6.8%. This is the latest in the string of moves from the White House to target affordability in the housing sector, and it's looking like it is setting these lenders alight this morning. Let's move on to the auto space. General Motors adding to its write-down from its production shift away from electric vehicles, another additional $6 billion worth of a write-down. We're seeing shares of GM head lower in pre-market, just shy of 1%, but it does follow a string of some of its competitors like Ford, who have also come up with big write-downs as they shift away from EV production as the Biden-era green policies are rolled back and that Trump EV tax credit was ended last year. Lastly, let's end in the biotech space. Revolution Medicines, this is a cancer drug maker, is coming into the eye for Merck. The FT reporting that Merck is looking at buying the cancer drug maker, and the shares of Revolution Medicines are headed higher by nearly 16% in pre-market. Now, Revolution Medicines, Vonnie, has a market cap of around $19 billion. So if this deal does come through, would mark another big deal in the biotech space in the last few months. Vonnie?
Yeah, very major deal. Valerie, thank you so much. Valerie Teitel there in London. 3 hours away now from the December payrolls report. Michael McKee is here with us to take us through it. Can we depend on this data? Is it reliable? Are we finally getting to a place where we're seeing a real picture of events?
Well, happy Jobs Friday, and we're hoping that it's reliable enough to at least come out at 8:30, and then we'll see what the numbers, 8:30 Wall Street time. The forecast is for a slight rebound in hiring after a couple of weak months that were distorted by the government shutdown. 70,000 jobs overall. On the private side, 75,000, as we still continue to lose government jobs. People maybe delayed in filing for unemployment benefits or something that pushed them out. Unemployment expected to fall to 4.5% from 4.6% last month, but the question here is really going to be in the rounding. Nobody really thinks we're going to have a big move, but we could round down a little bit in a reversion to the mean. I know that Veronica Clark is here, and she's going to tell us that we're all wrong. Unemployment's going to go up. What you want to watch today, Vonnie, is the unemployment rate, because it is the key number for the Fed. We see volatility in the jobs created numbers and a lot of changes in terms of which sectors are hiring, but it's unemployment that doesn't change on a month-to-month basis, doesn't get revised, so the Fed watches that. We'll see what the revisions are. I think it says decisions, that's my mistake. Revisions to October and November, and then the change in the labor force, and as we were talking about there, the composition and breadth of the job growth. If we do have job growth, is it concentrated only in health and social services, basically, or do we get some jobs in other areas?
And of course, if the unemployment rate moves up or down, it matters why it moves, right, Michael? What part of the...
Yeah, that's an interesting point, because what we have seen, surprisingly, is that the labor force has continued to grow. More people have been coming into the labor force, which is usually a sign that there is that people haven't lost confidence in their ability to get jobs, but it also makes the denominator bigger, so we see a rising unemployment rate. And so we'll see how that plays out today. If you see a contraction in the labor force and you see unemployment going up, that's a bad signal. But 8:30, we get Wall Street time, we get the numbers, and 8:31, I think we will get the Wall Street decision on whether they think the Fed is going to cut rates in January.
8:30, I think, more like it. We'll also be watching wage growth, of course, as well. Michael McKee there will be with us all day long to take us through the numbers and give us context and explain everything afterwards as well. Joining us now, though, is the aforementioned Veronica Clark, U.S. economist at Citi. She's looking for 25,000 jobs created and an increase in the unemployment rate to 4.7%. Michael pointed this out. Because it is pretty unusual. There are not that many, if any, others looking for an increase. Pointed this out because it is pretty unusual. There are not that many, if any, others looking for an increase in UE.
Yeah. I think what we could see in this report is somewhat similar to what we saw in the September jobs report. That was, of course, before all the government shutdown issues. What we saw then was strong seasonally adjusted job growth. So we're expecting 5,000 payrolls. I actually wouldn't even be surprised if we see something stronger, maybe even closer to 100 or 100.
Wow.
But what we also saw in that September number was the participation rate rose and the unemployment rate rose with it. I think we'll see something similar in December, but I would caution that, just because the unemployment rate is rising, because participation is higher, you should still take that seriously. That is still a higher level of unemployment than we were maybe expecting a couple months ago.
For sure. I mean, if more people are participating, but they're not. What would we need to see? Would that be enough to see a movement from the Fed in January?
I think so. I think so for a couple reasons. Because that then looks like a very consistent increase. New highs for the unemployment rate this cycle in, I think, August, September, November, and December. That's a pretty consistent increase at that point. And then number two, there has been some unemployment rate in December. Maybe there were measurement issues, government shutdown related furloughs or things like that. I'm actually of the view that there was not much of a shutdown effect in that number. So I think if the unemployment rate rises, even if it stays at 4.6, that's good confirmation that that was a true increase in unemployment we saw last month.
What makes you so convinced that there wasn't a shutdown impact?
Yeah, so we know there wasn't a shutdown impact from federal workers themselves. The BLS did tell us that. The government reopened that reference week and those people were counted as employed. Maybe there could be some government contractors and things like that. There believe that would be related, because it didn't seem like there was a big increase in contractor claims or in payrolls. Among every group, including temporary layoffs.
Will the Fed's next decision really hinge just on the unemployment? Employment rate, though, or will they also be looking at wage growth and whether it's slowing or even speeding up?
Yeah, I think the unemployment rate is the most important number here for sure. Inflation concerns. We will have CPI data next week, which is going to be even harder to read because of shutdown-related issues. But we saw in December risks for inflation are still on the upside, but Fed officials are getting a bit less concerned about that risk. And if we see wages slowing today, which I actually think we will, that would be even more reason to be less concerned about that upside risk to inflation. So yeah, it's going to be the report as a whole for sure.
Now, Powell did make it pretty clear that he was, expecting to pause for a while. So the Fed actually cuts in January.
Yeah, we're not pricing much for the Fed. I think it's only 2 or 3 basis points for that January meeting that's priced. Yeah, it would require some communication shift, but not necessarily a difficult one, because if the unemployment Really more worried about the labor market in December. Unemployment rate we had before that December FOMC meeting was 4.4%. If we see something like 4.7, that's, you should absolutely be more concerned on the labor market.
The Fed chair had also because it's not obvious what's going on from a demand point of view or a supply point of view. You say participation will be up. Will we get any more clarity on that?
Yeah, so the supply question is interesting. It's, we have had a lot of immigration policy changes and whatnot. Certainly supply has weakened, labor supply has weakened, but there are a couple things I think that should make you confident that too. Employment rate rising, even if it's because participation is higher, but it is also wage growth. So we have seen wages slowing. Average hourly earnings in November did slow. The employment cost index, we had unit labor cost data earlier this week that was somewhat weak. That is also a good sign that labor demand is weakening more than labor supply.
Going into future months, then, if we do see a jobs report similar to what you describe, do you continue to foresee, strength in creation and weakness in the employment rate?
Yeah, it's a really difficult year to forecast because we don't have any historical comparison that looks like this one. So we've never really had a scenario where the unemployment rate has just gradually increased for a couple years. And it rises much faster. We do think the unemployment rate can move mostly sideways for the first half of 2026. Once we get to March, April timeframe, that's when we've had this residual seasonality that results in weaker data the past couple years. I would need to see hiring pick up to feel comfortable that the unemployment rate won't just continue to rise more.
What parts of the economy do you think will hold up then? Kind of SCOTUS ruling or tariff change have on them?
Right. I don't know if we'll see any immediate impacts from if we do get any kind of tariff rating today, of course. What we've seen so far pretty consistently in the labor market data the last year or so is job growth is very strong in sectors like healthcare and education, and it's weakening in just about every other sector. Labor market, this pullback in hiring that really started businesses. If the Fed is cutting more and sooner, which we think they will, then taking rates closer to that midpoint of the neutral range, maybe you can get some recovery in those types of sectors later this year.
Veronica, thank you so much for joining us in studio today. You heard it, folks, 75,000, maybe even as many as 100,000 jobs created by the unemployment rate ticking up to 4.7%. That's Citi and Veronica Clark's call. Now to other top stories trending on the terminal this morning. Glencore's massive coal business, if merger talks between the two companies are successful. The talks are about a potential combination of some of their businesses, with one scenario being a takeover of the whole of the 10 core, including the coal business. Iran has restricted internet and phone access overnight in an escalation of its attempt to quell protests. Thousands of people appeared to have taken to the streets across the country, including in the capital, Tehran. Iran's supreme leader says his country won't back down against what he calls mercenaries or those who engage in vandalism. And Russia says it struck western Ukraine using an intermediate-range ballistic missile known as Oreshnik. Ukraine's foreign minister has described the attack near the NATO border as a grave threat to European security. Russia also launched hundreds of drones targeting Kyiv and the surrounding area. Coming up, President Trump calls off a second wave of attacks towards Venezuela. We'll discuss next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Venezuela is working well with the United States. That's President Trump with an update early this morning. He posted on Truth Social, quote, Venezuela is releasing large numbers of political prisoners as a sign of secret. Because of this wave of attacks, which looks like it will not be needed. Back with us now from Washington is Bloomberg's Kasia Klimashinska. This second wave of attacks, Kasia, were we expecting? Venezuela is
exactly just after 4 a.m. this morning here in Washington, D.C., President Trump posted on Truth Social praise U.S. Navy, U.S. ships, Coast Guard are still in the region and could be deployed. Also, yesterday, he spoke about possible land strikes against drug cartels in Venezuela. So that's still very much on his mind, but also on his mind is the oil production. He really wants the U.S. companies to go in to start pumping and selling oil. And for this, of course, they need stability. They need physical stability. Being able to bring their people there and financial stability, being sure that the dollars can flow. So President Trump is meeting oil executives at the White House today at 2:30 p.m. Nearly 20 executives. President Trump this opportunity for energy in Venezuela.
Yeah, we'll be looking for any outcomes that we can hear from that meeting. Now, also on the agenda in Washington today is that potential SCOTUS ruling on reciprocal tariffs. We actually might get a decision today, will we, Kasia?
As soon as 10 a.m., the Supreme Court is meeting, and it could rule on those tariffs either today or perhaps later this month. We know that the justices see this matter as important and urgent, as more than 1,000 companies filed lawsuits seeking refunds. They want their money back. They think that President Trump doesn't have this broad authority to impose blanket tariffs on goods imported from all over the world. Those tariffs were as high as 50% for some countries. So we might get a decision today, but even if, say, the court strikes down those tariffs, saying that Trump kind of abused his authority here, the court will most likely not say how those tariffs are supposed to be refunded. This will go back to lower courts. So we'll have a lot of uncertainty here that perhaps will hit not only the stock market, but also the bonds market, because, of course, the U.S. Treasury has to find this cash to issue those refunds.
Right, and also there are other avenues by which Trump could actually impose tariffs. Meanwhile, he's continuing with his housing push. He's telling Fannie and Freddie now to buy $200 billion worth of mortgage debt. I mean, this will increase the mortgage debt on their books at least, right?
Yes, but President Trump is pointing out that Fannie and Freddie are sitting on a stockpile of cash, so they could deploy this cash to buy mortgage bonds and lower the cost of a mortgage for an average American. This appears to be working. The market has already reacted to this post on Truth Social from Trump yesterday. And of course, the administration has other tools in their toolkit to try to bring down those housing costs. Trump also earlier this week urged corporate investors not to buy housing, saying that the homes are supposed to be for individuals, for families. And Trump still is yet to announce his new pick for the Fed chair. We know that he will want this person to cut interest rates significantly this year.
An exciting day and a few weeks ahead. Kasia Klimaszinska, thank you so much. Turning to tech now, U.S. shares of TSMC ticking higher after a revenue topped estimates. The company boosting hopes of continued global AI spending this year. Joining us now is Bloomberg's Shona Ghosh. So Shona, we'll get full results next week, but we did get a glimpse into what actually transpired for TSMC in the quarter, and it was pretty good, wasn't it? Give us the details.
It was. So, this highlights that TSMC, which is a chip foundry, is an essential part of the global semiconductor manufacturing supply chain. Its major customers are Apple, NVIDIA. NVIDIA, of course, continues to boom, being a core player in the AI growth sector. So it just goes to show how these sort of infrastructure or supply chain companies, their fortunes are very tied to the broader AI boom and leading players like NVIDIA.
Yeah, exactly. And the company did seem to benefit from rush orders when it looked like tariffs was going to really impact them. Does that mean that that quarter was colored and that we might not see the type of sales in the next couple of quarters that we saw last quarter?
It's possible. It's hard to say, that there are a lot of global impacts that will potentially impact companies along the supply chain like TSMC and one of its competitors, Samsung. So, for example, the rare earth mineral shortage, the restrictions from China, will raise prices, for example. So, I think there are a number of things that could impact these companies' results. And as we've seen, they're often very up and down, and revenues will go up one quarter, and investors will say that the AI boom is continuing unabated, down a little bit the next quarter, and there's fears of a bubble. So I think we can expect that sort of up-down momentum over the next few months for sure.
Yeah, and staying in the space, but moving slightly sideways, we also learned that Elon Musk's xAI has burned almost $8 billion in cash on this humanoid robot plan called Optimus. Can you give us some more details on that?
Yes, so in the first 9 months of the year, Bloomberg reporters got hold of results, a call that xAI did with investors saying it's burned this much money in the first 9 months. It's a lot of money, and it's probably not going to hit its revenue expectations for the last year. So I think that's a sign that xAI, like many companies, is spending a lot on artificial intelligence-related technologies, while not necessarily, getting the revenue, the profitability as yet from those technologies. xAI also owns X, the social media network, and as we know, advertisers have been sort of slowly dripping away from X, so the revenue's not necessarily coming in there either. So like lots of AI companies, we're seeing a lot of hardware, software expenditure on that technology, but not necessarily as yet the profits and revenue coming in.
Well, he is going to spend until he has AI that can power this Optimus eventually. Shona, thank you so much. Shona Ghosh there for us in London. Coming up, the jobs report and a possible SCOTUS ruling. It's your day ahead next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg. Now a look at what's ahead today. Payrolls coming in at 8:30 a.m. Eastern, just more than 2.5 hours from now. And then, of course, we do get Michigan sentiment. That's at 10 a.m. Then the Supreme Court also convening for a public non-argument session at 10 a.m., which could mean a ruling on President Trump's tariffs. Plus, we get Fed speak from Kashkari, Bostic, and Barkin throughout the day. Micro movers wise, Loan Depot, mortgage stocks rallying after Trump's purchase demands on Fannie Freddie, as you can see, up 20% now. Revolution Medicines, the FT is reporting Merck is in talks to buy the cancer drug maker. And Intel up 2.4%. President Trump praised CEO Lip Bhutan after a meeting yesterday at the White House. This is your macro picture before the jobs report. Futures pointed higher, the dollar stronger, and the 10-year yield up nearly 2 basis points. Nothing to worry about, it seems. That's it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
The U.S. economy really was massively resilient.
The labor market is a different labor market.
The unemployment rate is moving higher gradually.
It's frozen, but not melting down.
We're going to start to see some signs of the labor market stabilizing over the next several months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists looking for a firm jobs number and a drop in unemployment as the White House is bracing for a possible ruling on Liberation Day tariffs. President Trump is pushing Fannie and Freddie to buy $200 billion in mortgage bonds. The president looking to boost the economy.
All I can say is tracking this news cycle is kind of like watching pinball at a very close speed, trying to make sure that you understand where the ball is going at any given time. There are some broader themes here. The focus on the economy, you are right to point out. With respect to the mortgage market, how much is housing affordability going to remain one of the drumbeats heading into the midterm elections, and how much is this going to end up focusing on Fannie and Freddie? Yes, and buying bonds. $200 billion has to be put in the scope of $9 trillion for the mortgage bond market. At the same time, the Federal Reserve has to come back into focus.
The president's had quite a week, hasn't he?
He has.
You know, it's a long list of things he's done this week. I've picked out three. So the president went after executive pay of certain firms, went after capital returns, he's gone after investigative housing, and he's added more to the list going into the weekend.
I feel like we actually are this week, the first full week of January of 2026, drinking from a fire hose. The list is unending when it comes to what the president is trying to do right now and really use the weight of the White House for it. We talked about housing. We talked about the fact that he's also going to be meeting with oil executives today. He says that they're going to be investing $100 billion. 14 of them are lining up. Not quite sure that's the readout I'm getting from the shale patch right now, but the president says these individuals want to invest. On top of that, he's talking about a lot of foreign policy. He's going to be meeting with the Venezuelan opposition leader next week. And at the same time, as Iran has protests overnight and is absolutely blackout right now in that country, he is saying that he's putting them on warning if they go after any of these protesters.
We need to sharpen our focus a little bit, so let's focus on one thing. 8:30 Eastern Time, the jobs report, and the attention firmly on one data point, one metric, the unemployment rate. Unemployment set to come back in just a little bit later this morning from 4.6 to 4.5. Does that shut the door on the rate cut debate at month end?
To me, this is the ultimate question, right? How much does this end up being a bear case for the bond market and seeing a sell-off that does continue because people have been expecting any kind of further weakening in the labor market to allow the Fed to move as soon as January 28th. If you do get the unemployment rate ticking down, how much dissent do you have from the Federal Reserve? Do you see those fissures in that much more focus? And how much more is President Trump incentivized to announce a different Fed chair in short order? It could come on the front end or the back end of Davos, as according to Treasury Secretary Scott Bessent.
What he said in the last 24 hours, but I feel like we've been waiting for weeks and been told the same thing is coming. It's coming, and apparently it's coming now in the next 2 weeks.
You could say weeks, you could say months. We've been talking about this for a long time.
It was supposed to be in the fall.
Yes, exactly.
I was told in April it was supposed to be in the fall. Also interesting, though, we do have officially what the names are, and I thought Rick Reeder had sat down for his interview yet. He's the only one that's pending an interview. Maybe that's why they're unsure whether it comes before or after Davos.
If you're just joining us, welcome to the program. Lots to get through this morning. Bond yields a little bit higher, up by 2 basis points at the top end or close to the top end of the recent range, very close to 420. 418, call it 419 this morning. Coming up this hour, we'll catch up with Stephen Major of Tradition, with stocks holding steady. The former senior White House trade advisor Kellyanne Shaw on Supreme Court opinions, and Claudia Sam of New Century Advisors looking ahead to the latest jobs data. We begin this hour with stocks on hold and the dollar at a 1-month high ahead of the payrolls report later this morning. Stephen Major of Tradition writing economic data relative to expectations has softened. There is fundamental support to keep lowering the Fed funds rate to a level below where the forwards are currently implying. Stephen joins us now for more. Stephen, welcome to the programme, sir. It's always good to see you, and congratulations on the new seat. Let's talk about the data this morning. How relevant is the jobs report at 8:30 with your opinion in mind?
Well, I think your setup said it all, John. There's other stuff going on, isn't there? So there's the fiscal news perhaps coming through later, and everything else that's happening globally. So it's just one data point, and I think you've covered it pretty well. Regarding this one, what really matters is the evidence on about what all this does for wages, because I think there's been a clear trend these last few months where the path of wage growth is consistent with something nearer to the 2% inflation target. So what you want today is something that doesn't disrupt that, really. Of course, it's complicated because you've got the labour pool being affected by migration factors, and you've got some softening of demand for labour that's been evident in previous months. You know, overall, it's all very well looking at the unemployment rate and the payrolls number, but it's the bigger picture, how this fits into the bigger picture that matters.
Well, Steve, the bigger picture, I think, for many is that we've seen a notable increase in slack, captured by several data points. You point to wages, you can point to the unemployment rate rising more recently as well. There is a take on Wall Street at the moment, Steve, and I wonder if you'd push back, that if things stabilise, particularly with things like the unemployment rate, it closes the door on interest rate cuts. Do you see things differently for the year ahead?
I don't know about that, John, because so first of all, given all the things that have been happening, and you listed the surprises, the shocks that we've been experiencing these last few weeks, given all of that, would you have believed that the 10-year Treasury would have been in a range of 6 basis points, I'm told by my colleagues downstairs, 6 basis points this year, six whole basis points? In fact, it's been in a tight range for quite some time now, even before the start of this year. So, you know, I think that the bond market's holding in pretty well. If you got a strong data release today, something that indicated the economy was much stronger than we expected, I think the cynics out there might question whether the data was correct, in the same way that you could say if it was exceedingly soft. I think it's the broader trend that matters. You've got to smooth these numbers out over a period of time. I think the trend and the path is quite clear towards lower rates, and therefore there's an asymmetric bias in place. If you get a shock that says that the rates aren't going down, I don't think it's going to bother the market that much, but we're skewed towards opening the floor for rates and seeing how far they can go down. I don't see that many people talking about rate hikes anymore. It's only a few months ago that was being mentioned on shows like this.
It seems like, Stephen, this is no longer a data-dependent market, as you just laid out. A data point dependent market, just because people have so many questions around the data. This is potentially a market, though, that could be roiled by events, and you mentioned some of them, including the IEEPA ruling that could come as soon as today. What kind of effect would it have on the bond market if the tariffs passed under the IEEPA rule in the United States were to be repealed, pushed back in any kind of way?
Okay, that kind of scenario is going to blow us out of that 6 basis point range. And the question is whether we would close still outside of the range, or whether we'd still be outside of the range next week. Ultimately, we're looking at whether there is a path, I'm using that word path again, towards a fiscal number that is manageable. I mean, is it possible that the deficit is within a reasonable level? Now, of course, there could be some disruption to the president's plans, and it's clear there's a risk here. But you know, ultimately, the bond market's going to clear. The auctions are going to get done. There's a question about at what price and at what cost. Because the bond market's going to get done, I can assure you of that. The question is whether it's going to come at the expense of some other asset class.
Yeah.
That's really the issue, right?
Stephen, you keep talking about the 6 basis point gap, and you're right. I mean, even when you look at the move, the forward implied volatility index in 10-year Treasury yields, it's incredibly low. You aren't necessarily seeing much expectation for disruption. How do you know that this is resiliency and not complacency?
Yeah, look, that's a fair point too. Maybe we're all just so beaten up and already exhausted with the shocks. I'll give you an anecdote on this. You're putting together my most recent piece. Like many analysts, you tend to go through it at the weekend. So I'm sitting there on a Sunday looking at the text. I'm thinking, oh no, with the news flow last weekend over Venezuela, I was thinking everything I've written here is irrelevant. But I came in on Monday morning and I was still able to publish it. Now, how is that possible? How could I have been so wrong with my judgment on the Sunday compared to the Monday? And I think that most of us are experiencing the same thing. Anyone who's involved in this market at the moment. So it could be that we're complacent, but it could also be with the fact that we're resigning ourselves to the reality that rates aren't going up and they're probably going to go down. So, as I said, I think the data is consistent with dates going down towards where the forwards imply and maybe less. And with some of the changes coming at the Fed, I would suggest that the balance is tipping to rates going even lower.
Well, a lot has already happened. A lot has already happened from Sunday, Stephen. The president this week has really taken a focus on the housing market. Even if the Fed continues to cut interest rates, is that going to help the U.S. housing market? Will that help mortgage rates?
Look, so what proportion is that money of the total stock of mortgages? It's not that high, is it? I haven't run all the numbers yet, but we're talking about a few $100 billion in a multi-trillion market. So I don't know how much of a game changer it is. You know, ultimately, getting the 10-year rate down towards 3 rather than 4 would be one of the best things that could be done for the housing market right now. So I guess the intervention that's just happened is going to help, but I haven't run the numbers yet. I don't know whether it's going to have a major impact.
I actually mean if the Fed cuts interest rates, is that really going to meaningfully help the mortgage market?
Thank you. I thought you were referring to the intervention for Freddie and Fannie. Now, if the short rate goes down another 100 basis points, the whole term structure is going to come down. The 10-year on current form isn't falling as much, but it doesn't mean to say it won't still go down. So it depends what the delta is between the rate cuts and the 10-year. I would suggest if policy rates go towards 2% or even less, then you could imagine that 10s are going to have a 3 handle and probably low 3s.
Final question, Steve. What's more likely at year end? That the 10-year yield is at 3% or West Ham is playing Premier League football?
That's an impossible one to answer. Look, John, based on the fact that West Ham are 7 points adrift, it's pretty obvious where the probabilities lie there. But you think things can change. It looks like a close call between the two, and I'm not gonna give you an answer if you don't mind.
That was unfair of me, Steve. I apologise. It's good to see you, buddy. As always, Stephen Major of Tradition on this bond market and a sprinkle of Premier League football and why he believes the fundamentals are set up. They will support further interest rate cuts.
Yeah, and right now the idea of whoever is going to replace the current Fed chair will only make it more so since that will only bias rates lower.
To Steve's point, what a tight range we've seen so far, year to date.
I keep going back to this question, is it resiliency or complacency? And ultimately, I think everyone's saying resiliency because of all of these factors. Let's see if there is anything that can break through the noise, and it is noise. My goodness, how many different topics we're talking about.
So far year to date, on a closing basis of 5 to 6 basis point range on a 10-year maturity. The yields are higher this morning by 2 basis points. Let's call it 4.19. With an update on stories worldwide this morning, let's check in with Yahira with your Bloomberg brief. Hey, Yahira.
Hi, John. President Donald Trump is preparing to meet with 20 oil executives as he looks for help to rebuild Venezuela's energy sector. The attendees include fracking pioneer Harold Hamm and representatives from Chevron, ExxonMobil, and ConocoPhillips, and more. The administration's plans to rebuild Venezuela's oil sector could cost up to $100 billion over the next decade. Meanwhile, President Trump directing Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to bring down housing costs. The president claiming the move will drive down mortgage rates, some estimates suggesting a drop of at least 1/4 point. And this just in, Meta announcing new deals to power the company's AI data centers. The agreements could total more than 6 gigawatts of nuclear power, enough for about 5 million homes. Meta says it will purchase electricity from Vistra, Oklo and TerraPower. The deals would make the tech giant one of the largest buyers of nuclear power among the hyperscalers. That's your Bloomberg Brief. John?
Amazing. Those deals keep coming. They keep piling up. Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the push for affordable housing.
What we want is affordability to get better. What the Fannie and Freddie buying will do is compress the spread between mortgages and Treasury bills.
Up next, we'll catch up with Jeanette Lowe of Strategas, live from New York City. Good morning.
is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The rally hitting pause going into Friday, just below Tuesday's all-time highs. This morning, just about unchanged. Treading water going into the payrolls number at 8:30 Eastern Time. Futures this morning up by 0.06%. On the Nasdaq up by 0.14. In the bond market, 2s, 10s, and 30s shaping up as follows. We talked about that very tight range on a 10-year maturity. Yields at the top end of that range for the year, 418.50, higher by 2 basis points. We're in a very different position to start the year compared to where we were last year. 3-month moving average for payrolls coming into 2025, north of 200K. 3-month moving average coming into 2026, just north of 20K. That's a very different jobs picture for this country.
Yeah, and a very different expectation about what kind of break-even rate we need to really keep America employed, right? So that's why the question is really going to be the unemployment rate, because ultimately we don't have a sense, based on the demographic shift, of what a good or bad labor market number really is.
We're hoping that number stabilizes a little bit later this morning, and the overwhelming expectation from Wall Street, at least, is that you'll see some of that at 8:30 Eastern Time. And the Savannah's this morning looking elsewhere and the push for affordable housing.
What we want is affordability to get better. What the Fannie and Freddie buying will do is compress the spread between mortgages and Treasury bills. So Fed is currently selling mortgages. Fannie and Freddie can offset that buying.
So here's the latest this morning. President Trump pushing Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds as part of the White House's efforts to lower housing costs. Joining us now from Washington is Lauren Dezensky. Lauren Dezensky, welcome to the program. Just set us up here. What has the president announced and what is he trying to achieve?
Certainly, President Donald Trump announced that Fannie and Freddie are going to buy $200 billion worth of mortgage bonds. This is really all a part of Trump's affordability push. The goal here is to push down mortgage rates And coupled with his announcement that he's going to block institutional investors from buying single-family homes, this is all in his effort to make buying a home in America more affordable. The part that's interesting to me is that he's planning to talk about this at Davos later this month, which in terms of a domestic political message might not be the right venue for it, but for Trump, he's going to talk about whatever he wants. And affordability really is the word on his lips this year so far.
Yeah, Lauren, I'm with you, and I think everyone is. The backdrop is a curious one, but we'll get into that another time, maybe next week. The Treasury Secretary's words, I think, are interesting for me. When he points out something we know, but he says it explicitly, that the Fed is currently selling mortgages, Fannie and Freddie can offset that buying. Is that something we need to keep in mind as they're still going through the interview process to replace Chairman Powell?
Certainly. I think that perhaps this is a reflection of the direction of rates that Trump may or may not see from his future Fed chair candidate. Obviously, this process is a little opaque, and I would not want to weigh in too far over my pay scale here. But, you know, he's the Fed and the cost of everything. Like, this is something that clearly is so important for voters, as they have said at least this past year. And coming into the midterms, Trump has made very clear that he's thinking about his political survival. He told Republicans this week that if Republicans don't keep control of Congress, he might get impeached. And so this talk about rates and affordability and everything comes into that as well.
Hey, Lauren, it's good to see you. We'll catch you with you later this morning. Lauren Tazensky there of Bloomberg down in Washington. There's one good reason I can think of for doing this speech in Davos, Switzerland. When you look at the agenda for the next 2 weeks, there's a panel that week, I think it's on the Wednesday, and it's about jobless growth. And I think jobless growth at this point is so important for the people that are attending that get-together. Because if you think about the themes they're focused on for years, for decades in Davos, Switzerland, we haven't focused enough on just improving people's lives. It's been focused on these massive big-picture issues, the nice-to-haves, and I'm sure we'll get into that in 2 weeks' time. And there is a warning, I think, for a lot of these executives who are chasing these big goals and generating lots of profits, is that a lot of people at the moment are being left behind. And if you don't do something about it, you're going to find out at the ballot box.
You raise a great point. The idea that that President Trump having a firebrand speech with populist overtones at the key capitalist event of the world, frankly, sends a pretty big message back home that he's willing to stand up to power. So you can expect that there might be a real overtone of that, or, you know, really that will be the subtext, pretext, and the text of his speech.
Corporate profits up here,
exactly.
Payrolls growth down there, and everything in between. There's a lot of tension for society. Joining us now to discuss is Jeanette Lowe of Strategas. Jeanette, wow, what a week. What a start to the year. We've seen so many announcements coming out of the White House and from the president. What are you focused on, and what are you telling clients?
Yeah, this has been quite a start to the new year, and there's definitely a lot of changes afoot. I think one of the things that's really important here is that, obviously, as you guys mentioned in the last segment, the president is much more focused on affordability. This is a midterm election year. He is looking ahead to the potential loss of Republican control in the House of Representatives. So there's going to be a big focus on things like housing and electricity prices and things of that nature with regards to affordability. The other big story is obviously that in 2025, we had a focus on more austerity. It was about tariffs. It was about a delay of what was the tax benefits in the One Big Beautiful Bill. So you had those changes made, but you didn't change people's withholding. So that will now come out in 2026. The Fed held off on cutting rates until the end of last year. You know, have the Fed cutting rates. And we also see that we're going to get some financial deregulation going ahead into this current year. So you have a lot of austerity that was going on in 2025. As we move into 2026, we see a lot more austerity with the business and the consumer tax cuts that are coming with this financial deregulation and with more of the monetary policy easing coming from the Fed. So we have a lot of pieces there. And then, of course, obviously, we're also focused on what's coming potentially out of the Supreme Court this morning and what that could have as an impact on Trump's tariff regime and whether or not that will be disrupted.
Jeanette, when it comes to the Supreme Court today, what's your base case that they will strike down IEPA?
Yeah, I mean, that is our base case right now, is that they will strike down the IEEPA tariffs. So this will not impact the Section 232 tariffs, which are things for steel and aluminum and autos. So all of those will remain in place. But the tariffs that were imposed as reciprocal tariffs and the fentanyl tariffs, those do look like they are in danger here. The big question will be, could there be nuances that comes out of the Supreme Court? Could they keep the fentanyl tariffs in place because that represents more of a national emergency than the reciprocal tariffs? Will they decide whether or not there needs to be refunds for companies? Obviously, we've seen a slew of companies file in the Court of International Trade to make sure that they can still get a refund. That will be important. And whether or not, how long that process might take. And it may not be that we even know right away, because it could be that they remanded back to a lower court. So there could be a lot of tariff uncertainty. But one of the things that we're telling our clients is that however the court decides, the court is not deciding how Trump can impose tariffs. It's deciding how Trump can impose tariffs, not whether he can do so. So even if they rule against the administration, there is a backup plan that the White House has. And essentially, in a couple of months, it may take 5 or 6 months to get there. But we think that the administration is going to put back into place essentially all the tariffs that we have currently, even if there is an adverse decision for the administration.
Jeanette, one story we didn't talk about, but 17 House Republicans joined Democrats yesterday extending the Obamacare enhanced subsidies. Do you think that's actually going to pass in the Senate?
Yeah, I mean, there obviously has been some movement towards getting a bipartisan deal on this. There was the expectation that the discharge petition, that was the move that got this bill to pass in the House yesterday, that was going to come to pass. Obviously, we don't expect the Senate to do a clean extension. We do expect them, if they're going to move this forward, to come up with some sort of compromise, maybe a 2-year with some reforms included. There definitely does seem to be some momentum. You've had some mixed signals. Obviously, Trump said earlier this week that he was willing to, provide some flexibility with regard to abortion and the Hyde Amendment. So there does seem that there's this option to get something done, and we'll have to kind of see once this now moves into the Senate. Obviously, again, with affordability being a big issue, a lot of the Republican House members that voted for this extension were members who are vulnerable in the midterm elections. And so I do think there is going to be some concerted effort to at least try to find a solution as we move forward.
Hey, Jeanette, thank you. Good to catch up. Jeanette Lowe there, Strategas. It is January 9th. We've got a whole year of this still to come.
Ooh, sounds like a lot of fun. It seems like everyone's got a lot of energy for this one.
Coming up on the program, the former senior White House trade advisor Kellyanne Shaw, with Supreme Court tariff opinions pending. Plus, Danny has your morning movers from New York City. You're watching Bloomberg TV.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Equities just about positive by 0.1% on the S&P 500. The payrolls report 2 hours away as we count you down to the opening bell. Set up for a decent week of gains actually on the S&P so far, just below those all-time highs we printed on Tuesday. On the Nasdaq 100, positive by 0.2. The Russell doing nicely recently as well, up by 0.2% for the small caps. Turn to the bond market. At the very front end of the yield curve, 2-year bond yield higher for a fourth consecutive session, just bleeding a little bit higher, but still anchored around 350, 350.51, yield higher by 2 basis points. The 10-year at 418.50. I'll ask a question that Bramo would really like. What's more important this morning? Jobs at 8:30, or potentially Supreme Court opinions a little bit later?
Supreme Court opinion a little bit later, because right now people have such skepticism and exhaustion around data roulette that essentially whatever comes out will get nullified in terms of skepticism and overlays if it is a significant number that does surprise markets in any capacity. I could be wrong, of course. However, the fact that IEPA could potentially be overturned by the Supreme Court, we don't know whether those rulings will come out, to me indicates a potential black swan moment for people who've been counting on this revenue to really support the balance sheet of the United States.
I agree. We could see a tremendous amount of chaos for this administration as they try to line up the next legal avenues to make sure that they keep tariffs in place, but also for companies. Remember, if you did not file a litigation with the trade court, there is potential that even if IEPA strikes this down, you will not get your refund. So a lot of companies actually might be taken aback and on the back foot when it comes to this, and they are not prepared for potentially to reap the money they are owed.
So when we're thinking about where surprises come from, you've got to think about what we're priced for. Aren't we priced for that outcome at the moment? Wouldn't the bigger surprise be that actually it was held up and we keep these tariffs?
You know, I'm laughing to myself because I think Stephen Major nailed it when he said you could totally change your narrative based on the headlines and you come in and maybe it's 2 basis points away from it. In other words, you're not going to necessarily see big moves because everything seems to cancel itself out and nothing seems to matter.
And also, we're just going to start putting in, instead of IEPA, 338, 122s, 232s, there will be tariffs.
I think Steve just wants to break out this very tight range on a 10-year bond yield, and we're right in it at the moment, 418.50 at the top end of that very tight range to start the year. Let's turn to foreign exchange. Quite a week for the dollar, the best week since November, and another week of gains, another week of dollar strength. Euro dollar down to about 116 so far this morning. That currency pair negative by around 0.1%. As we count you down to the cash open, let's get you some morning movers. Lots to talk about. Danny has more. Hey, Danny.
John, you took my words. It's already shaping up to be a very busy morning. Announced less than 30 minutes ago, Meta signing a multi-gigawatt power nuclear deal. This will mean that Meta becomes the biggest buyer of nuclear energy among all of its hyperscaler peers. It's going to be buying that energy from already existing nuclear companies like Vistra, like Oklo. So you can see those shares both surging in the pre-market trade, nearly 20% for Oklo. Elsewhere this morning, we're also seeing all the mortgage-related companies. Those are also surging in the pre-market after Trump yesterday saying that he's directing Fannie and Freddie to buy $200 billion worth of mortgage-backed bonds. You're also seeing those rally this morning, too, all part of an affordability push. The president saying that it would help lower costs for mortgages. So Rocket, Loan Deposit, Open Door Technologies, all moving. In the case of Loan Deposit, Depot up 18.4%. Finally, some some more Trump-related movers this morning. The president putting out on Truth Social that Intel, that he had a meeting with Luc Bouton and it went well. They're making good progress. Again, the administration has been committed to taking a 10% stake in Intel. Right now, it's about 5.5%, but anyway, Intel up 2.7% in the pre-market, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. Sometimes you have to take pause and just reflect. How many of those individual stocks are moving on presidential announcements?
It's really quite unbelievable. I mean, if you think about the oil majors, if you think about the defense contractors and what's been going on there, if you think about the mortgage builders, the mortgage providers, what's going on there, and then if you take a look at a couple of random tech companies that might come into play, I mean, how do you get involved in this as an investor? It just really raises a lot of questions.
Intel closed down yesterday because as soon as the president put out that truth, I checked the stock. And then in the aftermarket trading, it was up 2%. And there is skepticism, and you see this a lot on financial Twitter. Are there people that are privy and aware to this information and then using it to their advantage?
Yeah, it's not good. Let's put it that way. We'll have more on that a little bit later. On our radar this morning, the Supreme Court issuing its first opinions of the year today, including a potential landmark ruling on President Trump's Liberation Day tariffs. Justices will decide if the White House bypassed Congress to unconstitutionally tax trade. Elsewhere, nearly 20 oil executives gathering at the White House today. Industry leaders meeting with President Trump to discuss Venezuela's oil production. The lineup including representatives from Chevron, Exxon, and ConocoPhillips. And finally, President Trump also issuing a warning to Iran amid nationwide protests. Trump saying the U.S. will, quote, hit them very hard if authorities begin killing protesters. Iran is restricting internet access with thousands taking to the streets across the country.
So a big question here about whether President Trump is involved in this with some social media. This is what actually Ayatollah Khomeini is arguing. On the flip side, it does seem like there is this groundswell of support of people protesting and trying to overturn this regime. Look, when we were talking with Amos Hochstein, he said this was the next hotspot. And actually, some of the success in Venezuela would just engender the U.S. and Israel to go in and potentially bomb Iran. So a lot of people are saying, is this the pretext for them to do that?
The one thing I will say on the military side, the defense posture in the Middle East hasn't changed just yet. And that would have to change if we were going to go back into Iran, if the president was going to take some sort of military action. I think what is important to notice, though, we do see Iranian authorities frequently try to do this. They shut down the internet. They shut down your ability to make phone calls and phone access when they are trying to quell protesters. So no surprise there that we're seeing this sort of blackout in Iran. We should note this is, though, the biggest since 2022 against the Ayatollah. He's 86 years old. But in 2022, it didn't work. So the big question is, will it work this time?
That is the hotspot on the map at the moment. Let's turn back to trade. The Supreme Court is set to hand down opinions on the legality of President Trump's tariff agenda. A ruling could come as soon as today, forcing the White House to recalibrate its approach to tariffs while refunding potentially over $100 billion. Joining us now to discuss is the former senior White House trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the program. Now, of course, we don't know if we'll actually get this decision later on this morning, but overall, what are you expecting?
Well, good morning. And certainly everyone is waiting with bated breath to see if the 1 in 19 case that comes out today is in fact going to be the IEEPA tariff case. But what would expect to happen is for everyone to take a moment and digest what the court has to say, both on the private sector side as well as the government side. And in fact, I wouldn't necessarily expect the president to announce his plan B right away. I think the administration would need time to figure out what options are available to the president, tee it up to him for a decision, and we could see something come, say, next week.
So when it comes to what options he does have available, I talk about these sections all the time. Can you actually walk us through what is going to be the most likely scenario you could see coming out of USTR?
Sure. And the administration has talked a lot about this, the fact that tariffs are going to be part of the president's strategy. They're not walking away from their tariff program. And some of the other options that they have legally include the numbers that you listed earlier, Anne-Marie. So Section 122, which is really about balance of payments, that gives the president the authority to impose tariffs of up to 15% for a period of 5 months, at which point Congress needs to vote to keep those tariffs in place. You also have Section 338 of the Trade Act of 1930. It's a statute that's never been used and hasn't really been threatened since the 1940s. That would arguably give the president the authority to impose tariffs of up to 50%, so he could effectively replicate the tariffs he has on every country overnight and reimpose those under 338. But again, it hasn't been used in its almost 100-year history, so not a lot of precedent there. He could also use these sectoral tariffs, so these Section 232 tariffs like the steel, aluminum, pharmaceuticals, semiconductor tariffs, to try to do a product-by-product approach. I think that's pretty messy. And then he could also do individual country investigations under what's called Section 301. And those are the tariffs that we currently have in place on China. We've got an open investigation on Brazil. He doesn't have a limit if he uses 301 in terms of tariff levels, but the challenge is those investigations are going to take at least 5 or 6 months to complete. So if he does that on a country-by-country basis, which is what a lot of people in Washington suspect he might do, the real question is what tariffs are going to take place in the meantime? What's the bridging authority? So we could see kind of a mix and match of some of these measures.
Do you expect countries to be lining up once again if the Supreme Court strikes down IEEPA and they're preparing for the president to have to go back to the negotiating table?
Well, look, I think that part of this will be a country-by-country decision, and I suspect that most of our trading partners will honor the commitments in the deals that they've made, or they will just, be okay with the status quo in the intervening months, because there is that threat. Almost assuredly, the president's going to reimpose these tariffs under some authority or another. And so there might be some deviations. You could see Europe, for example, that still hasn't passed that implementing law to reduce its own tariffs as part of the deal that it agreed to way back in July. I've heard on the European side that they may not move forward if the president, in fact, loses his IEEPA case, which would put us back in a trade war with Europe. So we could see some examples like that, but I think for the most part, countries are going to hold to their commitments.
Kellyanne, the reason why it's always great to hear from you is because you've been on both sides of this, right? You've been in the White House, you've done these negotiations, and you currently talk to a lot of corporate clients and others to give them advice about what to expect. I suspect that there is a degree of exhaustion after a year of uncertainty, and that a lot of people are not looking forward to another cocktail of tariffs. If this is the year where people are supposed to rebuild their supply chains, how does a new overview of tariffs potentially complicate that?
Yeah, I think that everyone is exhausted. I think I heard from about 3 clients in total over the break, just by sheer exhaustion. So, what does it look like this year? Last year was about breaking the global trading system, changing the way we trade with every country on Earth for every product on Earth. I think this year, from the administration's perspective, it's about rebuilding and recalibrating, meaning if you took a global sledgehammer to the trading system, you patched it back together in 2025, 2026 is about fine-tuning it, making adjustments where necessary, but not these big tariff swings. Now, of course, the Supreme Court case is the elephant in the room, and that could disrupt the plans for 2026, depending on which way the court comes out. But I do think, particularly towards the second half of this year, we're going to see more recalibrations as opposed to these giant swings. I think the tariffs are pretty much where the president wants them right now, and it's more about adjustment.
Kellyanne, we've written stories at Bloomberg about how many companies have lined up and put the paperwork in to try to get some of the refunds should the IEEPA tariffs be overturned. How many that you talk to have plans to start that groundwork just to get a foot in the door to start claiming their refunds that haven't yet done so?
Well, what I'd say is we are seeing cases filed every day, but the CIT basically told the private sector, don't file any more cases. We are not going to hear any cases until the Supreme Court decision comes out, and that's on the basis of the government saying you don't need to get in line. This had to do with this concept of liquidation, that after 314 days, those entries that you go through that formal entry process, they liquidate after that period of time. So this litigation, the Costco litigation and others, was really about trying to suspend that period of time. The government said that's not necessary, and on that basis, the court said don't file anymore. So I do think we're going to have to wait and see what the Supreme Court says to ultimately see where things go on refunds and what companies need to do. So there's a lot of unknowns right now. I do think when we get a decision, there will be a ton of questions. What's the administration's plan B? What does the tariff landscape look like? And what's the process for refunds? And those are all big black boxes at the moment.
Kellyanne, stay close. We might be speaking again on Monday. It's good to see you. Kellyanne Shaw there, the former senior White House trade advisor. You talked about everyone being exhausted. I thought we meant to come into a new year energized for the new year. We've all read the same outlooks. And when it comes to the equity outlooks, Tariffs have barely got a mention, barely a footnote in so many equity outlooks for 26.
To the degree that they have any mention at all, this is the year where you have more certainty. This is the year where all of the tariff noise that we heard in 2025 was supposed to end. Do we get a decision starting maybe at 10 a.m. Eastern today that overturns that particular projection?
And the president says he's going to talk about housing at Davos. If the Supreme Court strikes down IEEPA, he's going to be talking a lot more than housing at Davos. He's going to be talking about reestablishing global trade and the fact that he is going to have to go back into his toolbox to renegotiate some of these deals with these countries.
Have to rewrite that speech several more times, right?
Can you find me one person who's not exhausted coming into 2026?
I can't find
it. If you can, please write in.
I think the president. He was doing a Sean Hannity show interview last night, and then 4:19 a.m. he was on Truth Social.
He's a beast. He just keeps going. Futures positive by about 0.1%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira with more. Hey, Yahira.
Hi, John. Russia says it struck western Ukraine using an intermediate-range ballistic missile known as Orishnik. Ukraine's foreign minister describing the attack near the NATO border as a grave threat to European security. Russia also launched hundreds of drones targeting Kyiv and the surrounding area. Meanwhile, here, a group of House Republicans breaking with party leaders to join Democrats in extending expired Obamacare subsidies. The House passing the 3-year extension 230 to 196. The measure facing steep Republican opposition in the Senate, though defectors hope it pressures lawmakers toward a bipartisan compromise. And TSMC's fourth quarter revenue topping estimates, reinforcing hopes for sustained global AI spending this year. The beat by NVIDIA's go-to chip maker was boosted by demand for its data center chips. TSMC will report full quarterly earnings and a forecast on capital spending next week. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in the next hour, in about 30 minutes' time. Up next, running risk with policy.
We're still materially above neutral in my mind. Every month we come in and the unemployment rate ticks up a little bit and the inflation, the inflation data sort of seem to be doing a little bit better. We're running unnecessary risks on the labor market by being so restrictive.
That conversation up next with Claudia Sam of New Century Advisors, live from New York City this morning. Good morning.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. This is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, tap the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The jobs number, 1 hour and 42 minutes away. The estimate in our survey, about 70K. Big range if you look through the estimates that we collect here at Bloomberg. The high's 155, the low's 23,000. And if you go through some of the commentary, the focus really is on things like the unemployment rate, as opposed to the headline payrolls number. And if the unemployment rate comes in, there's just an expectation this Fed isn't going to do much at month end.
Yeah, there's a feeling that really January 28th hinges on that unemployment rate getting down to either 4.5% or 4.4%. That means no, they're not going to cut rates. If it is 4.6%, 4.7%, that's almost a green light saying, please go. Regardless, it's going to be a split decision.
Here are the scores this morning. Futures positive by about 0.1%. Around session highs, we're up by 0.25 on the Nasdaq. On the Russell, up by 0.18. In the bond market, lots of conversations about this very, very tight trading range on a 10-year maturity. Yields are higher by 2 basis points. The 10-year 4.1850 this morning. And the surveillance this morning, running risk with policy.
We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is in a weakening path and inflation is an underlying inflation is already running close to our target. Every month we come in and the unemployment rate ticks up a little bit, and the inflation, the inflation data sort of seem to be doing a little bit better. We're running unnecessary risks on the labor market by being so restricted.
So here's the latest this morning. Investors counting down to the payrolls report out in less than 2 hours' time. The median estimate in our survey coming in at 70,000. The unemployment rate expected to fall back to 4.5%. Claudia Sam of New Century Advisors writing, the main problem in the labour market is the lack of hiring. That may not spiral into a recession, but it can put upward pressure on the unemployment rate. Claudia joins us now for more. Claudia, a warm welcome back to the programme. It's good to see you. Let's talk about what we could see at 8:30 Eastern Time and how important that unemployment rate is.
Right. No, any question about do we have a problem in the labor market, the answer is going to start with what's happening with the unemployment rate. And it's really much bigger than does it tick back down to 4.5%? Does it hold? Does it it really is looking at the broader trend. We've seen the unemployment rate moving up since the middle of the year. We've seen the unemployment rate moving up over the past 2.5 years at a very gradual pace, right? So there really is an issue. And again, we don't need to see the layoffs to have the unemployment rate come up. It's just this very low level of hiring, and we have not gotten any indication that that's even stabilized at this point. That's really the center of the problem right now.
Claudia, you say that it's clear that we have an issue. What is that issue, especially given the fact that this isn't a monolithic jobs market? You're seeing some pockets of real pain and other pockets of real strength and wage growth.
Right. Well, I would say that we do the slowdown in hiring is quite broad based. We see that in the slowdown in job creation. We have a much more concentrated, healthcare, education. These are ones that not cyclical parts of the labor market really are pulling a lot of the weight in terms of job creation at this point. So, but you are correct that the pain in the labor market has started to accumulate. If you have low hiring, that's going to hit groups of workers like young adults coming out into the labor market. That's where we're seeing some really, large increases in unemployment and, not participating. And that, so the pain is not equally distributed. But I would say that we're seeing a broad swath of lower hiring. So the concern is out there broadly. I don't think we can point to one policy or one event that's really holding back the labor market. It's something much broader at this point.
It seems like everyone's focused on the jobs report that we get in about an hour and a half. It seems like people are talking less about the CPI report next Tuesday. It seems like employment is the primary mandate right now for the Fed, and it's sort of eked out inflation as the main concern. Do you agree with that? Do you think that's appropriate?
Well, the labor market was definitely what pulled the Fed into action late in the year, right? And they cut 75 basis points on the funds rate on risk to the labor market. So the Fed has stepped in. They may not have done enough, right? We may see more cuts because of the labor market going forward into this year, but really they've put some effort into easing, the pressure on the labor market. I think what's going to be really interesting early this year, we have some additional fiscal support coming online. It wasn't, the one big beautiful bill wasn't looking forward to weakness in the labor market, but we do have tax relief coming for households and importantly for businesses. That may be, the support that gets the hiring rate going, but it does give me some pause that right now the problem is not a lack of economic activity and demand. Like we see plenty of consumer spending and business investment. Businesses aren't hiring. So what is it that solves that problem? That's, I think, going to be a really big question. And the Fed's going to want to see how this plays out before they do a lot more, I think, at this point.
If consumers are worried about their jobs and they get these refund checks, does that mean potentially they're going to hold on to them? Or do you think they're going to go out there and spend?
So it'll probably be a mixed bag. At this point, we definitely can see in the consumer surveys, and the New York Fed had another one out yesterday, where people are they really understand it's tough to get a job. Like if you lose a job, the chances you assess of getting a job, they're down at very low levels. People still don't see very high, chances of losing their job. Right, which I think, people are seeing the low hire, low fire environment. So I don't think that you've got this level of anxiety right now. We are set up if the layoffs were to pick up, if you even had some isolated sectors doing more firing, that could change the picture and really have the anxiety pick up. But otherwise, a lot of experience shows us if you put money in the hands of people who've needed a little extra cash, they're going to spend it. Right. So I think there will be some push to demand. But is that what is holding back hiring? That's what's not as clear because this just doesn't look like the typical business cycle.
You wrote in your Substack, the Fed may let bygones be bygones in their inflation targeting approach to monetary policy. Has the Fed just absolutely accepted that 3 is now the new 2?
Well, so when I met with bygones is the Fed they really the 2% target is what they have. They don't look at a price level, right? And try to get the price level back on track by wanting inflation below 2%, right? So they're looking at not the price level over time, but at this, the inflation rate. I still think the Fed is very committed to having the 2% target, but it's clear with, them cutting, with inflation still elevated, they are not willing to risk a recession over squeezing out that last bit of inflation. And especially when I think there are some good stories about why there's still some temporary lift to inflation. So it's not that they've given up on their inflation target, but the Fed is paying close attention to what's happening at the labor market at the same time. But it does slow down the Fed's reaction to anything we see in the labor market because they have a dual mandate. So I think that's where just seeing what happens to the unemployment rate today is not enough to tell you what the Fed is going to do at the end of January, because the Fed is paying a lot of attention to that CPI report next week, too.
We're trying to make it simple. Don't spoil it, Claudia. It's good to see you. Claudia Sun, New Century Advisors. Claudia, thank you. Thank you very much. Mike Gapin of Morgan Stanley making it simple. 4.6% would keep the Fed on track to cut this month.
That seems to be what a lot of people are expecting, that if you do get that creeping up confirmed, then January 28th is a go.
Claudia's right. It's a complex moment.
Of course.
It's more than just about one data point, that's for sure. Up next, we'll catch up with Priya Misra of JP Morgan, Bloomberg's Lauren Tazensky, Kate Moore of Citi Wealth, Dan Stuyvesant of Goldman Sachs. The second hour of Bloomberg surveillance on this Payrolls Friday. Up next.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Coming into 2026, there's obviously been a lot of optimism.
I like the momentum of the market.
There's no bears when it comes to strategists.
I have a tough time seeing meaningful broadening in the U.S. equity market.
I think the long-term trend is quite positive.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 shaping up as follows as we head towards a decent week of gains, just off all-time highs printed earlier this week. Futures positive by 1/10% on the S&P, on the Nasdaq up by 0.2. What a 24 hours ahead of us. What a week ahead as well. We've got payrolls later on this morning, 8:30 Eastern time. Then we've got Supreme Court opinions, potentially on the President's Liberation Day tariffs later on this morning as well. Sneak peek of next week, CPI on Tuesday, bank earnings beginning as well.
Yeah, the idea of the read from the corporate world in terms of what kind of health you see in the underlying economy is going to be really key. Look, we're talking about all the headline roulette that's coming out of Washington, D.C. The proof is going to be in the pudding when it comes to the economy and whether the economy is chugging along and whether companies foresee that continuing throughout the year. If so, these gains will continue and a lot of people will be able to look through the noise with a bit more conviction.
And it comes at a time when this White House is really laser focused on the midterm elections and this message of affordability. Yesterday, you have the president saying he's going to tell his representatives, the FHFA, to buy more when it comes to mortgage-backed loans and bonds. They have already been doing this. And I was told by a source last night that they're going to take this up to the cap. At the same time, today he's meeting with oil executives. He has a price target in sight for oil, and that's $50 a barrel. And he thinks he can bring these executives on board to go into Venezuela to help that. In the Sean Hannity interview, this is how the president thinks. He thinks oil is the basis for everything when it comes to affordability and inflation. He was saying it's part of the reason why, you put donuts on a truck You need oil to get those donuts from point A to point B. This is how he's thinking ahead of November.
Can you imagine the communication war rooms that the big oil executives have been in over the past few days? The pressure on them going into this meeting, do you think these guys want to allocate big numbers right now with crude where it is?
Well, not only with crude where it is, but also the potential of losing their investment should there be a change of leadership in the U.S. or elsewhere. We already saw that back 2 decades ago. Exxon's still trying to recoup billions of dollars. ConocoPhillips, same thing. So at what point are we looking at companies that already have been burned, but who also, talking about those war rooms, don't want to get on the wrong side of this president?
That's accurate. But at the same time, those companies, because they knew that they were shut out from Venezuela, decided to go allocate capital elsewhere. Exxon all over Guyana now, which right now looks like one of the best bets because in a geopolitical standpoint, it's much safer. U.S. shale bosses, according to the Financial Times, basically say that this administration is putting American output, which is close to 14 million barrels a day, on the chopping block. Quote, we're talking about this administration screwing us over again. That is the feeling going into this White House meeting.
It's a delicate time for that sector. Let's put it that way. That meeting taking place at 2:30 Eastern Time later on this afternoon. Coming up this hour, Prime Minister of JP Morgan as Wall Street awaits a fresh labour print. Kate Moore of Citi Wealth remaining bullish through the noise, and Dan Stroyven of Goldman Sachs as President Trump meets with big oil executives. We begin this hour with stocks inching higher ahead of key jobs data. Prime Minister of JP Morgan looking for a cleaner read, writing the Bloomberg consensus of 70,000 and a decline in unemployment should mean the Goldilocks market pricing of low hiring, low firing can continue. Priya joins us now for more. Priya, good morning.
Morning.
Can the rate cuts continue?
Yes, I mean, if we get the Bloomberg consensus, does the Fed cut in January? Probably not, unless we get some big, much lower inflation. But look at the market pricing. Market's not pricing for the Fed to likely cut in Jan. The market has, though, 2 cuts priced in for the rest of the year. I think that pricing can remain because when we're looking at the totality of data, we're still not seeing hiring. Nothing in the fiscal stimulus in the One Big Beautiful Bill is essentially saying that companies are going to start to increase hiring. Look at this last week. Look at all the headlines that we're getting. Policy uncertainty is still high. So if hiring stays low and inflation comes down, in our view, you look at inflation across the board, whether it's shelter inflation, whether it's wage inflation, it's all heading lower. As inflation comes down, I think the Fed is going to say, okay, we can start to cut, a little bit more. I think the bar to cut rates is higher, but we do think that the Fed later this year is going to cut 1 or 2 more times. So I think that market pricing of that terminal rate stays. That's essentially what that 10-year is essentially banking on.
What is going to wake up this bond market, this very snoozy, range-bound, sleepy Treasury market?
I think it's great. I mean, interest rate vol has been extremely low. I think the president is focused on the 10-year. He's told us that before. I think what can wake the volatility up would be essentially if we get additional fiscal stimulus, not one big beautiful bill. If you get tariff dividends, now I'm not even sure post-AIPA that the tariff revenues will be as high. We do think that if AIPA is struck down, that the president's going to, essentially come up with AIPA-like tariffs under a different name. But, if there's additional fiscal stimulus, yes, then rates can rise. All those deficit hawks can come out. I think that's an opportunity. If you do get interest rates moving higher, any bear steepening in the curve, we would look to fade. I think the 10-year, in our base case, 3.75 to 4.25, I think that's the range we should expect for this year. If hiring continues to be low and firing starts to pick up, I think that's the tail risk here. I think the asymmetry in the bond market is rates are going to go lower. I think that's what nobody's talking about. Remember last year, all the narratives around the deficit, sell America, that's all way behind us. I think now we have to think about the 10-year being in a narrow range, housing affordability is a focus, and the risk is that if actually we start to see the layoffs, then rates can go lower.
So you think that the best part of the yield curve right now is the 10-year?
We do like the 5 to 10-year part of the rate curve. I think the front end starts to get really tricky. You have to have a clear view on inflation in the next month, on the unemployment rate. But when you're looking at the 5-year, 10-year, I think that's the part, number one, that impacts the housing market. That's the one that the president's focused on. That's the one that prices in the Fed to slowly get closer to that 3% terminal rate. So I think that's the one that we have more conviction in, that is likely to stay in a low range. And, I think that's what you own, particularly if you own risk assets. If you own stocks, if you own credit, your biggest risk here is that the economy actually struggles. struggles because there's so much complacency about this Goldilocks continuing.
That makes sense to me. The hedge against some kind of falling off a cliff of the economy or significant deterioration. What makes less sense to me is that the Fed has room to cut rates because inflation is lower, and that will naturally bring the entire yield curve lower because of the wealth effect, because this is going to boost asset prices that much more, which will only encourage people to spend that much more, and you're going to see inflation in some of these higher end items, which is really what's been driving some of this. I mean, how do you square that?
So I think the K-shaped economy, the K-shaped market continues. So to your point, spending and, if people are getting a refund check, they're going to spend it. Asset price inflation can stay high. But what we're looking at, what the Fed cares about, their dual mandate is PCE and full employment. That PCE number on inflation can continue to head lower because that's a function of shelter inflation on how, housing, beyond housing, ex-housing service inflation. Look at those numbers. They're slowly heading lower. The tariff effect is going to go away from inflation by the middle of this year. So I think, if you think about the rate cuts from the Fed, it was inflation in 2024. It was the unemployment rate in 2025. This year, you've got two paths through which the Fed can cut. There's that inflation part. As inflation heads lower, not asset price inflation, but PCE, which the Fed cares about, as we get close to 2, maybe it's 2.5, the Fed will feel more confident. The hawks that have been very vocal that inflation's above target, they're going to then step back and say, okay, we can, maybe neutral is closer to 3 and not 3.5. I think that's the debate we're going to have all year. What's neutral?
Priya, could we get your reaction to the president last night saying he's giving special attention to the housing market and telling his representatives to buy $200 billion of mortgage-backed securities and home loans?
I think it's great. Now, we don't need just one thing for housing. Housing is an extremely complicated issue. If they need to fix housing, they need to fix the demand side, the supply side. I was a little nervous if all we were going to get was on the supply front. Now, I think the president with this latest bit, and this does not need Congress. Now, the $200 billion is interesting. That's the amount that the agencies can buy relative to the cap. That cap can also move higher. I think once they do the 200, the cap can be moved by the FHFA. And
I'm glad you brought that up because the cap is $450 billion. They've already been accumulating billions. Right. So this puts us pretty much right at that cap. But I spoke to a source last night and said, well, the Treasury and FHFA tried to lift the cap, and they said no. So if this just ends at the $450 billion, does it really do much for the housing market?
Well, I think if it's 450, it's 200 billion of net demand. And if you think about the mortgage market, the marginal buyer for mortgages is really asset managers. It used to be the GSEs pre-2008. Some of us were around back then. I used to cover the agencies. Then it was the Fed. Then it was US banks. And now, if you look at it, the banks are saying after SVB, well, we're not going to touch this. I think that's why the announcement is interesting. You bring a new marginal buyer in, other investors that might have stayed away will say, okay, the government's behind this. The agencies have the ability to buy. I think we can step in. But I will say, you ask about whether that's important. Mortgage spreads can compress. But ultimately, if you look at the mortgage rate, it's the 10-year. That's the much bigger component. We have to keep the 10-year within that range. If the president's focused on housing affordability, so keep the 10-year 4%, 350 to 4, keep it there, and then get those mortgage spreads. We're talking 10 basis points. So, I get excited. I'm a bond person. Every basis point is very important. But I mean, to get 100, you're not getting 100 basis points in mortgage rates because of this, but it does help. Keep vol low and then get some mortgage spread tightening through
This might just be the appetizer, not the main course. Is the Federal Reserve going to come along for the ride, along new leadership?
Well, so no, I don't think the Fed's going to do QE. I mean, there's talk around the Fed doing QE. No, the Fed is going to
the Fed's working against this effort at the moment, aren't they?
Well, they are letting the portfolio run off. But I think what the Fed did in December, which was to say that let's make sure the plumbing works, I think that's important. They didn't let the repo market freeze up. So yes, they're letting mortgages run off. The GSEs will easily offset that. I think on the Fed, what we really want is a credible, independent Fed. And I think, we don't know who the next Fed chair is going to be, but if you look at what the Fed's done over the last few months, they have reasserted that they're independent. This is a committee. The chair is important, but it's one vote. I think the Fed is doing I don't know if it was if that was an intended reason for them to be as vocal, but they're telling us that they care about their dual mandate irrespective of the chair. I think they're doing their part. They're keeping that term premium lower. Inflation risk premium, look at what's priced into the break-even market. It's low. The market's not concerned about Fed independence, rightly so.
It's pretty anchored at the moment, that's for sure. Priya's going to stick with us, Priya Misra of JP Morgan. As a journalist, you've got to ask the question. I mean, you've got to wonder what the interviews have been like and what questions have been asked of potential Fed candidates.
Literally, people have told us on this show that they should do QE and that they will do QE in order to get mortgage rates lower. So it's not only a legitimate question, I think it's clearly in the ether. It's not priced into the market, which I think is telling that currently market participants do not believe that to be the base case.
I know the first question the president asks, because the only one he really cares about is, will you cut interest rates? But I can imagine the follow-up is, what else could you do to help the housing market? And he's saying that this is a housing emergency, and this is really, for him, such a focal point going into November. I imagine it is somewhat part of the conversation.
One to watch later this year, maybe. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. U.S. officials are discussing sending checks to Greenlanders as part of a bid to convince them to secede from Denmark. Reuters reporting they're considering payments ranging from $10,000 to $100,000 per resident. In an interview with the New York Times published today, Trump said ownership of Greenland is psychologically important to him. Meanwhile, Paramount Skydance reaffirming its hostile bid to buy Warner Brothers Discovery, arguing it, quote, represents the best path forward for Warner Brothers shareholders and provides a more certain path to completion. Paramount saying the Netflix offer is inferior because it plans to give investors stock in a cable TV spinoff that it deems worthless. And Oregon officials calling for calm after federal agents shot and wounded 2 people in Portland yesterday. The Department of Homeland Security said a Border Patrol agent fired a defensive shot at a vehicle after the driver weaponized it and drove off. The shooting came a day after an ICE officer shot and killed a woman in Minneapolis. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. And more from Yahara later this hour. Up next on the program, bracing for a ruling.
We're getting rich because of tariffs, by the way. Without tariffs, this country would be in such trouble, as they were for many years. It's such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
We might get that ruling later this morning. Up next, Bloomberg's Lauren Dezensky, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Live from New York City, welcome to the program. The jobs number a little more than an hour away. That comes at 8:30 Eastern Time. Just got some data from Bank of America, the Consumer Checkpoint Report. One of my favorites. This is for the month of December. The K-shaped economy and consumer pattern persists, but the divide isn't widening. We'll put some numbers on that. Higher income households saw a 2.4% year-over-year increase in card spending. Lower income households saw just 0.4% year-over-year growth, and that 2 percentage point gap between the two groups pretty stable over the past 6 months.
Yeah, the other interesting aspect from this report, and I agree with you, it's really interesting, highlights that even though people were being choiceful or picky or being very aware of the prices, they were buying more goods. It wasn't just an increase in spending because of the ticket items. It was the volume of goods that actually was being purchased. Also, people were actually proactive. They bought it before November, and that's also something that it really accelerated and then fell off heading into the holidays. So congratulations for getting ahead of the game, everybody.
Some front loading.
Yes, exactly.
Some real front loading. Thanks to Bank of America for that. We'll get earnings from them later on this month, next week, I believe. Equity futures at the moment then, positive by 1/10% on the S&P, up by 0.2 on the NASDAQ. Very tight trading ranges in the bond market we can talk about in just a moment. 2s, 10s and 30s. 2s anchored around 350. 10s at the top end of a recent range, 419 on a 10-year bond yield this morning, higher by 2 basis points. Under surveillance this morning, bracing for a ruling.
We're getting rich because of tariffs, by the way. I hope everyone understands that. They hate to report. We're going to have over $650 billion poured into our country or coming in shortly because of tariffs. Without tariffs, this country would be in such trouble, as they were for many years. We have a big decision. Hopefully we're going to get the right decision. It's such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
So here's the latest this morning. The future of President Trump's trade agenda hanging in the balance as we await a possible Supreme Court decision on the legality of his global tariffs later on this morning. Bloomberg's Lauren Dzenski joins us now for more. Lauren, just frame for us how important these rulings are, potentially later on this morning.
Certainly. I think the clip package does a great job of summarizing that nearly every day Donald Trump is giving a defense of his tariffs. And to a certain extent, he's speaking to an audience of one, which is the Supreme Court justices who really will make or break the fate of this agenda. They're specifically ruling on the Liberation Day tariffs, which were announced on April 2nd in that big Rose Garden event, and markets subsequently tanked because markets were unhappy with the announcement and kind of the gravity of the announcement. At least what we know so far, number one, leading to some of this uncertainty is that we don't actually know that the decision is going to come down today. It will happen on a Supreme Court decision day, or opinion day rather. But that might be today, that might come later next week, so we don't know. But we also know that the previous lower court ruling did say that these tariffs were illegal. Again, these are the specific Liberation Day tariffs. There's other tools in the toolkit, but if we're reading some tea leaves, it may not necessarily be good for Trump for these very specific tariffs.
That last piece of what you just said, Lauren, I think is so important. And forgive me for jumping in. There are other tools, and that's what I want to lean on here. I'll give you the flavor of things on Wall Street, Lauren. The way people are thinking about it up here is that ultimately, whatever happens, if it happens later on this morning, the president's got other means and ways of achieving the same thing. Is that the sense of things in Washington?
Certainly. It's not necessarily as sweeping, but there are other tools. There's a Section 301, there's a Section 232. These are the sectoral tariffs that have to be more targeted and more specific, as opposed to these country-specific tariffs of just, China will get X amount tariff or Canada will get X amount tariff. These ones have to, go after specific sectors. But Trump does have other tools and other opportunities to impose tariffs.
Lauren, thanks for being here. We appreciate it. Lauren Dzenski there of Bloomberg down in Washington, D.C. Still with us around the table, Priya Misra of J.P. Morgan. A question we've lent on repeatedly over the past week or so is what is relevant and what isn't relevant to this market? Because that announcement in early April turned out to be an absolute nothing burger by the time we got to the end of the year. What should you be focused on in 2026?
I think you have to be focused on fundamentals at the end of the day. And the fundamentals last year, for example, the reason why we faded all of that Sell America, the fundamentals are that the economy is holding up, the consumer is resilient, but hiring is slow. And inflation, a key component, inflation is heading lower. And that's why from a rate standpoint, that's what's kept interest rate volatility that low. I think if you get IEPA being reversed, the immediate reaction might be, oh, that's 100 billion of revenues that the government was getting in that have to be potentially refunded. We have to look at how those refunds happen. Maybe that can be slow walk and you have to go through the courts. But if that's the immediate reaction, that's a supply shock that the market might react on. I would fade that. I would say, let's look at fundamentals. Is hiring picking up? That's what we're watching. Is there additional fiscal stimulus that's going to come in and help demand? If that doesn't happen, you look at fundamentals, you look at policy risks, there are a lot of cross currents. I mean, we've got structural positives, AI investment, strong private sector balance sheets, but then there's a cyclical issue as well of this low hiring. So, as we think about markets, I think the risk on sentiment is why credit spreads are tight. That's why we like owning credit, but we like those treasury rates as well as sort of to try and think about a balanced portfolio.
If I were going to put all that together, I would say maybe fiscal deficits don't matter anymore. Is that correct?
I don't want to sound complacent. There is a long-term problem where, we have a long-term issue, I agree, on the deficit. Entitlement is really the only way to solve that. We saw DOGE didn't really solve that last year. But I think that's the question of supply, demand, needs at a price. Term premium, or how much additional yield we get from extending out the curve, that has gone up. So investors are earning more because we have an unsustainable fiscal trajectory. But look at the rest of the world. And I think, you look at the rest of the world that's actually doing more fiscal easing, where central banks might be hiking. The U.S. is still the place where you've got the growth and the central bank that's still potentially going to cut.
So you don't really attribute the outperformance of U.S. Treasuries over the past 12 months to this idea that you were going to get revenues from tariffs. Is that correct? That's sort of a fiction that was tied to some of the performance?
I mean, it helped, but it was a tiny amount. It's 100 billion. I think it helped calm some of the Sell America deficit. The U.S. is going to default. It calmed some of that down, that we do have tools to get revenues in. But, I took a lot of what happened last year to be this narrative around everyone's going to sell the U.S. to, no, let's look at the fundamentals. The U.S. is still growing really well, and we've still got the deepest, most liquid capital markets. And as that narrative went away, and then we looked at the fundamentals, we realized, okay, the unemployment rate is slowly moving higher, the Fed can cut rates, and inflation is, heading closer to their target. I think it helped, but I don't think just taking that away, especially if to our earlier discussion, it's going to be put right back on under a different name. I don't think it should be a big deal beyond maybe today at 10 a.m. if it is.
Priya, what about a $1.5 trillion defense budget?
So I do wonder, does Congress
what does that do the deficit?
So I think that is not priced in. I don't think the additional 500 billion is priced in, because the view is Congress going to allow that? In an election year, I agree that was a headline. If you get another 500 billion, if you get tariff dividends, the same tariffs are being used to pay for OBBA and tariff dividends and
a lot
defense.
of double dipping.
Then I think the bond market's going to say, okay, we need to get paid a little bit more to lend money to the U.S. But I don't think the expectation is that he's going to get that 500 billion quickly this year.
Priya, it's good to see you. Fantastic framing, as always. Priya Misra there of JP Morgan on this bond market and how $500 to $600 billion of extra defense spending is not priced in right now.
It's not priced into the bond market. It is being priced into some of the defense stocks, which is sort of interesting. There's sort of different messages being felt, whether you're on the equity side or whether you're on the fixed income side.
But to Priya's point, it has to go through Congress when it comes to $500 billion. Maybe they're not going to get all of it, but when you think about things like the Golden Dome, the Golden Fleet, they might be able to get some Republicans and Democrats to sign up for that.
It's a lot of spending down in Washington. There's more still to come. I'm sorry to disappoint you if you wanted some responsible budgets anytime soon.
Yeah,
I'm not sure it's happening.
I get the emails from the Committee for a Responsible Budget.
Yeah, it's just
and they're getting increasingly hysterical. Come on, guys, please care. I mean, other people say it's a big economy. We can absorb it.
It's not happening until the market forces it, and the market's certainly not forcing it, that's for sure. The jobs number 1 hour away. The estimate in our survey, 70K. In just a moment, we'll catch up with Citywell CIO, Kate Moore, with a look at her top risks for 2026. Plus, Danny has your morning movers. Nuclear stocks jumping with Meta signing new deals to power AI.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're 60 minutes away from the payrolls report, 2 hours away from the cash open. Into that, futures just about unchanged on the S&P 500. No drama this morning. All-time highs earlier on in the week, and we've hit pause on that rally over the past 2 sessions or so. Plenty of disruption coming out of the White House, though, and you see that at a single name level. We'll get to some of those stories in just a moment. On the Nasdaq, up by 0.15. On a small was the Russell, up by 0.2. In the bond market, what can we do to shake this bond market out of a very, very tight range? Yields higher by 2 basis points this morning. The 10-year 4.1850. Some of you looking for payrolls. Bramo is looking for something else.
Well, IEPA, and whether we do see some sort of overruling of the tariffs, so the Priya-Misra really just threw a whole lot of cold water on that thesis, saying that essentially people are going to look past it and it isn't that significant. I will say that longer term, based on what we've heard this morning, if there is a rolling over of the U.S. economy, that will have the biggest effect on yields, and it is to the downside.
And everyone's just looking through this because the president has a number of other legal tools he can use in his toolbox. One of them, Section 338, though, he may run into. This is the one a lot of people are talking about, because it'll be 50%. You can use it pretty bluntly. You don't need an investigation like some of the others. But he might run into the same sort of issues. There might be more legal suits following this when it comes to all of them, but I think the bottom line is everyone expects tariffs to continue under a Trump administration.
A big ruling potentially coming up a little bit later on this morning. As for the payrolls report, the SMNR survey, 70K. Big range, talked about it. The highs in the 150s, the low around 20-something. The unemployment rate is expected to come down to 4.5%. That's key for a lot of economists on Wall Street who believe that if this Federal Reserve is going to reduce interest rates, you need something like 4.6, 4.7 to keep that door open for month end. As we count you down to the cash open, let's get you some single names. So we're seeing that disruption. Danny has more.
Yeah,
hey, Danny.
We certainly are. And starting with news that we got just over an hour ago, that Meta will be buying a multi-gigawatt deal of nuclear power, making it the biggest investor among the hyperscalers in nuclear energy. It means it's going to be buying energy from the likes of Vistra, of Oculus. You can see the huge gain pre-market there. John, you mentioned the movers in stocks based on what this president has said, and these mortgage companies are exemplary of that. President Trump saying that $200 billion of mortgage-backed bonds would be bought by Fannie and Freddie. He's directing them to do so. So you're seeing those rally this morning. And again, these companies that offer those types of services, Rocket, Loan Depot, Open Door Technologies rallying as much as 5.6%. Finally, GM falling in this morning's trade nearly 2%. Late yesterday saying that it was upping its charge tied to EVs by $6 billion, making the total hit by its winding down of certain EV and battery operations at $7.6 billion. So that is hurting them this morning, John.
Danny, thank you. This is building up to be quite a costly mistake, chasing that EV story for some of these big players.
Well, and accelerated by the removal of the incentive that the government used to provide to buy some of these. And it really kind of raises the question, who is the best positioned, who is less committed to that, will outperform this year.
Another charge. Danny, thanks for the latest. Appreciate it. On our radar this morning, the Supreme Court could rule today on the legality of President Trump's sweeping global tariffs. A ruling against the levies would undercut the president's signature economic policy and could force the U.S. to issue refunds to importers. Elsewhere, President Trump directing Fannie Mae and Freddie Freddie Mac to purchase $200 billion in mortgage bonds to bring down housing costs. The president claiming the move will drive down mortgage rates, some estimates suggesting a drop of at least 1/4 of a point. And finally, on deal watch, Rio Tinto renewing talks to buy Glencore, potentially creating the world's biggest mining company with a combined market value of more than $200 billion. The company's discussing a possible combination of some or all of their businesses, including an all-share takeover.
So this is a redux, because we've seen this before a couple of times, and now we have some new leadership and we have some new incentives. The issue in the past has always been price. All of a sudden, we have copper at record highs. You have a real incentive for them to go head-to-head with the world's biggest mining company, BHP, and a real question about what will be included in that. You sort of alluded to that. Will it just be copper, or will it also be the things like coal?
I've been covering this story for more than a decade, because Ivan Glassenberg started this conversation more than 10 years ago.
Exactly.
Okay? The key part of this time around is what they would do with coal, and I think a big thanks goes out to our team over in London for this reporting that Rio is said to be open to owning coal if it buys Glencore, and that might move the dial to close this deal.
Exactly. This is what will move the dial, because forever Glencore has had these very large, interesting copper assets. Right now, copper is super hot, going to 13K. People see this power idea, this demand for copper, the need for the industrial base and for data centers and the likes. But it's always been, what do we do with those coal assets? But now if Rio's saying we will take them on board, this is really a green light for this deal to go through.
Speak to the move you're seeing on Glencore this morning. Their stock is higher by more than 10%. Watch this space. Let's turn back to markets. Citywell CIO Kate Moore noting positivity, writing consensus is largely bullish as we start this year, and we're watching several events that could shake confidence in current positions. Kate joins us now for more. Kate, good morning.
Good morning.
Happy New Year. Good to see you. Let's talk about those several events you're watching. What's top of the pile?
Well, I'll mention one of the events, which of course is relevant to what you've been talking about this morning, which is around the IEEPA tariffs, leading to volatility in the market, because many of the consensus views are that we're just going to kind of grind higher over the course of the next couple months. So we're going to watch that, pardon me, very closely. The second thing we're watching is actually the strength of the economic data. So many people are expecting that we're going to have the Fed cutting multiple times. We see, in fact, 3, 4 cuts in many people's scenarios over the course of 2026. We actually think the economy is in a very good place, and we're likely to see the Fed pause for a moment as it waits to see what the impact of the monetary policy cuts over the course of the back half of 2025 due to the economy. So I think people may be a little bit disappointed there. And then finally, a big risk that we have on our radar, and it's something we talked about, as you know, so much at the end of the fourth quarter, was what happens if some of the data center and some of the AI CapEx disappoints or gets delayed? You know, and how do we see people hedge those exposures or pull back from some of their concentrated positions in the space? So those are our risks on our radar, but I gotta tell you, even with those, we're risk on right now as we start 2026. We have a constructive view on equities. I think that's a fairly consensus view. But unlike some folks that are calling for a rotation or for increasing their exposure to ex-US, I think the U.S. is, without question, the best fundamental house on the block.
I want to get back into that in just a second. A lot of people have come on the show and said it's been a bit like whack-a-mole. It's been an exhausting week. We've had a lot of different headlines. It's been hard to know what to focus on. And Stephen Major was saying, on a Sunday, you can think you have to totally overhaul everything. Yeah. And then on a Monday, your outlook remains exactly the same. Totally. So what are you picking up on in terms of some of these headlines that are having specific company moves and potentially could have significant ramifications?
Yeah, I mean, we're kind of fading the specific company moves and trying to look through the noise a little bit. It's pretty hard for anyone to kind of trade against these headlines. And the other thing I would say is around geopolitical risk, right? We've learned throughout many, many years, decades, that the markets price in very quickly a significant reaction to a geopolitical headline and then fade it, right? And so we're trying to figure out now what are the longer-term fundamental implications of, you know, some of these changes or some of the invasions the U.S. has been engaging in. And we don't think we're going to see a significant change in the energy environment in the very near term, for example. So we're not actually making any changes to our exposure there.
The one risk scenario is something that a number of analysts have come on today, which is that the economy does start to roll over, that you do start to get some significant weakness as represented in the labor market, which is a reason why today's 8:30 a.m. report could actually be really significant. How are you thinking about this in terms of what's being priced and what isn't in that kind of scenario?
Well, I think people are worried about the economy rolling over because the duration of this expansion has been exceptionally long. And if you think about it, we've talked about this together before. For quarters and quarters, we've talked about the K-shaped consumer, that there are pockets of weakness in terms of consumption, and yet we continue to chug on, and companies continue to spend. And actually, we think there are a number of significant tailwinds, both on the fiscal and, as I was mentioning, the monetary tailwind after the cuts in the second half of last year. But I think people are worried because there is a strong consensus that economic growth, at least in the first part of this year, is going to be strong. And I think they're worried about positioning in the risk on, and also we have a lot of consensus around, short duration positions in the fixed income book, and everyone's kind of trying to test the waters. Our view, though, as we talk to companies and as we hear from them as they've reported or come to conferences and things, is that the labor market actually is in okay shape. We're not going to get mass layoffs. In fact, even if we're slowing down the pace of hiring, it's because we're further into this economic cycle and not necessarily because there's a reason to, significantly change outlooks.
That's one of the key catalysts for today, but the other is going to be the Supreme Court.
Yeah.
You say that even though people are talking about these other avenues to reintroduce tariffs, there's a number of questions that need to be answered. After this comes out, what would you want to hear directly from the administration to get some sort of clarity on the direction of travel?
Well, we know that tariffs are going to be a tool this administration is going to use for the duration of the term, right? And we've heard a lot of guests talk about that. I certainly agree with that. The question I have is, how long does it take to implement some more of these specific tariffs, and how durable they'll be past this administration? Do we have a one-time shift in terms of our expectations around margins and business models? Does this engender kind of a change and a shift in supply chains? Do we see kind of like relationships changing between suppliers, consumers, and the places that they do business? And that's really hard to model at this point. So it's a risk. I would expect, though, if the IEEPA tariffs were overturned, we'd see a near-term pop in the market. People would have a bit of relief, frankly, for all those companies that face margin pressure over the course of 2025. But I will say, I never want to bet against the resiliency of U.S. large caps who managed through that margin pressure and managed to, cut costs in other places or spread out those costs across multiple SKUs in order to maintain their fundamentals.
Another thing you like, gold.
I do like gold.
As a diversifier.
Yeah.
And my question for you is, a diversifier to what? Equities, bonds, FX, to what?
Well, I can be a bit cheeky, Jonathan, and say I've used the gold as a diversifier in multiple parts of the portfolio. In fact, when we first were starting to add it in 2025, we were really kind of saying, we don't like the role that duration is playing as a hedge or a diversifier in a multi-asset portfolio. And so that was the initial impetus. Of course, all of the fundamental reasons as well, central bank buying, other asset allocators diversifying, questions around the dollar. And actually, as we got through the year and continued to add to our gold position, we were also saying we think there are strong reasons for people to have a significant exposure there when other assets don't have as much potential upside. So we're using it against risk, we're using it against duration, and we're liking it for the fundamental reasons. We think we're going to see more and more people make this a considerable part of their portfolio over the next couple of years.
Can you just flesh out your point on duration? What you didn't like about it, and has that changed at all coming into this year?
One of the challenges is, over a couple of the risk-off periods, duration and equities, didn't actually have the same relationship that they had historically. We were watching this and saying, there's plenty of reason, frankly, for the long end to stay higher than it had been, right? We're looking at deficits staying high and going higher, not just in the U.S., but in the rest of the world. That lack of fiscal discipline kind of weighing on bond market participants. And then I would also say that we have this constructive view, which we had throughout the course of 2025, on growth and expecting inflation to be a little bit spicier than the market was pricing in. So those were two of the kind of the main reasons, the lack of the kind of the hedging properties, as well as the fact that we thought that rates should stay higher for economic fundamentals.
Something else that you've said, which is not consensus, is that you don't think that going outside of the U.S. is a good diversifier, that you think that the U.S. really is going to be the main engine of growth, which is counterintuitive given your call on gold. Can you explain that?
Well, you start the year, and you guys see this all the time. People put out their outlooks, and they say, we're going to diversify against some of the strongest markets. In this case, rotate. But in this case, rotate for rotation's sake is something I just drives me nuts. But in this case, the U.S. underperformed in both local and U.S. dollar terms last year. We know this. And most of that underperformance was frankly because other markets had multiple expansion and they benefited from the weaker dollar. The earnings side drove the majority of the returns in 2025 for the U.S. And so my joke here is that if you want to rotate just for rotation's sake, you should be adding more to high-quality U.S. equities where the majority of the market is being driven by earnings, not by multiple expansion in currency. And you have a lot of people saying, well, Europe is cheaper. We know that European multiples are less than the U.S., but for real reasons. It's around profitability, it's around margins, it's around free cash flow, and that is not a strong enough reason in itself to own, say, Europe. We also are not as excited as some folks are around kind of the fiscal spend outside of defense in Europe, for example. And that is actually fairly well priced, as you guys well know, in the market. So we want to stick with earnings, which we think are going to be the driver of equity markets over the course of this year. And we see the best earnings prospects in the U.S. and actually in emerging Asia.
Kate, it's good to see you. A clinic as always. Thanks for dropping by. Kate Moore of Citi Wealth, very much America First. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Colombia's President Gustavo Petro says there is, quote, a real threat of U.S. military action against his country. The remarks suggesting relations have not significantly improved, even after a phone call between Trump and Petro this week, after which Trump said they would meet at the White House in the near future. Meanwhile, President Trump saying overnight he canceled a second wave of attacks on Venezuela. That's because he says Venezuela is working well with the U.S. on rebuilding its oil and gas infrastructure and releasing what he says are large numbers of political prisoners. And Johnson & Johnson reaching a deal with the U.S. government to lower U.S. drug prices in exchange for tariff exemptions. As part of the deal, J&J will offer its drugs to the Medicaid program at comparable prices to other developed countries, plus participate in Trump RX, a website soon to be up and running where patients can purchase medicines directly. That's your Bloomberg Brief. John?
Yeah, thank you. Thanks for the update. Up next, reviving Venezuelan crude.
We're going to meet with the biggest oil people in the world. They're all coming here. The top 14 companies are coming here. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion.
Big meeting taking place later on this afternoon. We'll get the view of Dan Stroyven at Goldman Sachs in just a moment. Live from New York City, you're watching Bloomberg TV.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Ahmed in Bangkok. This is Bloomberg.
Live from New York City, welcome to the program. Equities just about session highs, up by around about 1/10%. The main event, at least for the economic data, is later this morning at 8:30 Eastern Time, with the payrolls report just around the corner. And the Savannahs this morning, reviving Venezuelan crude.
We're taking billions and billions of dollars worth of oil, and it'll be hundreds of billions of dollars. It'll be trillions of dollars. We'll be running the oil. We're going to meet with the, biggest oil people in the world. They're all coming here. The top 14 companies are coming here. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion.
So here's the latest this morning. President Donald Trump set to meet with top energy executives as the U.S. aims to rebuild Venezuela's energy industry. Dan Stroiven of Goldman Sachs writing, higher long-run Venezuela production further increases the downside risk to our oil price forecast. We estimate $4 of downside to our 2030 base case Brent price of $80. Dan joins us now for more. Dan, good morning. Good to see you.
Happy New Year. Thanks for having me.
Happy New Year to you too. How much pressure is on these executives going into this meeting later this afternoon?
Yeah, so we know that energy affordability and affordability more broadly is a key focus of the U.S. administration going into the midterms season. In terms of the outlook for Venezuelan production, I'd like to distinguish the short term, where there are likely some low-hanging barrels where you can increase production, perhaps in the tune of 400, 500 KBD in the first 1 to 2 years, with some easier fixes, doing some workovers on the fields, fixing some of the so-called upgraders to process the heavy oil, on the one hand, and then on the other hand, more substantial production increases. If you want to go back to production levels from the past, you need substantial investment, you need time, you need incentives, you need guarantees, and I think you need policy clarity on both sides, both in Venezuela and in the US. So I think the probability of a modest short-term increase has gone up over the last week, but I think the probability of a very large increase over the long term is still well below 50%.
There's a sense that right now any additional Venezuelan crude will cannibalize from U.S. oil production and frankly refining as well, both the U.S. as well as Canadian, and it will take away because the Canadian oil tends to be closer to the Venezuelan. How do you see that shifting right now, just based on what the current constraints are?
So, I think that's how the equities have priced it, with some of the Canadian oil producers and U.S. shale oil producers coming down this week, and share prices for the majors that are either producing in Venezuela or have produced in Venezuela, rising. But at the margin, I still think that U.S. shale production is largely pinned down by price, and we estimate, modest downside to prices from an increase in Venezuelan production. So, at the margin, it would be somewhat of a negative to shale production. But big picture, U.S. shale production continues to surprise to the upside. Despite lower prices, we held our Miami Energy Conference in Miami earlier this week, where Secretary Chris Wright also spoke. The message from the producers, the U.S. shale producers, was we keep getting better at producing more oil, even at lower prices with lower cost.
How's Mohammed bin Salman doing?
Saudi Arabia crude production, has been stable. Is expected to remain stable in the first quarter of this year, based on guidance from core OPEC producers. Our base case is that production in Saudi Arabia will remain stable this year, and that we don't expect production cuts. And so we continue to look for an oversupplied market of around 2 million barrels per day, which explains our base case that prices edge down. We have Brent averaging 56 this year, WTI 52. But with two-sided and why geopolitical risk. I think as the headlines of the last 24, 48, 36 hours all illustrate, whether it's Russia, Iran, or Venezuela.
Dan, you don't think the kingdom will step in if the president gets $50 a barrel oil, what he's targeting?
So we think that the production increases from Saudi Arabia have been strategic and have largely served internal purposes. I think Saudi Arabia is setting the stage for a tighter market down the road by discouraging shale supply, encouraging
but it's a $40
demand.
gap between what Riyadh and Washington want. They can't budget to $50 a barrel.
So I think, OPEC typically targets market stability. I think Saudi Arabia is sort of maximizing long-term profits from oil production as opposed to short-term prices. Prices in the short term tend to fluctuate. I think they have a longer-term objective.
Do you think the price could potentially also experience more volatility to the upside if the U.S. continuously goes after these shadow fleet tankers?
I do think so. I think a lot of the geopolitical risks are sort of short-term bullish because there's a rising probability of disruption. But with the U.S. administration's ultimate goal being energy supply abundance and lower prices, often these actions, and I think that's what Iran last summer and Venezuela last weekend illustrated, a lot of these actions are implemented, operations are implemented without disruptions, with the ultimate goal to raise production. So short-term bullish, medium-term more bearish.
Can you put some numbers on the shadow fleet? What kind of numbers are we talking about? What kind of supply does that account for?
Yeah, so oil on water is near an all-time high. Last year in 2025, global visible oil stocks rose by 1.3 million barrels per day. That's almost 500 million barrels. The vast majority, about 80% of those increases in global visible stocks were on water, very often being transported by the dark fleet. I think the bullish argument for the oil market is that inventories in the OECD pricing centers are still low. Positioning is very short. We saw some short covering overnight. But we put more weight on the fundamentals. The market is oversupplied. We think we need somewhat lower prices in 26 to rebalance the market from 27 onwards.
Dan, it's good to see you. Was looking forward to this conversation. Thank you, sir. Dan Stuyven there of Goldman Sachs. To your point, there's a big spread between what the kingdom would like to see and what a president would like to get.
It's massive, and this administration has a very good relationship with Saudi Arabia as well as with the United Arab Emirates, but obviously there is a big difference in the prices that they want to see. Their budget is $90 a barrel. The president, according to the Wall Street Journal, is looking at $50 a barrel. In order for him to get that, he would need to extract some more crude from Venezuela, and that's going to take a lot of convincing today with these 14 oil executives going to the White House.
These meetings in Vienna get a little bit more interesting now the US has got a seat on OPEC.
Yeah, I wonder if Secretary Wright or Secretary Burgum or the president. Well, remember when the prices went to negative? It was Trump who cut the deal with Mohammed bin Salman and Putin. So he's always sort of had a seat at the OPEC table.
Yeah. Will we have a seat? Will the United States have a seat when President Trump is no longer President Trump? That's my question.
It's a good question. Coming up on the program, Jason Draha of UBS, the U.S. Interior Secretary, Doug Burgum, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Next hour, it's the big one. Payrolls report just around the corner from New York City, the third hour of Bloomberg Surveillance. Up next.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheets.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The U.S. economy really was massively resilient.
The labor market is a different labor market.
The unemployment rate is moving higher gradually.
It's frozen, but not melting down.
We're going to start to see some signs of the labor market stabilizing over the next several months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 inching just a little bit higher on the S&P, likewise on the NASDAQ and the Russell. In the bond market, very, very tight trading ranges to start the year on a 10-year maturity, and for that matter, over the past few months, on a 10-year at the upper end of that range at 418.90 with yields higher by 2 basis points. In 29 minutes' time is the main event for the economic data. It's the payrolls report. The estimate in our survey is 70K, the previous number 64, and the hope for a lot of people, hopeful that unemployment comes down from 4.6% to 4.5.
And that's actually what some people would argue is priced into the bond market. The reason why you're seeing yields continuing to creep a little bit higher, and that the biggest risk scenario, at least for bond markets, is for yields to go substantially lower. Citigroup's Andrea Hollenhorst and team just put this out saying they expect 75,000 in terms of the headline number. Yay, right? But the unemployment rate rising to 4.7%. Boo. That means that right now you're going to get a Fed that's going to cut rates later this month. And that's the reason why they're looking at that deterioration being the bigger story.
Used to feel big on payrolls Friday, big data point, really important, consequential. Commercial break moments ago. Anne-Marie.
Don't sell me out.
I couldn't care less about the payrolls report today.
I could care. I just want to let everyone know I actually think it's going to really matter. The truth is, in fairness to Anne-Marie, it has been a very volatile start in terms of news headlines to the year, and I think everyone is pretty exhausted. Nonetheless, the economics will take front and center when it comes to certainly the markets, but also the politics.
So the biggest question for me today is, will the Supreme Court say that the president using IEPA, his fentanyl tariffs, reciprocal trade levies, do they exceed U.S. presidential power? For me, that is the biggest question today, the most important thing. Then you pile on top of that, Wall Street Journal headline just a few minutes ago, U.S. Coast Guard boarded a 5th oil tanker. You have 14 oil executives coming to the White House today with the president trying to cajole them back to Caracas. The president says he wants his representative, Bill Pulte, to buy $200 billion more mortgage-backed securities and home loans. There is a ton of economic news happening right now. So do I care about this job print that everyone's going to come out and say, throw cold water on it and say, well, you know, is it clean? What does it mean for the Fed? Let's wait for CPI, and then we can maybe discuss all that.
Tune in, 8:30 Eastern Time. The jobs report just around the corner. Coming up, Jason Draho of UBS Global Wealth Management with stocks trading near all-time highs. The U.S. Interior Secretary Doug Burgum joins us in just a moment, ahead of a meeting with energy executives at the White House, and Stephanie Roth of Wolf Research breaking down the December jobs report. We begin this hour with stocks stalling as investors await a fresh reading on the labour market, and Anne-Marie too. Jason Draho of UBS Global Wealth Management writing, the Fed is still more likely than not to cut rates again in March, and it will probably require more than 1 month of positive labour market surprises to further delay the cut. Jason joins us now for more. Jason, good morning.
Good morning.
You care, we care. Come on, let's make a think of it. All right, the jobs report at 8:30 Eastern Time. What is a positive report? What does that look like?
To me, like, well, a really positive surprise is probably something like 120, because the consensus is at 70. There's some higher numbers around 90. I think to really surprise the markets to the upside and get the Fed to think, maybe there's a stronger labor market than we think, probably in the 120 plus range.
120 and unemployment where? 4.5?
Well, so like, think of like the unrounded number was 4.56. So they can take 0.2 of a percent from go to 4.6 to 4.5. That's nothing. Think to go to 4.4 would be something that this is a more material change. So I think those numbers would get the Fed like, oh, there's something there. A lot of seasonality. We know we'll get kind of the annual revision, I think, in February. The numbers are probably, headline numbers are probably overstated. I think Powell even alluded to this in December, which is why I think you need a big number to really have the Fed think, maybe this is not just stabilization, but sort of start to re-acceleration in the labor market.
I can't let go, Anne-Marie, dismissing this report, because I actually do think it's going to be very important, because ultimately there's a lot of noise, there are a lot of headlines, but the real signal is going to be in the economy. And we haven't gotten a clean read. I mean, how important is this amid the noise of all of the headlines to you as a compass of what comes ahead?
Ultimately, given what we've talked about in terms of all these various factors, when there's so much noise, I always go back to, like, what are the economic fundamentals? Like, what's the growth outlook? What's the inflation outlook? And is it going to be better or worse? And do these developments actually change that in some way? So if we get economic data like the labor market data that says we've gone from softening and weakening of labor market last year to stabilization and potential reacceleration, that kind of feeds into these where the markets were already kind of pricing kind of this growth run a hot narrative. If we don't get that, I think that starts to challenge it much more so than anything else that we could hear this week.
So what I'm hearing from you, and please correct me if I'm wrong, is that if we get a weaker than expected employment print, that could pose a bigger risk-off move to stocks in terms of asymmetry in how markets are positioned. Is that correct?
I mean, again, it gets into what is the surprise. So if it's 50,000, 40,000, I think that doesn't scare the markets. If it's like 10,000 or 0, that suddenly suggests some of the confidence. I think investors are looking at a variety of labor market data. I think we've kind of stabilized. You kind of call that into question. So I think that, again, would sort of spook the markets.
Jason, you're selling me on the jobs report. I'm now a little bit more excited, but I want to know, do you think the shutdown had any impact on this reading we're going to get?
Well, the shutdown ended sort of mid-November. We know that for government employees, that really distorted the November payrolls report, which that's why I think the 65,000 for private sector was really important. I think the question still is, like, given the seasonality adjustments, other factors, I think there's still noise. And so this is why I think the markets could also sort of dismiss this reprint to some extent. So I'd say it's important, but depending on what your narrative is, you can kind of say, well, we need more data points.
Is that basically what Anne-Marie said a little bit earlier?
Yeah, this is what, now
right.
I was excited, and now you made me unexcited.
You've got someone back on your team. Can we just figure out the amount of intervention we've had so far this week from this White House? And as an investor, how consequential you think it might be? Is it positive or is it negative?
Well, I think that's a question we're all sort of trying to grapple with, like how much of this is real versus sort of headlines, sort of tweet kind of announcements, whether it is the mortgage payments, whether it is talking about defense companies not paying things out. Clearly, if you have a more activist or interventionist policies, then as an investor, as a shareholder, you think, well, do I need to price in a higher risk premium for it? Because I just don't know what sort of announcement will take place that could alter companies' cash flows. I think right now the view is probably still very much these are headline noises, not fundamentals. And you kind of go back to kind of the idea of a kind of a Trump put for the equity markets, that you can sort of rattle the saber so much, but not too far. But if that gets questioned, and then that becomes an issue.
The equity market has certainly had a fantastic run. Jason, it's good to see you. Jason Draho there of UBS Global Wealth Management. The president leans on mortgage-backed securities, and what happens? You see these single names that offer mortgages rip just rip in the pre-market.
There was a real message, though, in what Jason just said, and frankly, in the market reaction, which is they see the Feds, they see the president's put more than they do the stick, right? Even if you do have the potential caveats around, say, defense stocks, they rallied on the proposal for a budget increase, even if it was improbable that that would actually get through Congress. So the stock market's taking the good, the bond market's looking for the bad, but not finding it. It seems like everyone is expecting only the positive, not the stick.
It's a big tasty carrot right now for some of those names at
Yum,
least.
yum, yum.
Let's get you an update on stories elsewhere. I like that, Bramo. I'll let that go. You know.
Carrot cake, maybe.
You know, okay.
At the top of the food pyramid.
Yes, we can get into that later. Let's get into that later. I looked at that. It was a bad time.
I mean, come on, everyone
would
would
take so
agree with
long?
that.
It's ridiculous.
Sugar on the top, really?
I'm pleased they finally made that move. Okay, let's get you an update on stories elsewhere. Let's do that. Let's get your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. The United States reportedly seizing the oil tanker Olena in the Caribbean. The Wall Street Journal reporting U.S. forces boarded the ship, which was falsely flying a Timor-Leste flag while transporting Venezuelan oil. This marks the 5th such interception of a ship in recent weeks as President Trump aims to control Venezuela's exports. Meanwhile, NASA will conduct a medical evacuation of an astronaut suffering an undisclosed illness aboard the International Space Station. The astronaut, who is in stable condition, will return with the 3 other members of their mission, which launched back in August. This marks the first time in NASA's history a crewed mission has been shortened for medical reasons. And the college football semifinals kicked off last night with Miami defeating Ole Miss 31-27 in the Fiesta Bowl. Hurricanes quarterback Carson Beck delivered a game-winning touchdown run to punch their ticket to the national championship. Miami will take on the winner of tonight's Peach Bowl between Oregon and the undefeated Indiana Hoosiers. That's your Bloomberg Brief. John?
Indiana sweatshirt in the control room. You've seen that already?
I actually haven't, but I imagine that there are a couple of them.
Big fan in the control room.
Yeah, I know.
Yeah.
Hoosier up, boiler up.
No, that's Purdue. Another school in.
Let's move along, folks.
Yeah, that was
so focus on the food pyramid.
Okay. Oof. Up next, the morning calls. It's me teaching you.
At least you
ridiculous. Okay, we'll also catch up with the U.S. Interior Secretary Doug Burgum in just a moment on the meeting taking place at the White House between the president and energy executives.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
if you got a strong data release today, something that indicated the economy was much stronger than we expected, I think the cynics out there might question whether the data was correct. I think it's the broader trend that matters. You've got to smooth these numbers out over a period of time. I think the trend and the path is quite clear towards lower rates.
That was the brilliant Steve Major of Tradition joining us out of Dubai a little bit earlier on this morning, anticipating these job numbers at 8:30 Eastern Time. The numbers about 17 minutes away. Into that, the scores look like this. Futures positive by 0.1% on the S&P, on the Nasdaq high by 0.2%. That's the price action. Here are your morning calls. First up, JP Morgan, double upgrading Southwest to overweight, placing the airline on its positive catalyst watch ahead of earnings later on this month. Your second call from Mizuho, downgrading Qualcomm to neutral, anticipating headwinds to its handset shipments this year. That stock is down by 1.8%. And your third and final call from Truist, upgrading Lockheed Martin to buy, citing fading Doge concerns and strong global demand and the potential for a pretty big budget coming out of the US. Down in Washington, D.C., Lockheed Martin in the pre-market higher by 1.5%. Let's turn to energy. Nearly 20 energy executives meeting with President Donald Trump today to discuss rebuilding Venezuela's oil infrastructure. The lineup includes representatives from Chevron, Exxon, and ConocoPhillips, among others. Also attending the meeting will be the U.S. Interior Secretary Doug Burgum, who joins us now. Mr. Secretary, welcome to the program, sir, and a happy new year. Just frame for us the expectations for today's conversation.
Well, the expectation today is to have a great conversation about the opportunity to continue President Trump's agenda, which his agenda, of course, has been always about the safety and security, national security of our country. That begins with you can't have national security without border security. You can't have national security without energy security. So that's going to be on the table. And, of course, the prosperity of America. That's based on energy as well, because if without a plentiful, abundant, reliable, secure energy, you're going to have the inflation like we saw in the previous administration. President Trump is turning that around. So this is really at the core, it's a discussion about peace in the world and prosperity at home. And what an opportunity, economic opportunity to restore normal relations with Venezuela. And for companies, including many of these that had operations in Venezuela for decades ago, when Venezuela was a big economic partner to the United States before its collapse, get a chance to return to that. So looking forward to it. It's an exciting day and lots of interest in coming to the meeting today. There are not enough seats in the room in terms of executives that wanted to join in the meeting today with President Trump.
Secretary Burgum, I know that you and Secretary Ryder have that outreach with the oil industry right now, but what I'm hearing is that they are certainly lining up for a meeting with the president, but they're not necessarily lining up to go back into Venezuela. What are they telling you?
Well, I think the very strong interest. How can you not be interested in the world's largest oil reserves in the same hemisphere? So I think there's questions, of course, questions about security, questions about what the long-term profile is going to be, but the interest level is through the roof across from the small wildcatter to upstream, midstream, downstream, the majors. There's so much interest in this, and not just in energy. People are reaching out because the mining industry collapsed in Venezuela. Their entire electrical generation industry has collapsed. The opportunity with sanctions being selectively listed for the U.S. companies to sell into that market as it rebuilds is very interesting. And of course, we've got a number of energy companies that have spent their careers going into some of the world's dangerous places to develop oil resources. And those folks, some of those will be in the room today as well.
But it's going to take tens of billions of dollars for them to allocate capital to go back into Venezuela. Does the math make sense when WTI is trading below $60 a barrel?
Well, the market is going to decide, but I know that one thing that happened this week, people keep saying, oh, below 60, there's going to be no interest. Through the Department of Interior, we're holding our as required legal lease sales. The one that we held in New Mexico earlier this week on January 6th, $327 million of royalty payments and a record, the highest since these leases have begun under the new format. Almost 40 years, 39 years ago, in 1987 was when the new rules came in place. It was $219,000 per acre on one of the leases in Permian. So I would say the interest U.S. And in Venezuela very strong in this industry because they see, they look ahead and they see the demand for energy going up. And of course, driven by economic growth, 2026 could be a banner year, but also the energy required for us to win the AI arms race. So there's a strong, strong interest in this investing in this Western Hemisphere.
Does the administration have a goal of getting oil to $50 a barrel?
Well, I think what President Trump wants is he wants to break the back of inflation, and he knows that there's a component of energy in the food you eat, the clothes you wear, the car you drive. If you can get energy prices down, that's the best way to lick inflation, and affordability is something that matters. President Trump has stopped the runaway inflation, the prior administration. He wants to keep it going. When we talk about how do we get prices down, part of it is we've cut so much red tape in the last year. We've lowered the break-even point. That plus the technological innovation from this industry, the oil and gas industry is not what it was 50 years ago. This is a super high-tech industry. You take a look at my home state of North Dakota, and you look at the capability and the productivity increases of the people developing there. It's just been amazing, the gains that they continue to make. And again, the shale revolution tied with deregulation, cutting some of the red tape that was put in place. We know that their break-even point is getting lower and lower, and that's why it makes it a great industry, and that's why we've got the greatest industry in the country, or in the world, because in the U.S. we've got competition. We don't have a nationalized oil industry that's become a monopoly and lethargic. We've got great companies that get out and compete. We're going to be with some of those great companies today, and excited to hear their ideas about how to go in and break free the incredible opportunity that is for both the U.S. and Venezuela in developing this resource.
Mr. Secretary, a lot to unpack there, including about the shale patch. I do want to stay on this question of U.S. backing of some of these U.S. companies going into Venezuela and building out the infrastructure there. President Trump has talked about potentially a $100 billion investment, potentially over the next 18 months. Where would the funds come from in the United States for some of these energy companies to help back those investments?
Well, the discussions right now have been that the capital is going to come from the capital markets and come from the energy companies. I don't see that these companies are going to need support from the U.S. other than things around security. I mean, if we can provide a secure, stable environment, the resource here is so significant and so large that it's going to be attractive for people to go in and develop that. And particularly as the U.S. maintains the embargo, this is key. You reported on it just now. President Trump, serious. I mean, sanctions under President Trump actually mean a sanction. The failed sanctions under the Biden administration just turned Venezuela and other places into the discount gas stations for China and other countries. And President Trump is, we're going to make sure that this is secure, and we're controlling the flow both of energy going in and energy coming out. Venezuela's heavy crude requires diluent. It requires a light crude like we've got in the United States to go down there. One barrel's got to go into Venezuela for every 5 barrels that comes out. Russia controlled that market. That market's coming back to the U.S. And the synergy between our refinery sector in the United States, which was built around Venezuelan oil, getting back to that's great news for refiners, great news for gas prices for Americans, great news for the opportunity to sell modern equipment to modernize this industry. So lots of news for beyond even the oil majors. Lots of great news economically as we open up this trading and normalized trading relationship with Venezuela.
Yeah, certainly Valero, as a refiner, has seen the benefits of this. Mr. Secretary, you talk about security guarantees, and if the safety is there, the oil majors will go in with, frankly, capital markets behind them. What kind of security guarantees are they asking for?
Well, we'll find out some of that more today, but I think what they really want to understand is, you know, how serious is the U.S. in maintaining the embargo? How serious is the U.S. in maintaining stability in Venezuela? And I think the actions that they're seeing this week speak loudly to that. The actions of President Trump enforcing the embargo and already the cooperation. I mean, earlier this morning, President Trump, just in the last half hour, tweeted out that the Venezuelan interim government is releasing political prisoners. They're taking actions to demonstrate that they want to have a successful economic relationship with the United States of America. the interim government's committed that they're going to be buying equipment and material from the U.S. companies. I mean, these are all the signals that we're looking for to keep us moving towards normalized relationships.
Mr. Secretary, as you know, to establish stability in this region, it might require massive expense from the U.S. government, which might require a lot of money from taxpayers. If these oil majors go in with the support of the U.S. government, Mr. Secretary, will the president want a slice of that revenue for the U.S. government?
Well, I think President Trump is always looking for good deals for the American people, but he also is a business person. He understands that we have to have the right economic conditions for companies to go in and deploy their own capital and solve these problems. So I think in the end, what we're going to see is we're so fortunate to have a president who has got the willingness and the courage and the understanding of how to use force, just like past presidents did. I mean, we wouldn't have the Panama Canal without bold action by Theodore Roosevelt 125 years ago. And now under President Trump, again, taking a corollary of the Monroe Doctrine, which is saying, hey, if we've got criminal enterprises running countries and destroying countries in our hemisphere, that's bad for the neighborhood. Let's go in and clean it up. And do that. But when it comes to rebuilding, I think, again, what we've seen is that if we can create the right market conditions, we're not going to need taxpayer dollars to go do this. And who's going to benefit? The taxpayers, because they're going to see lower prices at the pump here in America.
The reason I bring up this question, sir, is because, as you know, there was some conversation about chips being sold into China and the government getting a share of the revenue associated with those chips. And I wonder if the same kind of thing applies here, because I think the executives going into this meeting later are trying to figure out what kind of meeting they're going into. Is it an opportunity to explore Venezuela by themselves or alongside the U.S. government? And what kind of agreement could be established further down the road?
Well, I think initially it's going to be alongside the U.S. government because, as has been stated publicly this week, the U.S. intends to control the disposition of the oil coming out of Venezuela. And as I said earlier, that it's going to control whatever material and supplies, and in this case, the millions of barrels of diluent that need to go in to extract this heavy Venezuelan crude, that is going to be controlled by the U.S. During this period in cooperation with the interim government in Venezuela. So I think that they can hear more about that firsthand today, but it's going to match what they've heard publicly this week. And I know from talking to a number of these executives this week, Chris Wright has talked to a number of these executives this week, there is a lot of interest in getting back into the world's largest proven reserves right here in our hemisphere. And again, that's a great benefit to the entire Western Hemisphere, but absolutely it's a benefit to the American citizens.
Mr. Secretary, we appreciate your time. I imagine this is going to be an ongoing conversation, and we look forward to exploring the issue with you through 26. A Happy New Year, sir. The U.S. Interior Secretary, Doug Burgum. Without a doubt, these majors are going to be interested going in. Along what timeline? That's going to be the question a lot of these guys are going to have. To establish real stability, you need to see how this plays out for a number of months, don't you? Maybe even years.
Exactly, and the point he brings up is that the questions he continuously gets asked is about security. You want to go back in there if it's stable. Remember, Exxon, ConocoPhillips, they're still owed money from the mid-2000s. But what he says he's hearing from oil executives is very different than what me and other journalists are hearing from oil executives, which they're very skeptical about going back into Venezuela.
Lisa, let's just put it this way. There's a lot of work to be done on this issue.
To even understand the questions that some of these oil executives have that need to be answered by the administration.
Up next on the program, we'll get to the jobs report. It's just around the corner with equity futures positive by 0.1% on the S&P 500. We're looking for about 70K and an unemployment rate to fall back to about 4.5%.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Mike McKee messaged me just moments ago. He said, the last time you wished me a happy Payrolls Friday was September 5th. September 5th.
Oh, that's pretty...
It's been a while.
Yeah, well, it's the reason why people are talking about clean data. Do we get it this time?
Crazy.
It
We
is
were doing this on like
September 5th.
random Wednesdays,
Crazy.
weren't we?
Yeah. Futures look like this. Your scores set up as follows. We're positive by 0.2% on the S&P 500. Likewise on the Nasdaq. Here's a quick picture of the bond market as we anticipate this jobs number. The estimate is 70,000. With the jobs number is Mike McKee. Good morning, Mike.
Good morning, John, and happy December 9th. 50,000 is the change in non-farm payrolls with a net revision to October and November of a negative 76,000. So over the 3 months, we're down by 26,000. Change in private payrolls, 37,000. Manufacturing payrolls were down 8,000. The private payrolls is only half of what was forecast. So this is a bit of a rebound in the government sector, it seems. The unemployment rate, 4.4%. It was 4.6 last month, or well, basically for November, we'll call it. And the feeling was that that might round down to 4.5 because government workers who misclassified themselves as unemployed would fall out. But we've gone down to 4.4. Labor force participation rate, 62.4. We'll look into the reasons for the drop in unemployment and see if it fits into the so-called good news categories. Average hourly earnings up 0.3 for the month, and for the year, 3.8%. It was 3.5% the last month, so the president gets something out of that. But a 4.4% unemployment rate on the face of it looks like he's not going to get any kind of January rate cut from the Fed.
Mike McKee, thank you, sir. We'll come back to you in just a moment. So you all remember the routine. The first move is not always the right move. But where's the emphasis this morning? On headline payroll, soft than expected, some big downward revisions, or on the unemployment rate? Coming into this, the view on Wall Street was unemployment at 4.647 keeps the door unlocked nicely for a rate cut at the end of this month. 4.4, does that change the conversation for the FOMC? Yields higher by 3 basis points at the front end of the curve. Two's up to about 3.52. The 10-year bond yield at the upper end of a very tight range for the year so far, 4.19. And in the equity market, I have to say in the stock market right now, pretty muted price action off the back of some of this. Up by 0.2%, Lisa, on the S&P 500.
Right now, at least the initial message from the 2-year yield is that this takes a little bit of emphasis away from the Fed cutting rates at the end of this month. The idea that you got a 4.4% unemployment rate after getting a 4.56% unemployment rate at the previous reading, that was also revised lower to 4.5%. So you are getting a revision lower. You will get some people who will come out and say it's all a noise. How can we really understand any of this? And the headline number was weaker. Nonetheless, on the margins, this doesn't indicate a further deterioration that would really embolden some of the doves to really go aggressively at the beginning of the year.
And Mike McKee, you're still standing closely by. Where would you put the emphasis this morning, looking across this report?
Well, we're going to emphasize the unemployment rate, and I'm still working my way through this, but the Labor Department does say that it adjusted the seasonal adjustment factors that are used in this report for the year, and that that may have had an impact on why we see the unemployment rate drop 0.2%. We've still got to see what the overall number is and what the rounding number is, and then we'll take a quick look. I'll take a quick look at what the biggest changes in jobs are. But right now, to say 64 or to say 50,000, that is slower than anticipated, but the unemployment rate falls more than anticipated, and what you end up with is that low-fire, low-hire economy we've been talking about for months.
No real change, as you were. Mike McKee, thank you. We'll come back to you later. As you were for market pricing and Fed cuts this year as well, about 50 basis points, and as you were, Fran Marie's probably feeling pretty good about herself, given that she wasn't interested in this number at all about 20 minutes ago.
I'm excited now. 4.4%. A lot of people are going to say this shuts the door for the Federal Reserve to have another interest rate cut. Also, looking into this, though, this might become a problem for the administration. When you look at, once again, manufacturing sees yet another contraction in payrolls. They are really trying to sell this message that manufacturing is coming back to the United States. It's where the jobs are. We're just not seeing it show up in the data.
If you are just tuning in, welcome to the program. So a slight downside surprise on the headline jobs number, 50K, the estimate 70,000. Lots of focus on the unemployment rate. That was at 4.6, revised to 4.5. It's come down to 4.4%. The expectation today was that it would come down to about 4.5%. If you push this through the equity market at the moment, going into the opening bell, equity futures positive by 0.25% on the S&P 500, up by 1/3 on the NASDAQ. Turn to the bond market. Yields have been bleeding just a little bit higher throughout the session, up now by 2 basis points on 2s to 351, on 10s up 1 to 418. With us around the table, Stephanie Roth of Wolf Research to kick off the post-payrolls conversation. Stephanie, good morning.
Good morning.
What's your reaction to this? What are you focused on?
I'm focused on the unemployment rate, as is the market. It was a big downside surprise, whether it's seasonals or not. We're now looking at 4.4%, which the risk for this report was certainly that it would be lower rather than higher, but we certainly didn't get that higher outcome, in which case certainly the January cut is off the table. And now the focus is on the labor market is largely pretty stable. And I think that there's a legitimate chance that employment will get revised up rather than down in the subsequent benchmark revisions, which is very different from what, say, Powell has been talking about, that we should think about each payrolls number as 60,000 lower than what is reported. I think there's a chance that it ends up getting revised higher into the future.
So the risk management adjustment of the Federal Reserve is over, that's done, that's behind us.
Yeah, I think that's fair.
What's in front of us? Just a period of stability and going nowhere until we get a new Fed chair?
Yeah, I think that last time was the last cut for Powell, and now we're going to see not much out of the Fed until we get the new chair, and in which case then we'll be in an environment where inflation is likely decelerating in the middle of the year. The bump that we get in the beginning part of the year because of fiscal will start to fade. We'll see a little bit of a cooling in the economy, in which case they can probably cut another couple of times.
Is this clean data?
Yeah, I think it's as clean as the first print on payrolls can be. Because we know that response rates are a lot lower on the first release than the subsequent second and third. So this is clean, unlike the CPI data, which we're going to get next week, which is going to have some significant fallout as a result of the government shutdown. This has largely worked itself out in terms of government shutdown effects at this point.
Do you feel more confident about the unemployment rate really representing something that's going on based on some of the other data that we've gotten this week, whether it was the JOLTS data and the quits rate, whether it was what we saw with respect to ADP numbers, or even ISM services data?
Yeah, I think the collective data is telling us that the labor market is stable, if not starting to improve a bit. Now, of course, hiring has slowed down, but some of that has to do with retail, which seems to be retailers concerned about how the holiday season was going to play out. It seems like perhaps the holiday season went a bit better than expected. So what the collective data is telling us is that we're not deteriorating in the labor market. If anything, you're starting to see marginal improvements, whether it's the quits rate, whether it's the layoffs rate not looking any higher, whether you're seeing claims continue to be stable. All of the data are telling you the picture is that the labor market is largely fine.
Governor Myron was on this week, and he really was talking about the reason why he wants to see lower interest rates. He was talking about what's going on with inflation. He thinks a lot of that has really evaporated. What would we need to see next week in an inflation print for the Fed to consider cutting with a 4.4% unemployment rate? We're not going to see that next week.
Well, for him to maybe go into the meeting and make that argument. I think it's going to be a tough one, because what we're going to see next week is a pretty decent bounce back in terms of following the government shutdown. because there were a number of cities, about 20% of the metro areas are surveyed every other month. Those that were supposed to be surveyed in October, the BLS put in a 0% inflation for them. So we're going to get a catch-up in that. So it is incredibly unlikely that we're going to see a soft CPI print next week. Certainly one that they can make an argument such that the Fed should be cutting as a result of soft inflation.
I believe we get that data this coming Tuesday on the 13th. Mike McKee's still with us. Mike, your thoughts on what you're seeing at the moment?
Well, we're breaking down the unemployment rate numbers, and if you start at the top level and go out to 3 digits, the unemployment rate for December is 4.375. It was 4.536 in November, so this is a significant move down in unemployment. Breaking it down, we see the labor force rose by, actually fell during the month by about 45,000 people in the labor force, and then the household employment number rose by about, we're calling it 232,000, and unemployment fell by a little over 200,000. So more people got jobs, fewer people were looking for jobs. And so in the parlance of this kind of stuff, we're looking at bad news is good news, and that's why we see the unemployment rate come down. Biggest job losses were in retail, and the biggest job gains, as usual, were in health and social services. The unemployment or job loss in retail is not usually a surprise for December and January. Maybe a little bit for December, but retailers start letting people go. We'll see if that continues into January.
Mike, happy Payrolls Friday. It's good to see you. It's been 4 months. It's ridiculous. We haven't done a Payrolls Friday in 4 months. Unreal. Robert Tipper Jim joins us now to build on the conversation in the bond market. Robert, would you conclude, established in the same way that Stephanie has, that the Fed here is done, at least until we get the next Fed chair?
You know, I could understand based on the 1 month where you could come to that conclusion. But if you look back over the last 6 months, 12 months, 24 months, there's a linear rise in the unemployment rate. There's month-to-month variability, but the trend there is definitely rising. The wage growth of 2.3% per month is about equaling inflation, so there is zero real wage growth there. So I think for a Fed that really has been very focused on the unemployment rate, they're going to focus on the trend. And I think this keeps us on course for them to continue slowly cutting the Fed funds rate as we go through this year.
Robert, do you think, though, that that means later in the year that we end up getting the rate cuts, not necessarily on January 28th?
So I think January, there's a lot going on there. We'll be on the eve of Mr. Myron's term expiring there. They have just moved 3 meetings in a row. And I think that is going to be really important here. And the chair has discussed that now they're on the cusp of or in the top end of the neutral range. So they may feel like they're not having an impact on the economy here. They can stand to skip a meeting. The pace of growth in the economy is fine. I don't think that's the problem. But there is a trend rise in unemployment going on. And I don't think they're going to be comfortable with that. And I don't think we can assume after a big jump a couple months ago that a 1 month drop of 1/10.5 is an end to that trend. So I think they're going to be on course for cautious cuts to ensure the extension of the expansion.
Robert, do you feel like because this wasn't highly conclusive data that would encourage the Fed to cut rates in the next few weeks, that actually encourages your decision to go and buy longer duration bonds? In other words, they're not going to be overly aggressive in terms of cutting rates, and that will allow some of that, or perhaps permit the weakness that you see to really take hold.
Yeah, and I think it is a strategic buy point for bonds. I mean, we're up here pushing 5% in the long-term treasuries. Your long-term credit product have very attractive yields. Your bond market is very attractive. And unlike a couple of years ago when you had an inverted yield curve, you're looking at a 3.6% cash rate that is probably still on its way down. So I think that a number like this, which is a very stable economy, slow deceleration in inflation probably, Fed cutting rates that people are going to continue to pick away. And I would point out that your money fund balances have continued to rise. So money has been going into the bond market pretty steadily over the last year. People are, getting anxious about were getting anxious about their 4% T-bill yields, now will be anxious about their 3.6% T-bill yields, should be thinking about going out into the market and extending duration. We haven't even really begun to see an asset allocation shift from money funds to bonds. So I think it is supportive of the back end to see this kind of cautious Fed approach to rates.
Robert, are some of these themes, forces, factors unique to the US bond market? Because certainly the performance of the 10-year Treasury was somewhat unique regarding the global bond market in the last 12 months. The drop-off we saw in the 10-year yield is not something we saw replicated in big developed market sovereign debt markets, Robert. What's special, unique about this US market at the moment?
Right, yeah, this is a fantastic cycle for global bond managers because if you have a central bank clock, and in our recent quarterly, I put a central bank clock there and talked about how, a year ago, everybody was cutting interest rates except for Japan. Now there are a lot of central banks that are transitioning from that, oh yeah, we're done, like the ECB or the Reserve Bank of Australia, and the market is starting to price in hikes. Korea, all around the world, there's been a big shift towards that end stage. And I think that's made markets anxious. For the strong performance the U.S. bond market had last year, it was a weak year in Europe. They just had about a 1.5% return on their aggregate index. But on balance, markets are taking turns, kind of leading what is a very slow bull market out there where the bond market is outperforming cash. It's outperforming. Everybody's terrified to be in the market.
And that's an if, can real wages kind of support the economy and see that rotation? You talked about Russell outperforming here. It's a little bit of, hey, if you see this broadening in consumption being supported from real wage growth, that can kind of be the new story in 2026.
Which is what a lot of people are banking on, the sort of broadening out. And we saw that record high in the Russell 2000 yesterday, even with an essentially flat S&P 500. Are you leaning into that based on the data that we've gotten so far this week?
Well, it's a little early to say this data is enough to reach that conclusion. And I think you have a lot of kind of other issues associated with that equity market rotational theme, which is a lot of concentration and investors really struggling with one of the key issues for the 26 outlook, which is how do I manage my portfolio? How do I deal with diversifying and finding sources of diversification when I have such concentration, 40% of the equity market valuation in the top 10 companies? How do we get away from those highly concentrated names? How do we find diversification in the portfolio? And the broad economic support for that would be coming from this notion that you could have an economy that is spreading out the gains and seeing a broader based recovery. We talk a lot on this program about, kind of the challenges of the K-shaped economy. And do we see some of that support? So a little potential hint, I don't want to overstate that, and to answer your question, probably not enough in this week's data to come firmly to that conclusion, but it is pushing in that direction.
Jeff, I've got 20 seconds. I'm tight for time. Forgive me. If the Supreme Court rules against these tariffs and we find that out later on today, is that a buy of bonds, a sell of bonds, or a shrug of your shoulders and go to lunch?
I think the conclusion here is that we kind of overreacted on the tariff side, right? We overreacted back in April. Didn't seem that way at the time, but the real issue is we've overestimated the pass-through impact of tariffs on inflation. And so I think it's just kind of taken the heat down on the implications for that. So maybe the third answer in your proposal there, it's a shrug of shoulders.
Lunch it is. Jeff, thank you, sir. Jeff Rosenberg of BlackRock. Enjoy the day. Thank you, sir. Thank you very much. You said lunch too. I've got it in front of me.
Yeah, well, I mean, clearly it's sort of shrug your shoulders because ultimately we don't really know what's going to happen with this. It just kind of creates more noise that we can kind of parse through.
A lot more chaos for C-suites that are paying some of these tariffs, and maybe they're going to get reimbursed. But do you even need to get reimbursed if the president is going to put on, a 338, a 232, a 122?
I'll take the safe option. I've got no idea.
Which is the reason why
this bond market's been so snoozy for so long now.
You'll be at lunch too. I think everyone's pretty exhausted. They're saying, I could just have a nice meal.
Logged into Bloomberg anywhere, of course, all right? Yields up by a single basis point. The 10-year 4.18. Tune in Monday. Steve Chevron of Federated, Nuria Rabini joins us, Alicia Levine as well, and Torsten Slok of Apollo. From New York City, have a wonderful weekend.
Tune in to Bloomberg Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, you know, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The unemployment rate is lower. Futures higher. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
We now have 4.4% unemployment ahead of the Supreme Court decision as the market faces a macroeconomic double tap.
Trump at home and abroad. The president cancels a second strike on Venezuela and prepares to meet with U.S. oil executives this afternoon.
And an AI power arms race. Meta locks up nuclear electricity supply from Vistra and Oklo, with Rio Tinto in talks to potentially buy Glencore.
There's a lot going on today.
Yeah.
I think is very apparent. I'm looking at some of those energy stocks, Matt, specifically the nuclear-powered ones, with Meta now becoming the biggest hyperscaler buyer of nuclear energy. They're going to buy some from Vistra, from Oklo, and you can see this huge move off the back of that. 17.6% for Oklo. Vistra, Matt, in the pre-market is up by nearly 16.5%.
Yeah, will be interesting to see how this plays out, how much they're going to end up paying per gigawatt. Mortgage stocks are moving as President Trump asks, or demands rather, Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to keep interest rates down. He's essentially going around the Fed to do quantitative easing from the Oval Office. And right now we're looking at some mortgage stocks here. Open Door up 10%, Rocket up 6%, Loan Depot up 16%. So some big moves in some stocks that are really tied closely to the news this morning, Danny.
And big moves this entire week with stocks tied closely to the president, whether it be that, whether it be Intel this morning or some of the oil majors. But let's start with the payroll data. It came in less than expected in December, but the real shocker, a lower unemployment rate. Let's get a closer look at the data with Bloomberg's Michael McKee, international economics and policy correspondent. Mike, what do you concentrate on for this report?
Well, the unemployment rate, because that's what the Fed is concentrating on, but the market's first reaction is always to the number of jobs created, which were lower than expected, 50,000 after 56,000 in November. But remember, we lost 173,000 in the month of October, and the net loss for the 2 months of November and October was 68,000. So we end up with a negative 22,000 over the last 3 months, which is not particularly good news. And in this case, private payrolls did not grow as much as anticipated and as much as the prior month. And there was because there wasn't much going on in the government sector as well. Now to the jobless numbers, Danny. This is what really mattered. 4.5, this is important. Do you look at the unemployment rate for the month of November? It was 4.5%. It had been 4.6% when first released, but they applied new seasonal adjustment factors. That moved down to 4.5%. So the drop to 4.4% is not as big as you might have thought. But it's still good news, because what we end up with is on a three-digit basis, the unemployment rate is below 4.4%, 4.375. So it is a significant move, and it does tell you that the Fed is not going to be lowering interest rates next month, which is not going to make the market this month. It's not going to make the markets happy. The jobs were gained and lost is pretty much as you'd expect. Manufacturing lost jobs. Trade and transport lost the most, 33,000. Retail down by 25. And as always, health and social services and leisure and hospitality were the two big winners in December. And the leisure and hospitality really made a big comeback there. So basically, I think you end up at the end of the day by saying, not much has changed. I mean, this isn't October where all the government workers fell out, right, but it's not that different from November, and it's not different. The story's not different from what we've been telling. Low fire, low hire.
On the other hand, if you step back, right? I mean, we of Gen Z feel like 4.4% is high, but if you step back, Mike, and look at, history, this is a very low level of unemployment, and 3.8% wage growth is nothing to shake a stick at, especially if you look at inflation at only 2.6%. I mean, it looks like a pretty good labor market.
Well, it is a pretty good labor market. And the thing about the unemployment rate, the Fed is not so much looking at the level because they know it's low. It was the speed at which it was rising, and it had gone up from 4.2% to 4.6%.
Yeah, Mike, 1 month does not make a trend.
1 month does not make a trend. We'll have to watch this. But not only did it not go up again, it didn't even stay the same. It went down. So it's whether it's 4.375 or not exactly isn't as important as the fact that it's not rising and it's not threatening to rise significantly to the point where you need to put a safety net under the economy by cutting rates more.
All right, Mike, great to get you on this hour. I'm sure we'll talk to you probably again in the next hour. Michael McKee is our international economics and policy correspondent, and we are focused in on the labor market. Later this hour, we're going to speak to the U.S. Labor Deputy Secretary Keith Sonderling about these numbers, whether he sees them as a success. This afternoon, we have a who's who of U.S. oil executives gathering at the White House. Nearly 20 people will be attending, including bosses from Chevron, Exxon, ConocoPhillips, Shell, and Valero. President Trump is expected to push the companies to rebuild Venezuela's battered energy secretary. U.S. Interior Secretary Doug Burgum spoke to Bloomberg about the meeting.
I would say the interest, U.S. And in Venezuela, very strong in this industry because they see, they look ahead and they see the demand for energy going up. And of course, driven by economic growth, 2026 could be a banner year, but also the energy required for us to win the AI arms race. So there's a strong, strong interest in this investing in this Western Hemisphere.
Joining us now is Bloomberg Washington correspondent Tyler Kendall. And Tyler, I wonder what carrots the White House is going to dangle in front of these energy executives to get them to invest in Venezuela. And I also think it's interesting that Doug Burgum used the term Western Hemisphere because he's clearly referring to the Monroe Doctrine.
Right, exactly, Matt. I mean, that is the biggest question of today, as it is very clear that the White House is turning up the pressure on these oil companies and really banking on them to help advance U.S. interests in Venezuela. If you listen to President Trump, he often says that the country has to be on more sound economic footing before the U.S. can even consider setting any potential dates for elections in the country. But people familiar with the matter do tell us here at Bloomberg News that oil executives have already made the case directly to this administration that they are weary of the scale, the size, the money required to rebuild Venezuela's oil infrastructure. But at the same time, these people familiar tell us that nobody wants to tell President Trump no. In fact, President Trump has signaled that he was in touch with these companies even before he gave the green light for that mission last weekend that captured Nicolas Maduro. And this is an industry that has broadly supported President Trump and this White House's deregulation push. But it is clear that these companies have concerns and they're going to want to see physical security guarantees, but also financial guarantees when it comes to any potential investment, not to mention those questions about what this means for domestic producing here in the U.S. and global energy prices. Now, you mentioned this at the top of the program. President Trump does say that the U.S. is currently working well and cooperating with the Venezuelan government, and that includes giving access when it comes to rebuilding that infrastructure. So we'll see where it goes from here. But Matt and Danny, just to underscore the perhaps tension that these oil companies are feeling, it is our understanding that some of the executives for this meeting at the White House today asked for it to remain behind closed doors. A White House official does dispute that that was an ask on the table, but as of now, it's on the official White House schedule as being closed to the press.
So we'll have that meeting. It's also Jobs Day in America. But Tyler, I think it's safe to say that should we get a decision by the Supreme Court on IEEPA and whether or not it's illegal to use that to enforce tariffs will be the event of the day. What should we be thinking about? What should we be looking for? As it is possible we'll get that ruling today.
Right. This would definitely dominate the conversation here in Washington, Danny. The Supreme Court has really two big questions that they have to decide when it does come to President Trump's broad-based tariffs enacted under IEEPA. The first is, as you said, does he have the legal authority to invoke IEEPA for tariffs? Because this has never been used in this way before. The authority is actually typically used to levy sanctions, not to levy tariffs. If the Supreme Court does decide that the president has that authority, then it has to look at whether or not the president actually used the authority correctly. Because keep in mind, President Trump has invoked IEEPA twice, and in doing so, he had to declare a national emergency. That happened with those tariffs related to Canada, Mexico, and partly on China over fentanyl concerns. And then it was also those so-called reciprocal tariffs where the president cited persistent trade imbalances. At the oral arguments last November, we did hear the justices cast some skepticism, some doubt on all of this, really, whether or not he has the authority and whether or not those national emergencies met the legal standard required. So a lot to dig in here. We'll see if it happens at 10 a.m. Eastern.
Tyler, thank you very much. And if we do get that decision, you and the D.C. team will be part of it, part of the ones breaking it down. So we'll let you prepare for that. That's Bloomberg's Tyler Kendall. And Energy Secretary Chris Wright, speaking of those oil executive meetings, will be joining Balance of Power. That will happen at 5 p.m. Eastern Time. Elsewhere, Meta has announced a number of nuclear deals that will help make it the biggest buyer of nuclear power among its hyperscaler peers. Will Wade, Bloomberg's energy and renewables editor, joins us now. Will, this is a huge amount of energy, potentially enough to power 5 million homes. What are the details of this deal Meta is making with nuclear energy power users?
Oh, yeah, this is a really, really big deal. So starting off, they're going to be getting energy from some Vistra nuclear power plants, some existing ones in Ohio. They're going to upgrade those plants. They're going to upgrade some other plants in Pennsylvania. They're going to get power from those upgrades. And then looking further down the road, they have deals with two advanced nuclear startups, TerraPower and Oklo. And both of them are developing a new technology, and Meta has deals to buy many gigawatts of power from those projects. And what's interesting there is They're not even building them yet. TerraPower is going to have to build 2 new ones and maybe 6 more after that. Oklo's going to build, I don't know, maybe a dozen of their small nuclear reactors. And those are projects that won't even, come to fruition for years.
Yeah, and those are also, small, as you mentioned. So they're not like gigawatt power producers. By the way, what do we think the financial terms look like, Will? They didn't release them, but I ran an analysis with my handy-dandy ChatGPT, and it tells me the rule of thumb is about $600 million per gigawatt per year. Does that make sense?
I'm trying to crunch some numbers as well for a story I'm going to be putting out later this morning. But yeah, those figures could be in the ballpark. This is a very, very costly deal. And what's interesting is Meta is willing to spend money for nuclear. They could get solar and batteries a lot faster and it would be a lot cheaper. But nuclear gives them a couple of advantages. Well, the most important advantage, of course, is that it runs all the time, and solar doesn't. And they really, really want that clean energy around the clock. Meta's got like this massive data center project it's working on in Louisiana, and they're going to be powering it mostly with gas. And they've faced a lot of criticism because gas, of course, is a fossil fuel and, spews carbon emissions. And Meta's, like many of the tech companies, has these ambitious green goals. And when they say, well, we're going to have a big data center project and we're going to power it with gas, people kind of look at that and go like, really? What about those green goals? So they had this other big data center project in Ohio, and that's what's going to get all this nuclear power. So is how Meta gets to say, yeah, we really are trying to stay within our carbon targets.
And of course, you want to use wind, right? Because
the poor birds.
The birds. Will Wade, thank you very much for that. We'll look forward to your story on, I guess, a speculation on the financial details, looking at, Microsoft paying like $17 billion for like 10 gigawatt hours. You kind of make comparisons, and we'll do that. I want to check on markets right now because despite the idea that the jobs number isn't going to allow the Fed necessarily to cut rates or push them in that direction further, we do have futures higher here. And we did see the 2-year yield spike as soon as those numbers came out. So it does look like the market is kind of leaning in that direction.
Yeah, but the 2-year yield move has subsided. I still should point out, though, on work WIRP on the terminal, only a 5% odd that will get a cut. So the market basically saying it's not happening in January.
In January.
Yes, in January, to be clear. After that, it goes to 30%, and then basically some cuts are priced in.
And down to 3 in 2026. In terms of the individual movers that we're watching today, Danny's hot about Rio Tinto.
It's a huge deal.
It is, especially
a metals giant would be created.
Especially for the expats. Potentially buying Glencore to create the world's largest mining company with a market value of more than $200 billion.
Well, I have a company that you are very excited about, and that is General Motors, GM, falling 2.2% in the pre-market. It's going to take another $6 billion in charges tied to production cutbacks in its EVs and battery operations. What a costly turnaround and mistake for them.
Doesn't cost as much as, remember Ford had a $20 billion write-down recently. Intel is rising after President Trump praised the CEO, Lip Bhutan, following a meeting that the two had. So Lip apparently was very flattering in that meeting, and the shares are up 2%.
Coming up, we're going to discuss markets, the economy, the Fed, the fastest growing active bond ETF, BINC. We're going to discuss it with the man behind that ETF. That's BlackRock's Rick Reeder. That's coming up next. Stay with us.
David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Just over 10 gains after an unchanged session. The two-year yield still is rising up 1.8 basis points. It was up higher than that after the latest jobs numbers, which came out just under an hour ago. Some mixed messaging coming from it. Where do you concentrate on? Let's bring in BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder. And Rick, great to see you this morning. Thanks for joining us. I'm sure you've been poring over the numbers. What is the concentration? Is it growth that comes in less than expected? Is it the revisions for October and November? Or is it an unemployment rate now just at 4.4%?
So I think what Mike McKee said was right in that, you know, the Fed talked about the unemployment rate. I have to tell you, I have a different take on it. I think there is we're talking about 50,000 jobs and then a revision down over 70,000 jobs. If you take, we're growing now, if you go to the last 6 month moving average, if you take out healthcare jobs, we're actually running negative jobs for the last 6 months away from healthcare, which is non-cyclical, not interest rate sensitive. Actually, if you go back 8 months, the total net jobs is negative 213,000 jobs net of healthcare. What I think is going on is we have a productivity revolution of extraordinary proportion, that we have an economy that's growing at a quite robust rate, but we just don't need the people. And I know when people say, well, you know, they were focused on, could this be 60,000 jobs, 70,000 jobs, 80,000 jobs? If you go back to 2021, now that was post-COVID, we were running 600,000 jobs. Now, big pullback from 20, but then in 22, 380,000 jobs a month. 2022, you were running 217,000 jobs. 23, you were running, 24, you were running 170,000 jobs. We're talking about last year, you ran 50,000 jobs. Net of healthcare, no jobs. This year, you're running at a number, well, we just saw 50,000, 39,000 was in healthcare. Point being, and part of why I think the interest rate tool doesn't really affect healthcare. It doesn't really affect education, which was another part of the job market. Meaning, I think we're just seeing a productivity revolution. I mean, you break down the numbers, you really look at it, it's pretty extraordinary. And I think the labor dynamic is quite significant on the backside of that.
Where do you see that, Rick? Because I was just listening to Odd Lots, the Odd Lots podcast that Joe and Tracy do with Jan Hatzius from Goldman Sachs. He says that AI has added about 20 basis points of productivity to growth, and their new incoming chief equity strategist, Ben Snyder, said out of all 500 S&P companies, only 6 have been able to quantify added productivity from AI. So I hear about it all the time, and I see the stock soaring, but what's the evidence that we have actually increased productivity with these tools?
So, by the way, Jan's right as normal. As usual, I will say one thing. People like to take productivity and say, oh, it must be a two-letter word, AI. AI is coming. By the way, so is robotics, so is automation, so are other forms of productivity. But if you go back the last 2 years, and I broke it down on a call we did, logistics, inventory management, customer procurement, freight, how you use freight, efficiency of how you manage your inventory, efficiency of how you manage your receivables. Every company today is running. Why is revenue growth a decent place? But what's really happening is earnings growth is spectacular. Earnings growth is spectacular because you're reducing your cost infrastructure. Cost of goods sold, SG&A are coming down because you've come up with a better way to actually run your business, and you're using software, cloud, inventory management tools, et cetera. So I think AI is coming, and I think it accelerates what is a productivity boom. But I agree with you. I agree with what Jan said. Today, it's not AI. And by the way, you look at the M&A calendar, and which I think will continue to be robust, to say the least. Why will you see so much M&A? Some of it you have business incentives that are real. Some of it is you have businesses trying to build a moat, create more data, et cetera. A lot of it is synergistic, i.e., I can grow my company, I can build scale, and I can reduce my cost ecosystem. And that, what that means is fewer jobs. And I think we're watching it. And I don't think the story is ambiguous. I think the story is quite clear. We have a labor dynamic.
Right.
That is tricky. And by the way, it's a lower skilled problem. It's an urban problem. It's a, that I think is, part of why I think, I've been pretty adamant that I think the funds rate needs to be, I think interest rates need to be a bit lower, because I think it's lower skilled. I think it's low income. I think it's small business that are on the backside of what is a tough dynamic today.
I want to get to that, and I know Danny does too, in terms of rates, but I want to get to what you think we need in terms of adding jobs, because we have zero immigration, and we're close to a population declining. We're not having kids in this country. So to me, 4.4% unemployment, in that picture, especially with 3.8% wage growth, that looks good.
So by the way, it's a 4.4, trending significantly higher from where we used to be. And by the way, I would argue if you took a step back and said, gosh, 4.4, is that a crisis? Unequivocal that that's not a crisis. The trend isn't a good story, number one. Number two, we have a dynamic, and I think when people say it's a supply, that it's an immigration dynamic. If you look at the demand function, and so you look at the JOLTS data this week around job openings, and you look at the trend there. And again, I'm not saying we're in a jobs crisis today, but if you took a step back and said, gosh, I want to look at the big picture, and I go back to where we were in terms of what jobs are created in 22, 23, 24, we could strip out the COVID dynamic. And then you say, where are we going? Where we're going is a place from a labor perspective that I think is a bit concerning. And I think, one man's opinion, I think you have to be a bit anticipatory. We've been talking about this, for 9 months where the funds rate was at 4 3/8. And by the way, I don't think we need to go that far. I think we got to get the funds rate down a bit to 3%. We've been talking about that every month on this show. And I just think you got to get there, because I think that's the equilibrium rate today.
Rick, I just wonder though, even if you get there, how does that change these very macro trends you're talking about? I mean, that doesn't change this push to productivity. That doesn't put a cap on AI and maybe its ability to replace workers. So if you lower rates, does it really have as big of an impact on the labor market this time around?
So the answer is you're right, and it's like, does the Fed create jobs? And the Fed have one tool to create, and this argument the Fed has one tool. And by the way, it's not just the Fed. I actually think most of what you're describing needs to be accomplished through fiscal initiatives. And so, by the way, obviously a lot of news recently about the housing market. Why I think the housing market is such a profound dynamic, and part of why I think that influence is so significant. And by the way, I actually don't think the Fed funds rate is that critical. I think it's longer term interest rates you got to keep down, because you got to get the mortgage rate down. What happens if we get housing moving? If you get housing moving, you create more labor mobility. You see a job in another state, another city, you can move. That's important. We create, every house built in this country creates 3.1 jobs from people building houses. That creates, and it's, by the way, it's hard to AI building a house today. That creates an improvement in employment. And then I think there's a whole series of other things around technology, et cetera, that I think most of it on the fiscal side. But I agree with you. I think that is the trend. So then you go back and say, okay, so then what is the equilibrium rate of interest relative to that? If inflation break-evens are 2.3% and inflation projections by UMich are certainly well contained. But I think, I don't know, my point being is, yes, we have a productivity revolution. It's hard for the interest rate tool to solve it, but I think there's a whole series of things that can ameliorate some of what is a problem today, and will be a bigger problem.
Well, we still have a lot to talk about, Rick, because, you know, Stephen Myron was on with us yesterday and said that the inflation target is, inflation right now is within noise of the target, which makes sense if you look at the data. And President Trump has been pulling on all the levers that he has to try and get the housing market moving, and I want to talk about that. Rick Reeder is going to stay with us through the open. I also want to talk about Bank, because Rick runs what we've discovered is the fastest growing actively managed ETF in the world. Coming up later this hour, we're going to speak with the Deputy Labor Secretary as well, so stay with us on Open Interest.
Estava sitiada.
Isso ao começo eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talia ki kon ahma ta suara pangok ahma le pah manjang le nyai kon mananya.
Este una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, and it is an exciting day. I mean, chock full of news and market moves. There's a ton going on this Friday. Having said that, S&P futures are only up 0.1%, but we're near as damn it to an all-time record high on the S&P and the NASDAQ. Those futures up 0.08%, 0.4% on the Russell. So everybody's up a little bit after that jobs number, and there's a ton going on. That is true at the New York Stock Exchange as well. It looks like the Professional Bull Riders Association ringing the bell there because they're coming to Madison Square Garden this weekend. A couple of stocks related. TKO owns the PBR, and that stock's up 350% over the past 5 years. Looks like Boot Barn is a sponsor, and mainly due to my former host, co-host Shonali Bassick, they're up 300% in the past 5 years. You've got iHerb ringing the bell down at the NASDAQ. I don't think it's digital weed. It's apparently a business tied to wellness somehow. But I hadn't heard of iHerb before.
Well, I hadn't heard of professional bull riders before. So, by the way, I looked it up, and apparently there's a rider whose name is Sage Steele.
That's a great name.
I don't know if he was among those ones up there,
That's
but
a great name
I want to
for a
meet
bull
Mr.
rider.
Sage Steele or watch him ride.
Go to the garden this weekend.
Yeah, I guess that's what I'm doing this weekend now. Okay, away from all of that, some of the stocks we're watching this morning. Meta has agreed to a series of electricity deals for its data centers that could total up to more than 6 gigawatts. That would power the equivalent of 5 million homes. It's nuclear energy. Vistra, Oklo are among the energy firms that they're working with, so shares are up as much as 15 1/3% this morning, Matt.
Yeah, absolutely soaring. What an incredible story. We also have mortgage stocks moving higher as President Trump directs Fannie and Freddie to buy $200 billion in mortgage bonds to keep interest rates down. That applies pressure to the Fed, or essentially he's going around the Fed and doing what some call kind of Oval Office QE, which I think is so fascinating. And I was like, who should we talk to about this? Well, luckily, we still have Rick Reeder here, BlackRock's Chief Investment Officer of Global Fixed Income. And this is so interesting. I mean, President Trump, not only has he this week said he doesn't want, like, Steve Schwarzman buying homes anymore, or any institutional buyers of homes. At the same time, I think President Xi of China reminds us that homes are for living, not investments. And you've got President Trump now doing Oval Office QE, like telling his guys at Fannie and Freddie to buy $200 billion of mortgage-backed securities. Does this help, Rick? You think the housing crisis that you were talking about?
So I won't comment on a specific initiative. The only thing I will say is something there I think housing is pivotal. By the way, I normally think people underestimate how important 3/4 of the wealth in this country by people is in their home. And the way young people build wealth is through their home. The way by the way, I would even translate it. I would even relate it to, I've showed a chart on fertility rates, marriage levels, etc. I think housing, if you have what is today, what is a moribund housing market, I think the impact is significantly more intense than people think. So any of the initiatives, I think, to move it, I think fiscal, I think obviously moving the mortgage rate, I think is helpful. And by the way, I don't think you have to move it that far. You know, we track prepayment speeds on mortgages, as you said, very, very closely. If you get the mortgage rate to 5.5 to 6, you've seen it, by the way, as the mortgage rate has come down, you create more velocity in terms of housing moving. You see it in existing home sales picking up. So anyway, I think that's the case. And I think if you get the mortgage rate down a bit, and by the way, I only think you need to get 10-year treasuries down 25, 30, 40 basis points and just keep them there, keep rate volatility down. And then with fiscal, I think you do some pretty positive things. And I agree that it's arguably one of the most important things we could do today.
Hey, Rick, does anybody ever talk about getting the fertility rate up? Like, why don't we put some carrots out there to create more kids?
So I don't know. I don't know if you know this. I'm actually becoming a grandfather today. So that's
Congratulations, Rick.
Yeah, no. So I think, by the way, Matt, I don't know if you know this, but I had my anniversary once when I was on your show many years ago. So I think all my big events come when I'm talking with y'all. So there's something good there about being with y'all. So anyway,
good for us, but you're in trouble at home, I imagine.
Yeah, that is well, close. I think there's a couple of things that are play. I mean, I do think it's right. I do think if you have young people, look at the student loan, 30% of student loans are in repayment today. That is unbelievable. That stat is unbelievable. Young people are having a hard time. By the way, if you look at the youth unemployment rates now up, I think it's 8.5%, maybe a little bit higher than that. Young people graduating, you saw was at UMich or one of the surveys that showed people graduating college. It's the toughest time in literally a generation. So listen, I think there's some things, I think a lot of this is related. And I think a lot of this is, if we create an issue, I think Danny's question before that was dead right. There is something that that are just hard to fight against. But I think there's a series of things that I think that can be done that will improve a bunch of things. And by the way, the thing that is critical, nominal GDP has to be high because we have a debt burden in this country that is large. And if we keep nominal GDP high, we keep employing more people, you bring that nominal GDP number up, which diffuses the debt burden.
Rick, if we could talk about your other child, which I realize is less important than your grandchild, but still important for these markets. It is Bink. Matt has pointed this out. The fastest growing active ETF. You're talking about some seismic changes.
In history.
In history,
of ETFs,
in the world.
which is huge. There's still more ETFs than stocks.
And a lot of active ETFs too, so that is a big deal. And I'm assuming you're going to have to position this for big changes, lower rates, maybe changes with MBSs, or mortgage-backed securities, which I know is part of this. Maybe a tariff ruling, which could also change what this bond market does. And this brings me to a viewer question that someone wrote in. What is the best part of the curve that is the best place to invest for total return in 2026? How are you thinking incorporating that idea into Bink in 2026, Rick?
By the way, it's always funny when the chart that goes up that shows the price of Bink, it doesn't show the dividend yield. My job is to create as much dividend yield, as much income as possible. Listen, I think, there's something, by the way, there's always an interesting thing about, people say, why is he saying that the funds rate should come down? He must have an ulterior motive. I actually don't want the funds rate. In fact, I don't want interest rates to come down because commercially, these yields are phenomenal. I mean, these yields to create income in a portfolio, we can create 6.25%, 6.5% yield by being and staying high quality and staying, I think Bink is running a low single A rating, which is pretty amazing with a less than 4-year duration. Anyway, if we can just keep that yield up, so what do you do to do that? You reduce a little bit. We've reduced a little bit of high yield. We've increased a bit of emerging markets. We think the dollar is contained. We have talked about on the show. We like mortgages. Quite a move today. I don't know at these levels, but increase your quality, and you could still run yield that is pretty significant in the portfolio, and be global. Look at interest rates around the world, particularly Europe, where you can, as a dollar investor, is quite attractive.
Is it, by the way, as you grow this quickly, we were just looking at the Eric Balchunas tweet there, and I have to think he's the foremost ETF analyst, most respected ETF analyst in the world. Is it more difficult as it grows to manage, or is it just such a huge space that you can't get that big?
Yeah, I mean, so by the way, it does, you think about in size, it's a fantastic question. There's a couple of things. First of all, part of why mortgages become more interesting is because they're so liquid and the size of that market is so expansive. You do think about other things, though, as you get larger that you can do in your portfolio where we can, we do a little bit more bespoke. We tend to keep this very liquid, but we can do a little bit more bespoke because of the size of it. So that gives us a little bit more flexibility. But there are some markets that are clear, like the CLO market or others, that you think about, how big do you want to be in certain markets? So it does evolve a little bit at scale. I think there's a lot of things that make it easier to do it. I'd say on balance, it's a little bit easier at scale, but you do evolve it a bit in terms of how you're managing it, for sure.
Rick, how are you thinking about positioning heading into what might be a decision today on IEPA from the Supreme Court if we don't have as much revenue coming in, and if it is ruled illegal? What kind of changes could you see to this curve?
Yeah, it's a great question, and so first of all, a couple of things. This has been out there for a while. I mean, whether it's today or when it comes out. I will say one thing. I mean, we buy, including recently, we buy a lot of volatility in the equity market because, well, quite frankly, volatility is cheap in the equity market, whereas I think it's high in the rates market. But we buy a lot of volatility. We have been recently as volatility's come down, as you all talked about. Stocks go up, volatility comes down. So we have built a decent amount of protection in as people interpret it. I've talked about on your show before, I tend to like the front to the belly of the yield curve, particularly after a number like this, and they cheapen it up a little bit. The long end of the yield curve, not that interesting because of the volatility it gives you. So a few things around the edges around, gosh, can you hold a bit more front to belly of the yield curve? Can you buy a bit more volatility, protect some downside? And we were talking about in fixed income, maybe you go a little bit higher quality for the time being and wait for things to play through.
We had Stephen Myron on. He was on Surveillance yesterday, and he thinks that the Fed is still 150 basis points too restrictive. What are you watching in the data that could prove that out? Or what do you need to see in the next prints to show that the Fed is really behind the curve here?
I mean, I'm pretty resolute in my opinion. I've been for many months that I think 3% is a no-brainer in my mind. In that is an equilibrium rate. If inflation break-evens don't trade a lot. I'm not sure they're a great benchmark, but they're 2.3%. You're still above inflation break-evens. If you say, given what the labor market is telling you today, given that inflation, most of what is in inflation today is non-cyclical in services. We talked about shelter, and you can actually, if you drop rates, you bring shelter down. You build shelter, inflation down. But things like healthcare, education, insurance, trash, and et cetera, like these things are not interest rate sensitive. So I don't think inflation is, we're going to hurt inflation by getting that funds rate to any lower, because of so much of it is non-cyclical in inflation. So I think 3 is certainly a place you can rest. Whether we have to go lower, I guess to Danny's question about like what is over, if you have an economy that's not running 5% nominal, and we start slowing because the fiscal tailwind becomes a headwind, does the neutral rate have to be closer to 2? I think time will tell. But I don't think we have to go that much lower today. But I don't know, if it was me, I would get the rate to 3. I would be focused on longer on the yield curve, because that's where real velocity in the system works. That's where we finance mortgages, credit, virtually everything in the system finances out the curve in the 5s to 10s roughly.
Hey, Rick, if I may, and I've got to ask, because a lot of people listen to you, really appreciate your opinion, and want to know if it will be you part of making that decision. The Treasury Secretary yesterday said that you were one of the sole candidates who haven't yet had your interview. Might you be headed down to Washington, D.C. anytime soon?
Yeah, no, you anticipated my answer. I am focused on my family situation, as we talked about, in terms of, and then, this is the busiest time, quite frankly, I've ever seen in terms of what we're doing. We've got a lot of year-end stuff we do, markets, funds were evolving, et cetera. So I don't know. I know it's a bad answer, but that's where I've never been more busy, so that's what I'm doing.
Well, Rick, I think I can speak for the entirety of the Open Interest family and wish you a congratulations to you.
Oh, thanks.
And
yes,
your
congratulations.
Family. Rick, thank you so much for joining us today. That's BlackRock's Rick Reeder. All right, let's get a check on your equity market this morning. We're up 1/3% for the S&P 500. Look at the Russell 2000. Matt, it is up more than 1%.
Yeah.
Even though we had an unemployment rate come to 4.4% and wipe out the chances of a January cut. Small caps still on fire this morning.
I mean, we've heard so many people on all sides of whatever spectrum you like. Because I was listening to Claudia Sahm this morning on surveillance with Tom and Paul, and you just heard Rick Reeder. Mike McKee, I think, laid it out. Even though 4.4% is lower than it has been, the trend is still higher with unemployment. And I think the market is reading 50,000 jobs added as low. That's why we saw initially a spike in yields, because—
And revisions too.
Yeah, it looks like the Fed could add to the narrative that the Fed still needs to cut rates.
Yeah, and especially when we have a new Fed chair. Let's continue the conversation. Joining us now is Deputy Secretary of Labor, Keith Sonderling. Keith, it does feel like a choose-your-own-adventure set of data. What are you concentrating on this morning after the release at 8:30 a.m. of unemployment?
Well, good morning, and thank you for having me. I'm excited to talk about this jobs report because what we've seen is continued positive job growth. It came in at 50,000 new jobs, exactly around where the market was predicting, and that shows that President Trump's economy is strong, that there's job creation, and if you even look back for the year as a whole, we saw that net job gain, and that's what we're excited about because that's benefiting American workers, and that's what our mission here as a Department of Labor is to make sure that the Americans are getting in the workforce, getting the jobs, and have the skills and training we need, and that's what we're seeing.
Keith, I just want to jump in because you talked about the net job growth of last year. Payrolls climbed 584,000. That's the weakest since 2020, when, of course, they were plunging because of COVID. And if you look back past the pandemic, you don't see annual increase of payrolls that low through the entire expansion through 2010 through 2019. Keith, couldn't you look at that and say, sure, jobs were added, but it wasn't that robust?
No, jobs were added in the right place, 654,000 in the private sector, negative job growth in the government sector, which is exactly what President Trump promised, to right-size the federal government, to get jobs back into the private sector, and that's what we're seeing. And especially with unemployment rates coming down and wages going up, that's the metrics we're looking at, and that's what we're excited to see from this report, and so is the market.
We still have seen manufacturing jobs. We lost almost 100,000 manufacturing jobs in 2025. And this was a sector that I think the president, it's fair to say, is very focused on. He wants to bring manufacturing back to these shores. Why do we have what looks like a manufacturing recession a year into his term?
Oh, well, look, what we're doing here is we're expecting significant manufacturing jobs. We're expecting significant reshoring. And here, because of the president's policies of bringing foreign dollars and bringing trillions of dollars in to this country, which we're going to see this year really come to fruition. We're seeing groundbreakings at factories. And as I travel across the country, what I see is that enthusiasm for those jobs coming back. But first, the infrastructure investments have to be made. We're seeing that. Companies are excited to hire American workers. They're excited to build in America, whether sectors across the spectrum here. And that's what we're focused on in the Department of Labor, is for each of those, whether it's first construction, then manufacturing, for each sector that's coming back, we want to have the skilled American workforce. And that's what we're focused on with historic investments in skills trades, in apprenticeships, in Pell workforce grants, because we know those jobs are coming back. It's just those investment dollars are coming in, and then we're going to see a boom in construction and manufacturing this year.
Right, and you know, just to underline Matt's point, we certainly didn't see that in the last report with construction, manufacturing, transportation losing jobs. Or we did see jobs added, Keith, though, was the federal workforce, nudging up by just about 2,000 roles. Is the DOGE effect over? Are we now switching to net hiring? Is that what we should be expecting from this federal government?
No, look, for the federal government, with the voluntary resignations, people leaving, we saw huge decreases at certain points. And, you know, from across 2025, which is what the president promised, to right-size the government, that's exactly what happened. So at the end of the year, that number was significantly down for these federal government agencies to be able to operate at full function, which they can with the right workforce. And that's what we saw from the overall job numbers from last year in the federal workforce.
I wonder if you still think, you know, if we go with the narrative that the economy's hot, we're adding jobs, everything's fantastic, do we really need the Fed to cut rates? Because in that case, they don't seem too restrictive. How do you kind of square that circle?
Look, that's up to them. The president has been very clear on what needs to happen there. And inflation is down and wages are up. And that's really what our key metrics are at the Department of Labor. And we see that the GDP growth is better than expected and continues to be better expected. And what that's going to lead is to more jobs. And I promise you, the Labor Department will be there to skill those workers so American workers get those jobs. They have the underlying skills that they need, which they've been neglected before, but not any longer, because we know those jobs are coming and we want those jobs to go to Americans. And that's what we see consistently in this job report in this administration, is net gains in native-born American workers, which reverses that trend, which was going the other way. And we want those Americans to get the opportunities and have the skills, and that's our commitment when those jobs come.
Okay, Keith, thank you very much for joining us. Unfortunately, we're going to have to leave it there. Labor Deputy Secretary Keith Sonderling. And later today, Energy Secretary Chris Wright will be joining Balance of Power at 5 p.m. Eastern Time after oil executives head down to Washington, D.C. for meeting with the president. You're watching Open Interest.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now, though, If you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
It's Jobs Friday and maybe potentially tariff ruling Friday too. Jobs come in, the growth there was less than expected, but so was the unemployment rate. So you're getting this picture where the S&P 500 gains 0.2%, but bond yields perk up too. Two-year yields now near the highs of the session, up just under 3 basis points. Same goes for the 10-year yield. Joining us now is Alex Pichon, head of fixed income at Rockefeller Asset Management. Alex, I gotta just say, like, today could be a very consequential day for this bond market. We already have the jobs report where yields are set higher, but maybe a ruling on IEPA. For you, what's more important for this market?
So I think a lot of things that we look at, particularly in the area that we're focused right now, we've been heavily focused on the municipal bond market. We think about technical factors, supply and demand, driving markets. What we've seen to start the year is there is surging demand for municipal assets, certainly within the ETF space as well. And so that demand, absent overwhelming supply, is what will continue to drive performance in our market. It will drive municipal to treasury ratios lower. It will drive whether we really react to any material changes that we might see today, tomorrow, or in the coming days.
So looking at Muni's performance in 2025, how do you expect 2026 to play out?
What an interesting year for performance, Matt, in munis. And if you're not diving in every day, you maybe miss the fact that investment grade munis outperformed the high yield muni index. That is unusual. A key driver of performance
weird.
Right? You're probably thinking about this often. A key driver of performance within fixed income, we all know this, we heard this earlier from Rick Reeder, is income and yield. And the yield on the high yield muni index per Bloomberg is about a 552 today, tax exempt. The yield on the investment grade index is closer to a 348, tax exempt. Now, if you really dive into what happened within high yield munis relative to IG last year, if you look at a couple of key sectors, tobaccos, or you look at a handful, really one very storied credit, that is the story there. So passive muni strategies, passive muni ETFs, or those who just hug the benchmark in active management really underperformed. When I think about the performance story next year for both high yield and IG, active management likely to win, and your returns are likely to look like the yield to worst on the benchmark, right? That is the source. That is pretty compelling in munis relative to taxable fixed income for U.S. tax-paying investors, right? You're starting to talk about 9% plus tax equivalent yields in the high yield muni space. So we think it really benefits investors to lean into the opportunities.
One, I think that's so interesting because that has been a big transformation over the past decade of finally market participants wanting to own actively managed ETFs. And obviously the outperformance helps. But with that demand, is there a risk that the fundamentals do come unglued, that there is some disconnect, that the demand keeps spreads artificially tight?
So that already exists, whether we're thinking about or open-end funds. When we look at the municipal market, there is no better home for active management. There's actually also no better home for ETFs and active management, because why are U.S. taxers in munis? For the tax efficiency. What is the best wrapper for that? Likely an ETF. When we think about our market, it is one of the most diverse markets out there. 40,000 active issuers that range in size from issuing a few billion to a few million, right? 5 to 10 million. Our view is really simple. In that market, yes, there will be pockets where there are stresses, either large issuers or small issuers, sectors as well. But if you are actively managing your risk, disciplined bottom-up fundamental analysis, relative value overlay, you can find opportunities that are away from some of the fundamental challenges. And if you look beyond the index returns into the dispersion among managers, you start to see the difference. So that's where I get to that comment around benchmark hugging. versus saying, maybe I don't want to own some of these large global issuers that are index eligible. Maybe I want to own something different.
We're showing the Index Go function, which I'm sure that you spend a lot of time on your Bloomberg looking at this. And I'll ask you the cocktail party question, which is, how are municipalities doing? You know, which are doing the best, which are problematic?
So it varies across the board. You're going to have general obligation debt that's doing quite well at the state level, but it may not be doing well at the local level. You're going to have localities that are doing well, but you might have certain counties that are not. Within the healthcare sector, there are pockets where I would say avoid risk. Small, single-site rural healthcare centers probably are going to bear some of the challenges that we see already unfolding over the last 5 years. And then you could look to some of the larger issuers that credit fundamentals are strong. This is a market where it truly is bottom-up credit analysis, not ignoring any sector, not ignoring any obligor, but being tight.
Alex, great having you here with us. Thank you so much for joining us. Alex Petrone of Rockefeller Asset Management, talking munis.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
circumstances surrounding a shooting by Border Patrol agents yesterday. Husband and wife were wounded in a traffic stop that the Department of Homeland Security says was targeting a suspected Venezuelan drug gang member. Now to officials in Minnesota who speak this hour, correspondent Usher Qureshi.
Initially, the investigation was supposed to be jointly conducted between the FBI and state authorities here in Minnesota. That changed when the FBI, according to a statement from those state authorities, said that they would block them from having access to interviews, case material, body cam, etc. The governor has said that they want access. They want to be part of this investigation. They may take legal recourse to try and get access.
Iran's supreme leader says President Trump's hands are stained with the blood of Iranians as thousands continue protests that have spread out across the country. Correspondent Holly Williams is at the foreign desk.
Iran's internet was cut off last night, possibly an attempt by the Iranian regime to prevent people from posting videos online for the world to see. More than 40 protesters and security personnel have been killed in the demonstrations so far, according to human rights monitoring groups, though we cannot independently confirm those numbers.
Demonstrations began over Iran's struggling economy. At least 50 people have been killed. Hiring cooled off at the end of the year. The Labor Department says employers added a fewer than expected 50,000 jobs. Economist Constance Hunter.
We have a lot of uncertainty with regard to the geopolitical landscape, with regard to the economic landscape in so much as tariffs. And so that uncertainty usually causes firms to slow down.
Unemployment fell from 4.6 to 4.4%. Now to a big jewelry heist in the South. Jim Crisula.
Police in Cape Coral, Florida, near Miami, say two men bore through the wall of a neighboring store's bathroom to break into a jewelry store. They made off with more than $500,000 in inventory and two guns after restraining and assaulting the store manager. Their haul included more than 1,000 pieces of jewelry.
Dow is up 110 points. This is CBS News. The University of Miami will play for college football's championship.
Miami quarterback Carson Beck ran for the deciding touchdown with 18 seconds left in a 31-27 semifinal win over Ole Miss on ESPN.
Takes off only Carson Beck with his legs. Puts Miami on top.
Beck later in the face of adversity. When we had to respond, we responded.
Feels real good to be a Cane, baby. I'm so proud of this team. I'm so thankful for all these fans, man. This is who we do it for, man. The whole city.
The Hurricanes will play the winner of tonight's Indiana-Oregon game for the national title. Steve Kathan, CBS News.
The Princess of Wales says she's grateful.
Come to peace with our tears and discover what it means to be alive.
Middleton's nature video celebrates her 44th birthday. Just 1 year ago, she announced she was in remission from cancer. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well, so check us out there. This is Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. We had some economic data today, Scarlett, but we're not going to be hearing from the Supreme Court. They will not issue a Trump tariff ruling today.
Yeah, we thought that it could come as early as today, but the Supreme Court, maybe they're thinking about a strategic rollout. They can afford to wait. They know a lot of people are looking for some kind of ruling.
Yeah, absolutely. And so perhaps next Friday, so we'll stay on tap for that. So it's not going to happen today. Joanne Shu's going to join us here because the University of Michigan, the survey's consumer director, they did release their data today, so we'll take a look at that. We also will play up to that. Emily Rowland, co-chief investment strategist for Manulife John Hancock, talk about her thoughts on these markets and what the jobs report will mean to the Fed here going forward. So we got a lot coming up there. Josh Wingrove, Bloomberg News senior White House correspondent. The big take story of the day, President Trump orders big oil into Venezuela. Do it for our country is what the president is saying. And as we see in Washington, D.C., executives for these big oil companies will be meeting with President Trump. The full reporting on that as well. So a lot coming up over the next couple of hours. Again, the jobs data we'll get into is kind of mixed. Unemployment rate down, but some negative revisions. So we'll break it all down over the next couple of hours. And we'll kick it off with John Tucker and a Bloomberg Business Flash.
All right, guys, this flash brought to you by IBKR. Will President Trump nominate Kevin Hassett as Fed chair? At IBKR forecast trader, the yes was recently at 77%. Start predicting today at ibkr.com/forecast. Last trading day for this contract, January 21st. 2029. Well, let's start off with the data. Joanne's going to take a deeper dive, but the headline number, the University of Michigan Sentiment Index, ticking higher, 54 from 52.9 from the prior reading. The expectation was for 53.5, so a little better than expectations. I go right to the inflation numbers. The one-year inflation expectations, 4.2%. That's exactly matches the last reading we had, but it's higher than expectations. And the 5 to 10-year inflation expectation, 3.4%. The expectation there was 3.3%. The other big data point you mentioned, Paul, employers adding fewer jobs than expected in December. Non-farm payrolls increasing 50,000 last month. The unemployment rate edging down to 4.4%. And right now, as we look at the screen, Vistra, the best performing stock of the S&P 500, that was up close to 15%. The company disclosing a power purchase agreement with Meta. And right now, we have the S&P 500 just 2 points higher, 69.23. The Dow's turned lower. That's 65 points lower. That's down 0.1%. And the Nasdaq Composite Index, 39 points lower, down 0.2%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Let's take a look at some of the stocks on the move. Today, we're joined by Bloomberg's Christina Aquino. Christina, what are you looking at today?
Let's take a look at Vistra, Paul. Biggest gainer in the S&P 500 today, so ticker VST. Those shares are up more than 13%, set for the biggest gain since April 2025, and that is because Meta is in fact out with a deal to purchase electricity from 3 existing Vistra plants. So Vistra is actually part of a bigger deal by Meta to purchase and just make a lot of electricity deals with a bunch of providers, right? And this is essentially their play to be the biggest buyer of nuclear power among its hyperscaler peers. And, we don't know actually what the agreements are worth, but analysts are saying that this could easily represent billions of dollars in total revenue for some of these electricity generators. This is why we're seeing such a big increase in the shares today.
Yeah, it's had a pretty volatile run this week. Up 4% on Tuesday, down 9% on Wednesday, but for the week it's up about 4%.
Such is the life of a power generator.
Well said. All right, next up on your list.
Let's take a look at GM. That's not doing too well today. So ticker GM, those shares are down 4.5%, and that is because the company continues to take a hit on its EV investment. They said that they will take another $6 billion in charges tied to production cutbacks in its electric vehicle and battery operations. So we got that announcement yesterday, actually, but the shares are reacting today. And that brings the total write-downs from GM's bet on battery electric cars to $7.6 billion. Ouch. And again, this just reflects the broader challenging environment for electric vehicles. We do, of course, know that President Donald Trump's administration has moved to eliminate federal support for EVs. The latest tax and spending bill, if you recall, scrapped $7,500 of federal tax credits for EV buyers, and GM's feeling the pain.
How about Southwest Airlines?
Southwest Airlines, ticker LUV. So that's not doing too shabby this morning. Shares are up 2.5% at the moment. It got a pair of upgrades at a number of shops. So JP Morgan raising that recommendation on that stock to overweight from underweight previously. And they're seeing an increase potentially in its earnings per share guidance, earnings season coming up. So we're going to be keeping an eye on that. Susquehanna also raising the price target on the company to $45 from $35 previously. Current price is $44, but that implies about a 5%, 4.8% increase from the last price.
All right, good stuff. Christina Aquino, thank you so much. Bloomberg Markets Live Managing Editor joining us with our Stock Movers. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. You can subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So big data points today, Paul, on this Friday. Of course, jobs was primary one, but it's a little bit dated because it's backwards looking, and you can question how clean it is.
Right.
Consumer confidence is the other big one,
and
people seem to be feeling better.
Yeah, I'm just looking at the University of Michigan data. Came out, University of Michigan sentiment data came out with a reading of 54. Consensus was 53.5, so a little bit better there. Let's break it down with Joanne Shu, Surveys of Consumers Director at the University of Michigan. Joanne, what did you take away from some of the data today from your surveys?
Consumers see a little bit of improvement over the last few months in the economy. However, we're still near historic lows in consumer sentiment. So consumers are still feeling pretty tentative about the trajectory of the economy. Overall, they continue to be concerned about the pain of high prices, but at the same time, their inflation expectations seem to be stabilizing right now at much lower levels than we were seeing back in April and May when tariff announcements were peaking. But we're not out of the woods. Consumer views of inflation still exceed what we were seeing at the end of 2024, beginning in 2025.
Joanne, does there tend to be any kind of seasonal pattern for how consumers feel at the beginning of a year compared with, I don't know, middle of the year or end of the year?
It really depends on what's going on in the economy right now. One of the main things that we're seeing is, a gradual decrease in concerns over tariffs. We saw a decrease in the share of consumers spontaneously mentioning tariffs. But again, high prices continue to be the primary factor that's weighing down people's personal finances as well as buying conditions for large purchases.
Interest rates are coming down, maybe more slowly than maybe some people would like, but the interest rates are coming down. Is that reflected as a positive in your survey?
We have seen a modest decrease in the share of consumers pointing at expensive borrowing costs as a negative reason, as a negative factor for big ticket purchases, but it's not coming down a lot. And I think that is consistent with the fact that these interest rate cuts have been pretty gradual and have not necessarily passed through to things in a major way to consumer facing loan products. Certainly if interest rates that consumers face continue to fall, that will certainly be some relief for consumers. But at this time, it really is high prices that's dominating their thinking.
I mean, when we look at the consumer sentiment rising to a 4-month high, that is an aggregate. But what you do at University of Michigan so well is to break it down by people's political leanings, Democrat versus Republican versus independent. What does that show when you look beneath the headline number to see how people on the left?
So the improvement we saw in January was actually seen among Democrats and Republicans alike. On both ends of the political spectrum were in agreement that things were a little bit better. So that is something that we're seeing across the political distribution. independents, they actually fell a little bit, but we'll see what happens by the end of the month.
To give us some context, Joanne, I mean, we have the reading today of where would sentiment look like? Is that a 70? Where's it historically been?
That we saw in the middle of 2020, 0.0. Where we were just 1 year ago. So we definitely want to see some sustained increases. Highest in 4 months is certainly a good, something that is good to see. However, it's not necessarily, that does not necessarily end the story. We want to see continued increases. We want to get out of the 50s as soon as we can, and we want to see sustained upward trajectory.
And so much of that depends on how secure people feel about their own employment. We got a jobs report today from the government that showed a smaller than expected increase in the U.S. economy, although the unemployment rate did decline. What did your survey reveal about views on the labor market?
Consumer views about the future of the labor market have been weakening and softening over the past year, and this month is no different. In December, we had 63% of consumers expecting unemployment to rise in the year ahead. January, exactly the same thing. What's really interesting is that these weak views of the labor market are seen across the distribution of income as well as education. So it's not just that lower income, less educated consumers are worried about labor markets and no one else is. We actually see quite a bit of concern at the top of the income and education distribution. Even college educated consumers have elevated worries about job loss in the years ahead.
And that's what we've heard a lot of reporting about the recent college graduates facing a tough entry market there. So it is, again, across all educational levels. Joanne Shu, thank you so much. We appreciate it. As always, Joanne Shu, she is Surveys of Consumers Director at the University of Michigan. Again, the headline number for UMich sentiment, a little bit better, 54. The consensus was 53.5. Last month was 52.9. So as Joanne said, some improvement here, but still better, or would reflect the outlook on consumers. Next on the screen, S&P up 14 points, the Dow minus 8. NASDAQ up 51, kind of mixed on the back of that. We'll have more coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It didn't take much, but stocks pairing some of the earlier gains with a much anticipated Supreme Court decision on tariffs. It did not happen, so that's why we paired some of the earlier gains. A negative ruling would have offered a boost for equities and also removed a key earnings overhang. Right now, you have 9 of the 11 major industry groups in the S&P 500 still higher. Utilities, the best performing industry group, and that's because Meta is signing a series of electricity deals. And as such, Vistra is one of those, that the best performing individual stock in the S&P 500 right now. Vistra is up close to 14%. And then you have possible takeover news. Revolution Medicines up close to 5%. Merck in talks to acquire them, and that's according to the FT. S&P 500 up 26 points. The Dow up 104. The NASDAQ 100 up 131. The 2-year yield up to 351 right now. The 10 is pretty much unchanged at 417. Paramount Skydance wants everybody to watch their MTV again, apparently.
Really?
They're looking to revive MTV, and they're also looking for the music industry help. So something's in the work.
Just replay Duran Duran videos.
Yeah.
Do you remember, what was the, everybody out there should know this,
Yes.
the first MTV video.
Video killed the radio star.
By the, what was the name of the band, the group?
Goggles, Googles.
The Buggles.
Buggles, that's right.
Excellent. Scarlett. 10 points. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you.
Stuck in my head now.
I know,
Thank
exactly.
you.
I love that song.
Yeah, I remember when the first day of that thing, that was big. And that got just big in the next 20 years. It was just huge. And then time passed it by. All right, John Tucker, thanks so much. We've got Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker studio. We are streaming live as well on YouTube, so check us out there. Lots of economic data today. Market's a little bit higher here, but let's see how the pros are interpreting it. Emily Rowland, Co-Chief Investment Strategist is at Manulife John Hancock Investments up there in Boston. Emily, we got some jobs data today. We got some UMich sentiment data today. The market seems to be kind of taking it in stride. Does this change in any way kind of how you're viewing the economy or how some risk assets may perform in 2026?
No, I mean, the jobs report was a bit of a nothing burger. It was a mixed report. You know, of course, everybody was focused on the unemployment rate. That did come down a touch. I would point out that that lower unemployment rate could have been flattered by the participation rate falling a little bit. So when there's fewer people looking for work, that can actually bring that calculation down. So we want to think about that. But regardless, the market liked the lower unemployment rate, but there were some negatives. We had negative revisions to the last couple of months to the tune of, 76,000. That's not great. And the breadth continued to disappoint. So hospitality and leisure, and most importantly, healthcare, continuing to drive the bulk of the gains. If you look at 2025, broadly speaking, we would have had negative jobs growth if it weren't for the healthcare sector. So I would call it like an okay jobs report. It certainly does take a cut in January here off the table.
Yeah, and in fact, this jobs report kind of backs up that whole idea that we have this low hire, low fire labor market.
Yeah.
So if it removes the possibility of a January cut, we're looking at traders still keeping their outlook for 2 cuts this year with the first by mid-year. How does this set up expectations, positioning, and how people are thinking about the release of inflation data next week?
Yeah, so inflation data we're hearing may still be sort of distorted given the government shutdown. So I still think it's going to be taken with a little bit of a grain of salt here. But to your point, bond market's expecting 1 cut in June and another one in September. We still think that bonds offer a lot of value here above 4%. Frankly, the bond market is really not budging based on disinflation data that we're seeing. You know, we saw it this morning in wage growth sort of holding steady. There was a fear that wage growth was going to pick up. We're also seeing some disinflation come through on the housing or shelter side of the CPI equation. So we'll be watching that really closely. If you look at some of the real-time measures of housing, they're showing a lot more slowing than sort of the official BLS data is telling us. So things like Zillow and Apartment List are telling us that the shelter component's closer to flat on a year-over-year basis. We don't really think that bonds are picking up on some of that. So we're leaning into fixed income here on a high-quality basis. Given those elevated yields, we do expect yields to come down over the course of the year.
So, Emily, if we think about 2025 and looking ahead to 26, boy, 25 was a great year in equities, very strong year in fixed income. How are you and your teams there kind of thinking about 26 in terms of where the opportunities are?
Yeah, so we're constructive on stocks. You know, I think that there is a number of catalysts in place. You've got the One Big Beautiful Bill, which could help potentially bring the effective corporate tax rate down through that immediate depreciation of CapEx. We think it's modestly accretive to the consumer as well. If oil prices can come down, that's sort of another positive. A weaker dollar would also be kind of the gift that keeps on giving into 2026. 40% of the revenues of S&P 500 companies are derived from overseas, so the weaker dollar helps on that front as well. The challenge, of course, though, is the starting point at, 22 times forward earnings. It's going to be tough to get any more multiple expansion. So earnings really does need to be the key driver. And then on the fixed income side, like I mentioned, I do think bonds are mispriced here. So I think bonds can do some more heavy lifting in portfolios with incomes in the 4 to 5% range on high quality bonds.
When it comes to equities, we get earnings next week. The fourth quarter numbers come out, and of course, the big banks will start us off. What do you think we'll actually learn from these banks, especially given that we can't really rely on a lot of the data? As you mentioned, the inflation data next week might still be kind of messy.
Yeah, analysts are expecting high single-digit earnings growth, so the bar is not crazy high coming into this quarter. I'm just excited to talk about earnings and not geopolitical developments, Scarlett. I don't know about you guys, but that's going to be really refreshing for us. And, as long as the economy and the labor market continue to hold in, we think cyclical areas of the market like financials can do just fine. They're also benefiting from the wealth accumulation that we've seen. So in a strange way, the market has been in the driver's seat of the economy. So we've seen just incredible consumer net worth being built up. It's in stocks, it's in real estate, and all of that sort of wealth accumulation and appreciation is in a way impacted or helped the financial sector. So the AI trade, which has buoyed investors' portfolios, is actually feeding right back into the cyclical side of the U.S. economy, benefiting the banks. So we think banks are going to come through with some positive developments, given the strength of the consumer, given the strength of the labor market, and given the strength of the stock market.
Emily, how about U.S. versus non-U.S.? We saw as strong as the equity performance was in the U.S. in 2025, and much of the rest of the world, it was even better than that. We're hearing even people over the last 12 months talk about high yield, emerging market debt as well here. How do you think about the global allocation these days?
Yeah, Paul, a lot of it does come down to the weaker dollar. The dollar was down almost 10% in 2025, and that can be hugely accretive to international equities as you're a U.S. unhedged investor. It was pretty remarkable to watch the momentum that got built in overseas markets. I mean, you had things like the Kospi and Spain, up 80, 100% last year, really on technicals and momentum. It's just we're living in this world of momentum where you sort of trade first and ask questions later. When you look at the fundamental backdrop for non-U.S. equities, it's like, okay, earnings were about 3% last year. I don't know that justifies a 30+% return in Europe on 3% earnings growth. The economic data have been, I would say, mediocre. We're in sort of a malaise if you look at things like PMIs overseas, yet those markets are booming. It is tough to stop this momentum trade train, I guess, internationally right now. So we do have some exposure there. If the dollar weakens, we think it can help non-U.S. equities, but we see better earnings growth prospects here in the United States.
All right, Emily, thank you so much for joining us, and have a great weekend to you. Emily Rowland, Co-Chief Investment Strategist for Manulife John Hancock in Boston. Let's go back to the tech sector. We can't stray too far from it ever when we talk about the market. And take a look at some of the Mag 7 names. Alphabet this week has moved ahead of Apple in terms of market cap, and Meta signing this big power generation deal with this company called Vistra. It's a volatile week. Let's bring in right now. Mandeep is our global Bloomberg Intelligence. And context for us, this gigawatt nuclear deal that has signed for its AI data. How should we think about this?
Yeah, I mean, the best way to frame it is how these companies are spending their capex. And we know roughly, 1 gigawatt of AI data center capacity costs about $50 billion. Again, it depends on the region, the source of energy and land, et cetera. But that's a rough ballpark. So when you think about 6.6 gigawatt, and we already know OpenAI has committed to, about 26 gigawatts. So clearly these companies have big ambitions, and what it suggests is a company like Meta, which will very well spend over $100 billion in capex this year in 2026, may stay on that path for at least the next 3 to 4 years because they believe, they have a lot of applications when it comes to their own consumption of AI data centers, and they seem to be confident about their own model, which has so far trailed the likes of OpenAI, Anthropic, and Gemini in terms of capabilities. But it sounds like they want to make sure they have the capacity to deploy AI, and that's where nuclear is an interesting choice because a lot of the other hyperscalers have gone for more natural gas turbines, but we know there is a big backlog with someone like GE Vernova for their natural gas turbines. So from that perspective, nuclear is an interesting choice, as an alternate.
What are the big tech companies, these big AI companies, saying about their confidence in the reliability of power in the next 5, 10, 20 years? Because a lot of folks are saying that really could be the gating issue for the development and evolution of AI.
Yeah, I mean, look, I was at CES where Jensen highlighted, the reason why companies would upgrade quickly to the latest Rubin architecture is because they Rubin will give them more tokens per unit of power, which is really a way to emphasize the efficiency of how you utilize your available power. And so from that perspective, everyone sees very long lead times when it comes to adding new power, and they want to maximize, the usage and utilization of whatever they have right now. And look, you could argue, there are some other sources which may have shorter lead times, like solar or battery packs. But in this case, given the size of power that these companies need for running, we're talking about 1 gigawatt data center. It's very hard to think about too many sources of energy that will give you that sort of power. And, that's where the lead times are so long.
All right, Mandeep, thanks so much for joining us. Appreciate it. As always, Mandeep Singh, Senior Tech Industry Analyst for Bloomberg Intelligence. Again, kind of a cool deal here. Meta buying a bunch of electricity capacity to fuel its data centers in the future. I'm probably going to see more of these types of deals from these big users of energy. S&P up 37 points, the Dow up 175, the NASDAQ up 155, that's 0.6%. So a nice turnaround in the markets here. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. I'll just throw this headline out there. President Trump posting a chart on social media last night, and it included figures in the yet-to-be December employment report. The president is typically briefed on the numbers a day before their publication, but it's verboten to share them with anybody. We did have word this morning that the Supreme Court won't be issuing its tariff ruling today, so that took some of the steam out of the stocks. Maybe we could get a ruling next week for the Supreme Court on tariffs. With the Meta agreement, Vistra is the best performing stock in the S&P 500. It's close to 14% higher right now. Overall, you have 10 of the 11 major industry groups in the S&P 500. They are up right now, and with Vistra Utilities right now, they are the best performer. And at the bottom of the list right now, the worst performing industry group, the financials. The S&P 500, 28 points higher. That's up 0.4%, 6950 on the index. The Dow Jones Industrial Average up 104 points. The NASDAQ 100 up 142. The two-year yield, well, let me do the 10-year right now. The 10-year yield is unchanged, 416. The more policy reactive two-year yield, that's up a basis point at 350. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, the U.S. oil industry executives, they're being summoned today to turn Trump's vision into reality. But executives are wary of the scale of work required in Venezuela, where they would confront decades of abandoned rigs, leaky pipelines, and fire-ravaged equipment. That is the subject of the Bloomberg Big Take story today on the Bloomberg Terminal and at Bloomberg.com/Big Take. These are our favorite stories, always great, researched and written. Lots of great data in there as well. Josh Wingrove joins us, senior White House correspondent from Bloomberg News. He's down in D.C. So, Josh, hey. I guess the oil executives are making their way to Washington, D.C. today, to the White House. What are the expectations? What are we hearing from these big energy companies about investing once again in Venezuela?
Well, I think we just would characterize it as, the champagne remains corked, right? There's questions as to how many of them want to go in and what guarantees they would want, in particular from the U.S. government. Are those backstops? Are taxpayers going to be on the hook? I mean, all these questions are really swirling in the air. Now, Trump himself sees this as sort of a gold rush opportunity, right? He has complained forever about the U.S. Leaving Iraq, for instance, without, quote, taking the oil. It's pretty clear that that is like a core goal of what he plans to do now with Venezuela. And so we will see. But it's just very complicated for a range of reasons, including the existing disrepair of that. My colleague Jennifer Deloe is at the White House right now. We'll be covering that meeting with today, although whether they open that up, it remains a little bit unclear to me. But she and I wrote this piece about it with some of our other colleagues, saying, the existing stuff is not in good repair. The expansion itself would be complicated. Of course, there are security questions. Analysts saying, companies can't, risk their workers being put at risk. And of course, the day-to-day relationship between the Trump administration and the existing Maduro-less Maduro administration remains very fluid, to say the least. So, all these things are hanging in the air. Trump sees this as just, a sort of a hemispheric, roll-in of these massive reserves, which really are huge, but the actual production itself is not very huge right now for all these reasons. So getting this thing back up and running is going to take a long time. We're talking billions or tens of billions of dollars. We're talking years or maybe even decades to really ramp it up.
And it's notable that the big oil executives have not said a whole lot publicly. Beyond Chevron, which already has a presence in the country, we haven't really heard anything from Exxon or ConocoPhillips, which are owed money and could presumably go in and spend a lot. What are you envisioning, Josh, or what are you expecting from this meeting then? I mean, is President Trump going to invite the cameras in and kind of force them to commit to spending in front of cameras?
There's been some mixed signals on whether that will happen. We just don't know. Trump has a long record of doing that. He also has a record of announcing things with maybe less than full buy-in or in ways that surprise the people that are at least nominally part of those announcements. So I think anything is on the table. He could call in the press for it. He could speak afterwards. He could post afterwards. You were reading the thing that he, scooped the job data, which is a big no-no, of course, for presidents to do. He's a poster at heart. We could see him post on it. And whether, it's always a question of whether the stuff he's saying has actually, been agreed to by the parties that are supposedly a part of it, or whether the fine print has really been hammered out. We just don't know. Remember, some of these companies were burned to the tune of billions last time they went to Venezuela, and they're, of course, concerned about doing that. Trump sees this as an opportunity to recoup that, but of course the risk is it simply is, Lucy with the football, and they get caught on the hook again.
Does this matter for voters, Josh? Do voters care about this in a way that Trump can use to his advantage for the midterms?
I would say two things. Trump sees upside here because he thinks this will put downward pressure on oil prices. Low gas prices are always good for governments, whether they're Republican or Democrats. But the flip side is Republicans are concerned that Trump might, be focused more on what to do with Venezuela than the everyday concerns of Americans. So that, Trump himself is sort of downplaying that and saying that they can sort of walk and chew gum at the same time. But I think, the core concern here for Trump is like gas prices low equals good politically, and they're coming up on these midterms that he himself thinks will decide whether he gets impeached or not, right? So he thinks the stakes on these are high. But, there's obvious concern about, regime change leaving them on the hook for years and years of trying to figure out what the heck is going on with Venezuela and its oil industry, and that sort of metastasizes into other political problems for them, and Democrats seizing it and saying, he's focused on all these other things abroad instead of focused on you. We're already seeing some Democrats sort of seize on that as an argument.
Josh, we've become used to seeing executives come through and countries for that matter, come through the Oval Office and promise billion-dollar investments there, $100 billion, $500 billion of investments. Do we have any way to track whether any of that's happening? I mean, I don't ever see documents being signed, lawyers huddling together, papering all this stuff out. Are these just announcements, or do we have any follow-up?
Yeah, it's been kind of a customary pilgrimage lately, hasn't it, for these people to go in and do it. It remains fluid. That's how I would say that. Our colleague Sean Donnan and others did a piece a couple of weeks ago, I think, took a good look at that, sort of pressure testing, fact-checking Trump's overall claim. Like, he talks about 17 trillion, 18 trillion. Basically, that doesn't hold water, or at least there's nothing publicly to correlate that. So, that remains the case on a company-by-company basis. For example, we've also been tracking those deals with Japan and South Korea. Remember, they're talking about hundreds of billions of dollars in investment. Haven't seen any of that roll yet. We might start to see that pretty soon. There were some meetings in late December with the Japanese in particular about what their first projects will be. So Trump talks about this all, but it just simply is not sort of on paper yet in a sort of bulletproof way, and we just don't know. But they're pointing to the jobs data this morning. NEC Director Kevin Hassett, of course, may be the next Fed chair, saying, look at the productivity is going up. This is a sign of the Trump economy and the manufacturing in particular. But of course, the administration has shifted to saying, well, 2026, this is going to be the year. The implication that 2025 didn't end necessarily with the boom that they had hoped for, but we'll see. But right now, absolutely, it's the case that these remain verbal pledges, almost aspirational in many cases, as opposed to like hard fine print.
Before we let you go, Josh, the Supreme Court did not issue a ruling on Trump's IEEPA tariffs, its reciprocal tariffs. Was there any, I guess, betting that it would happen today or next week? I mean, we're talking about how the Supreme Court it can wait until the very end of its session to come out with this ruling.
Yeah, there was thought that it might come in December. So when the Supreme Court said today as its first day of rulings, there were, people thought, oh, this could be the first day that it could come. Now we go back to sort of waiting to see when they schedule their next rulings, and we will see. But it's not coming today. I will say that there was a call last night. Hassett talked about it earlier today between Trump economic officials talking about their plan B, and they said today, and they said before that they plan on acting if they lose the case. They think that they will win the case, but if they lose it, they've talked about pivoting to other authorities. Today they talked about Section 301, they talked about Section 122 in the past. Tariffs are going to be a part of Trump's policy.
All right, Josh, thank you so much. Josh Ringrove, our White House correspondent, joining us from our Washington, D.C. bureau. From New York, this is Bloomberg Intelligence on Bloomberg Radio. We're looking at modest gains for the U.S. stock market, the S&P up 0.3%.
is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good Friday morning. This is Bloomberg Intelligence on Bloomberg Radio. Paul Sweeney and Scarlett Fu here with you. And this afternoon, we are waiting for President Trump to meet up with big oil executives. He's called them to the White House. Of course, on the agenda is what to do about the Venezuelan oil that the U.S. has now commandeered and is now looking to sell and bring the proceeds back to Venezuela and the U.S., according to the White House. Let's bring in Vince Piazza. Vince is our senior equity research analyst covering oil and gas for Bloomberg Intelligence. And Vince, do these companies want the oil? That is the question, because in order to get the oil, they have to put a lot of money into fixing the infrastructure right now.
That's a great question. And let me give you the punchline about all this. I don't think I have been more confused in my multi-decades in this business, and my gray hair bears that out. And the calls that we have fielded from the investment community, they're just as confused as this as well. So who wins, who loses, and why? Prompt, near term, no one. Because we just don't have the transparency, we don't have the details to make that decision. Longer term, who wins? If you think about the refining sector in the U.S., those heavy and sour barrels that are typically produced by Venezuela, those will head up to the U.S. eventually, longer term, and that will help the refiners, and that will help their margins, and that should lower gasoline prices over the long term. But again, do you need those barrels, just given how we have transitioned the U.S. From really a gasoline economy into more of an electronified commodity with EVs and such. So no, do we need the barrels right now? Probably not. And is the industry, does the industry want it? Probably not either. So, it is a confusing time, and I probably am more confused now than I was 3 days ago.
Well, maybe we'll get a little clarification. Energy Secretary Chris Wright will be on Balance of Power at 5 p.m. Wall Street time tonight. Maybe he'll give us some clarification there. Vince, give us just a sense of the state of the infrastructure in Venezuela. A lot of people, a lot of folks are saying, boy, it's not good shape, and these companies would have to go in there and spend a lot of money to just kind of modernize it, and much less expand it here. And who wants to do that without a lot of guarantees and a lot of stability? What do we know about the infrastructure?
Well, let me give you an example. Exxon and Chevron put out their 5-year plan recently, just this past month. And I can tell you where the capital is being deployed. And the intention here is to deploy it in more investor-friendly environments, in the Permian, in Guyana. PDVSA put out back in the early noughts, their estimate on what it would take to bring production back to those previous peaks of the 3 million barrel range. They're at roughly 1 million barrels today. And even back then, back about 20 some odd years ago, that estimate was north of $58 billion. And it's going to take a lot more than that 20 years later to bring an industry back online. You think about the infrastructure, but also think about the entire value chain. We're talking about in excess of $100 billion, maybe even $200 billion. And who really wants to spend that much money, given that the history of nationalization in that country? Also keep in mind that Conoco is owed significant dollars. Exxon is owed significant dollars as well. So there's a lot of uncertainty here. Yes, those barrels do exist in the ground. It's going to take a lot to get them out of the ground. And if we could do this, you could see a rebirth of U.S. refining. But do you need those barrels eventually longer term if we're moving away from that type of an economy?
What kind of timeline are we thinking about here? Presuming the president comes out of this afternoon's meeting with a commitment from each of the big oil executives, and they do decide to put money to work, how quickly could they get Venezuelan oil back online?
Years, decades. I don't think there is the political will on the part of the energy industry to really bring those barrels back online. Exxon made a significant acquisition in Pioneer here in the U.S. Chevron spent a year plus battling for Hess in the courts to invest in Guyana. That's where they're earmarking their dollars. Could there be incremental capital spent in Venezuela? Sure, there can. But to resurrect an industry that was at one point at 4 million barrels a day from roughly 1 million barrels, it'll take, the industry has changed in the 70s from 20. Hydrogen-powered engines. So it is a very different framework, state of play today than it was, say, 10 years ago. But incrementally, you do need those barrels, and it would be great to have that competition for those barrels.
Vince, thanks so much. We really appreciate your expertise here. Vince Piazza, Senior Equity Research Analyst. He follows all the major oil and gas companies for Bloomberg Intelligence. And again, Energy Secretary Chris Wright will be on Bloomberg Television tonight. Balance of Power at 5 p.m. Wall Street time tonight. Maybe he'll have some clarifications and more guidance for the markets here. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning, Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We've got a lot to cover here in the second hour of Bloomberg Intelligence. We got the jobs report today. We did not get a Supreme Court ruling on President Trump's reciprocal tariffs, so we'll wait to see when that does eventually show up. But we were going to dig into the jobs report with Amy Glazer of Adecco to give us a little more insight into what this mixed report really tells us about the state of the labor market. Michael McKee, our Bloomberg International Economics and Policy correspondent, helps us move things forward because we've got inflation data coming out next week as well. And then Erin Hudson, she is our muni bond reporter, will talk to us a little bit about what she sees in the muni bond market. There's a housing boom in Montclair, which is colliding with a school crisis, an education crisis there, funding for those school districts that's to the tune of $18 million. Michael Hillen, Bloomberg Intelligence Senior Research and Food Service Analyst, will also talk to us about U.S. restaurant sales set to rebound as it looks like there was a flu spike in December that did maybe put a bit of a dent in those restaurant sales. But first, let's bring in John Tucker for our Bloomberg Business Flash. John.
All right, guys, we're seeing some degree of risk aversion after the High Court didn't issue any ruling on the Trump tariffs today. Maybe get it next week. Now, based on their questioning during the oral arguments, the betting is the High Court's going to knock down the tariffs. Now, Lululemon Athletica, worst performer in the S&P 500. They're disappointed we didn't get it today, down close to 5%. And then on the other side of the ledger, you have Vistra, best performer, up over 13% on word of that agreement with the electron-hungry Meta platforms. As a result of that, we're seeing right now the S&P 500 27 points higher, right now up 0.4%, 69.49 in the index. The Dow up 115 points. The NASDAQ Composite Index 129 points higher. That is up 0.6%. In the yield space, the 2-year, which is more policy reactive, up close to 2 basis points right now at 350. Bain Capital's Bob's Discount Furniture, the home furnishings retailer based in Connecticut, filing for an initial public offering.
Nice.
Really?
Disclosing growing revenue and profit. Actually, a busy slate of IPOs coming up. And then let's
Usually
move on.
they've been crypto names, not Bob's Furniture.
Bob's Furniture's.
But there's an AI theme. You know there's an AI theme.
He's got the AI bed or something. Bob. Saks planning to file for Chapter 11 bankruptcy. Could see this as soon as Sunday over the weekend. So the company heading toward Chapter 11 without, right now, a restructuring agreement in place. Critically, they're in advanced discussions on a roughly $1.25 billion so-called debtor-in-possession financing package with creditors. So that at least would allow the business to keep running. And they run Saks Fifth Avenue, Bergdorf Goodman, what else?
Neiman Marcus.
Neiman Marcus.
And off Saks.
Well, I don't know about that. But anyway, is there anything in any of those stores that like a John Tucker would be interested in?
What is a John Tucker interested in?
I still need the 22-ounce framing hammer, and I need a new circular saw.
Yeah, that is not available unless you want to brand name one a holder for it. How about that?
Like a Gucci holder for my hammer. Yeah, hint, hint. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett and Paul.
Kombucha?
What's that?
Being offered on the 6th floor, I understand. I don't know what it is, so I Googled it. It's a fizzy fermented tea drink made with sweet tea, yeast, and bacteria.
It's kind of new agey.
Absolutely. But I feel like it's up for debate as to whether or not people say it actually has positive health effects.
Okay. All right. It's being offered on the 6th floor.
It's sort of in the wellness area.
Run up there and get
I like it.
a cup of kombucha.
Yeah, no, I think I'll skip that.
They even have hard kombucha now.
Really?
That's like alcohol spiked.
All right. It's for the Brooklyn crowd. All right. John Tucker, thank you so much. We appreciate
Not the
that.
Jersey crowd.
Scarlett Fu, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move. Today, we're joined by Bloomberg's Norma Linden. Nora, what are you looking at?
Well, let's take a look at a lot of those tariff-related names. Of course, we are seeing indexes now recovering, but earlier we did see a lot of names selling off. I'm looking at Mattel, still down, Deere, Deckers, Urban Outfitters, Under Armour. All of these are still being pressured by the idea that we didn't get that Supreme Court decision today on reciprocal tariffs. So we're going to see what happens next week. But of course, we do know about $150 billion in revenue has been collected thus far when we think about $150 billion in revenue. So a lot of companies are sitting here waiting for that refund. And some people are talking about the idea that this could have ripple effects on the economy if we do see that. But of course, when you think about the trader action here, any sort of delay equals uncertainty. So you're seeing people trying to figure out where they should be rotating, or, you know, a lot of people were betting on relief and we didn't get that.
I saw a good research report from Morgan Stanley a couple of days ago. David Gurr forwarded to me and said, if you're betting on a big refund, probably not. You're probably going to get some kind of ruling that might result in a little bit of refunds here and there, but there'll be pockets for the administration to be able to say, you know, sidestep it. So we'll have to see how the ruling does come out, how complete that ruling is, if at all.
Right.
All right, what's next?
Well, also automakers, of course, when we think about tariffs, they are a sector that is exposed. But we're looking at General Motors, ticker GM, down for a different reason, it seems. And this is after it would face an additional $6 billion in charges tied to EV and battery production cutbacks. This is bringing the total right down to $7.6 billion. So we are seeing shares of General Motors sliding down about 2.6%, but earlier plunging for its worst day in 6 months. So we are seeing a slight pairing of that decline, but still down nonetheless.
And the third name you have?
Third name in the green. This is Southwest Air, ticker LOVE, LUV. We're seeing shares up as much as 4.9%. They earlier hit their highest intraday level since 2022. Now they're up about 2.9%. This is after JP Morgan actually raised its recommendation on the company to overweight from underweight. The analyst over there is talking about they see an increase in its EPS guidance as likely. They also added the stock to JP Morgan's positive catalyst watch list ahead of its upcoming earnings report. So keeping all eyes on those airline companies.
All right. Thank you so much, Norma Linden, Bloomberg Television Markets correspondent. And for more conversations like what you just heard, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, so a lot of catalysts that people were really waiting for today. It was a data-filled week, but it really hit a peak at the end of this week with the jobs report today. Amy Glazer is with Adecco. She's a senior vice president there, and she joins us now to discuss the December jobs report. And Amy, a lot of people saying that it was a mixed report. You had the unemployment rate falling unexpectedly, but the non-farm payrolls, which is the number of jobs added, was weaker than expected. How are you looking at it?
I look at closing out the 2025 year in an area of stability. It was a labor market that was a little bit bumpy in the fall, and I think we landed at a safer place. Look, hiring, although it may be modest, is still a positive trend. Unemployment remains contained, and I think both employers and employees and job seekers can go into 2026 with a sign of cautious optimism.
So, Amy, I think how it's been described by some is here's a labor economy where there's not a lot of firing going on, but there's not a lot of hiring going on. Is that how you see it? And if so, is that okay?
It's one of those, it's not too hot, not too cold,
Yep.
so we may be reaching a happy medium. I think, Paul, we're at the new normal, and it's been a long road since COVID, and I think we're now finally a year of 2026 will be the year of durability, stability, and consistency.
Amy, have we seen AI really make an impact yet on the labor market? I know that there's a lot of talk, there's a lot of consternation, there's a lot of anxiety, and companies may be reluctant to hire, but I don't know how much of that is tied to AI just yet.
I think we're going to wait and see. It is starting to make an impact. One of the most interesting things, although it's top of mind for employers, it's work fit on a candidate's mind are about AI or the future. So it's top of mind for not only candidates as well.
Housing, like agriculture, have we seen that?
Depends not only industry by industry, but across geographies. And certainly laws of supply and demand exist. Anytime the supply shrinks, you're going to have some price increases and pressures and wages and things of that nature. So the noise on it has settled quite a bit. I'm not hearing employers talk about it as much as they were several months ago.
All right, thank you so much, Amy. Really appreciate your joining us today. Amy Glazer is Senior Vice President at Adecco, joining us from Ponte Vedra Beach in Florida.
Good golf course down there.
Oh, is it really?
Oh, yeah. CPC, Ponte Vedra.
Okay.
It's the island green.
Well, you're off next week. Are you going
Yes,
there?
I am. No, I'm going to Aruba, baby.
Okay,
I'm going right into the war zone. It's 10 miles off the coast of Venezuela. So good luck for me.
Yeah, well, I mean, flights are going there, so
back,
you don't have to worry about not being able to get there.
Yeah, just getting off.
All right, well, good luck to you on that one.
And my fishing boat,
While Paul is going to be on the beach, we are going to be waiting a slew of economic data, and Michael McKee is here now with us to kind of give us an overview of what we might expect. He's our international economics and policy correspondent. And Mike, today's jobs report didn't really move the needle in terms of, answering questions about where the labor market goes, because it was kind of like, it's more of the same, low, hire, low, fire. Next week, we get inflation data.
Yeah.
Do we think this is going to be clean data?
Semi. We get full data for December, but remember, we did not get complete data for November and no data for October, and that's going to skew the numbers because you don't get the month-to-month comparisons. And basically what the BLS did was impute zero change to every category in October.
Just put a zero there.
Just put a zero there. So it's going to take a while before the numbers sort of work their way into being completely reliable again. The way the housing numbers are calculated, and you don't want to know the mathematical formula, but basically it's going to take till April to clean the housing part of it up. But if we get a significant move one way or another that you could say, yeah, it's probably not statistical noise, then that could sway things. But at this point, given the way the jobs numbers came out, I think Fed still sits on hold.
What did you take away from the labor data today, Mike? Because some people are saying, hey, the headline unemployment's down, but others are saying, yeah, the revisions don't look good. And what was your takeaway?
I think it basically just confirmed the story that we have seen within a range of numbers bouncing up and down, that it's a low fire, low hire economy. Not a lot of jobs created, and over a 3-month period, you've got negative job growth, but you have the unemployment rate falling back again. It's only 1 month, but it fell back again. So it's telling you that we're not seeing a massive increase in unemployment. And that's what the Fed was worried about, not so much the level as how fast it moved. And if it's not going in the upward direction, it's not moving very fast, and they can relax a little bit.
I'm looking at the average hourly earnings, 0.3% gain for the month of December, matching the analyst estimate there as well. What does that tell us about wage inflation?
We're still seeing wages outpace inflation. That's the important thing. At 3.8% on a year-over-year basis, inflation running at about 2.8 or 2.9, depending on which number you're using. And so that should make people feel better. And obviously, we've talked quite a bit about why people aren't feeling better, although today you saw the University of Michigan numbers come in with Americans a little more cheerful about the way things are. It doesn't suggest that there is a wage inflation problem, which, because we're under 4%, it's still a little high to be neutral in terms of inflation, but that's on the good side, as if inflation's still coming down, but we're getting more money in our paychecks.
You know, we talked to Joanne Shu from the University of Michigan just moments ago, Mike, and I tried to take the glass half full approach like you did. Hey, it came in a little bit better than expected. And she said, no, we're still bouncing along the low here. You want to see something with a 60 or a 70 kind of, you know, and so.
Yeah, no, it wasn't like go throw confetti.
Yeah.
But
that's what I was trying to do. I said,
part of the problem with these sentiment surveys is you tend to get a recency bias. People are comparing how things are today to how they were a month ago or last summer or whatever, and you get people saying, well, you know, look at where we were. This is so much lower. It's just been that way for a long time. And the one that always gets me is consumer confidence is lower than it was in the 1980 recession. Well, yeah, but the people who are answering the surveys today weren't around then, so.
Question from the peanut gallery?
Yes, sir.
The President of the United States gets the data before everybody else? Is that right?
The BLS sends the data over at 6 p.m. on Thursday night to the Council of Economic Advisors, which can then and does distribute it to those.
That's Kevin Hassett, right?
No, Kevin's National Economic Council.
Okay, sorry.
That would have been Stephen Myron, but now it's the acting head. And so the president had the numbers yesterday. But I don't think this was a deliberate attempt to insider trade. I think what happened
is he released part of it in his.
He released part of it. Well, what he did was
media.
he put out a chart that it looks like the CEA created for him that showed from the time Trump took office, basically leaving the January numbers out, starting with February and going through the rest of the year, there were 640,000 jobs created. Well, you wouldn't have gotten to 640,000 if you didn't have the December numbers in there, which people figured out, and I think he had no idea that that's what he was tweeting out. He was just trying to brag about what his administration.
As a former investment banking analyst, where my entire existence was putting graphs and books together, it was a very bad graph. The number in the text did not agree with the number in the bar chart. That would have been 30 lashings from a vice president in my day.
Yes, but this is the president, so he lashes you.
Yeah, I mean, that's tough. All right, so, you know, it didn't seem to impact the markets.
No, because again, I don't think this was a deliberate attempt to affect.
He wasn't front running the numbers.
And you would have had to look at that chart, figure out what the numbers would have been without December, and then assume that December was going to make up the difference. And not that many people look at a tweet like that, and you know, who's going to do the math, stuff like that. So I don't think it was a deliberate. It was a mistake. It shouldn't have happened. But also, given the way it was done, just putting out a number for the year instead of the actual number didn't give anybody really a trading advantage.
All right, Mike, thanks so much. Appreciate it. As always, Michael McKee, international economics and policy correspondent for Bloomberg News. Red headline crossing the terminal. Supreme Court sets Wednesday as next opinion day.
But that doesn't mean it's going to come out with a ruling on the tariffs.
No, it doesn't.
It just could.
Yeah, there we go. So you guys let me know how that goes, okay? Because I'm not going to be...
We're going to call you in. We're going to remote in.
So we'll see how that goes. We got some green on the screen here. S&P up 37, the Dow up 215, and the NASDAQ up 160 at 0.7%. More coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash, and we're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Let's start with the tariff-exposed stocks. They fell after no decision from the Supreme Court today on tariffs. Lululemon Athletica shares, they were worst performer in the S&P 500, down almost 5%. And then, as you heard Scarlett mention, Wednesday is now the next opinion day for the court. So that's the earliest at which we can find out about the tariff ruling. The expectation, according to Bloomberg Intelligence, of course, is that they're going to shoot down the Trump tariffs. The data today, employers adding fewer jobs than expected in December. At the same time, the unemployment rate, that's a different survey, that fell back again. You have shares of mortgage stocks. They're higher after President Trump said on his social media platform he's directing the purchase of $200 billion in mortgage bonds. This is about affordability. S&P 500 up 36 points right now. That's up 0.5%, 69.58. And the Dow Jones Industrial Average up 218 points. The NASDAQ Composite Index up 160 points. And that is a rise right now of 0.7%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett Ball.
Now on Bloomberg Intelligence, Munis in Focus.
All right, the focus on munis today is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. And there you go. John, you're going to want to stick around for this discussion here. We're going to talk a little Montclair, New Jersey. Erin Hudson, municipal bond reporter for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Now, Montclair, New Jersey is a great town just west of New York City. Most people, or a lot of people that live there, kind of work in the city, work in the arts, entertainment industry. Great commuter town, great town in general. They got some problems with their finances. Erin, talk to us about what's going on in the municipal bond market for Montclair, New Jersey.
Yes, so Montclair's public schools have an $18 million deficit. Oops. And this is something that they learned about over the summer. It took everybody by surprise when the local administrators made this announcement. And basically since then, they have been trying to get a handle on the deficit. They've started cutting staff, so reducing teaching staff, and now they are asking taxpayers to increase taxes to make up the rest of the difference. So,
and this comes at a point when housing values have gone up, so your assessed value has gone up, so the tax increase could be substantial.
Yes,
I'm guessing.
Definitely, definitely. So yes, Montclair, the average homeowner in Montclair is paying over $21,000 in property taxes already. And
by the way, parenthetically, New Jersey, for the rest of the country, has the highest property taxes in the nation.
Brutal.
Yes,
I won't even tell you my number.
Within the state of New Jersey, Montclair is among the highest. And so these proposed increases that would help pay the school budget deficit would be about $1,500 for the average homeowner. So,
yikes.
Yes.
Okay, so real money here. Would this be a permanent tax increase or kind of a one-time adjustment?
So there's two questions that will be on the ballot. One is for a permanent tax increase, and one is for a one-time increase. And so part of that is that what the school district is saying is that they are facing a structural deficit. So clearly mistakes have been, there's been issues. There's unbudgeted expenses so expenses are way higher than revenues, but they are saying that in addition to just solving this $18 million gap, they are going to need more money going forward. So this is a tough pill for residents to swallow, especially when they're seeing their home, the town is also in the middle of or about to go through a property tax reassessment. So taxes will be going up for a lot of people regardless.
And Montclair
So
is an interesting town. I'm not sure if it's a city technically, but there's a lot of wealthy people there. Average home over north of $1 million, but it's a very diverse population, all different income levels. And so the average salary, the average median household income is about $167,000. So the numbers that for a lot of people, these taxes are going to be just onerous. My question is, where did the budget shortfall come from?
Yeah, that is really the question. What the district has told us so far is that there were unbudgeted expenses. They found unpaid bills. Who's running the district now are administrators who started their terms in July 1st. So these are new administrators who took control of the district and immediately announced that they saw a deficit, and that's what this district is grappling with now.
When you open your tax bill, it's just like it breaks it down, the county, the municipal, and then the school. Far and away, the school part of the tax is the biggest part of any homeowner.
And that's why New Jersey, you might have the stat, some of the best schools in the country, districts, some of the best school districts.
It depends, yeah.
I think, you go look at there's a lot of them, and a lot of it's because, why are your taxes so high? Because we want to invest in schools, but I don't know.
And everyone who moves to Montclair, almost everyone I have talked to says that they are in Montclair because of the schools and because of the diversity of the town.
Yep.
And one thing to note that's also in our story is that diversity in terms of the Black population in Montclair has been declining over time. And that's something that is concerning residents, some of the township's council members also. This is on their radar too, that people are getting priced out, and especially as these home prices rise, it's just becoming unaffordable.
I know my assessed value of my home, based of which you base the taxes on, has gone up dramatically. I don't know what to, I'm at this point going to leave empty beer kegs on the front lawn and jack up an old car.
Right.
To try and bring down my value.
Just to bring it down a little bit. So the vote for residents to decide on how they want to go forward is not till March 10th. What is it like in Montclair right now? I would imagine there's a lot of emotions running high.
Yes, things are, they've actually been this way for quite a while, because this vote was actually supposed to happen in December, but then a legal challenge was brought against the vote. So the vote was canceled and then rescheduled. So I think, after the holiday break right now, parents are being asked to volunteer at their schools because there's been staff reductions. Leading up to the last vote in December, there were lawn signs, high school students were going door to door. So, it's still early. Only on January 5th did they confirm this election is going through in March. But, I would anticipate that residents are going to be mobilizing, residents and students.
Is there a bond issue option here?
No.
Okay. They're just
Bonds
thinking about
can't
taxes.
be, well, not immediately.
Yeah.
They do plan on, if voters agree to have the taxes get raised, then the district's plan is they're going to issue a short-term type of municipal debt that is going to basically allow them to tax anticipation notes. So they're going to be able to get the money for the taxes that will come in, and then they'll repay that debt.
I see. Okay. All right. Keep an eye on. Good story on the Bloomberg terminal there for our good friends in Montclair, New Jersey. Shout out some great restaurants there and bars and stuff. Some good.
Well, we should go there because they need the tax revenue.
I know. Yeah, exactly. I got a parking ticket there like all the time. So.
Well, you're contributing to the town's finances.
Paul's doing his part.
I'm doing my part. Aaron Hudson, municipal bond reporter of Bloomberg News. Appreciate that. Let's get to the restaurant business here. The flu season, which is upon us, and it's a little bit more harsh than average. It's impacting a lot of folks. Obviously, it's also impacting some businesses like the restaurant business. I didn't think of that. Michael Halen, he thinks of it. Senior restaurant and food service analyst for Bloomberg Intelligence. Mike, talk to us about recent trends in the restaurant biz.
Yeah, it was a tough fourth quarter, especially December. December was hurt by cold weather, snow, and an earlier flu season. It's the worst flu season so far in 25 years. There's been some issues with, the vaccines not covering the current strains that are out there. And so December was pretty rough. Quick service and fast casual, did better. Quick service sales were down slightly. You know, fast food chains like McDonald's, and whereas fast casual like Chipotle and Shake Shack, they were up slightly in December. It was the full service chains, so casual diners like Chili's and family dining like IHOP that struggled the most, which makes sense. If it's really cold or if it's snowing, you're less likely to go out to a restaurant and dine in. You're more likely to order Domino's. And so it all kinds of makes sense. But, you know, these trends are going to flip pretty nicely into January. We've seen a huge squeeze in restaurant stocks to open up this year, and we think it's going to continue.
So what do these casual dining chains do to change the trajectory of what seems like a pretty set trend at this point?
Well, the casual dining chains had a really nice year in 2025. But because of that, they have tougher comparisons to lap, right? And so for that reason, we think and we think QSR stands to benefit more from tax reform, as well as like a 10%-ish decline in oil prices. So we don't expect a bad year out of casual dining. We think they'll continue to do pretty well. They're not going to receive as much of a boost from Chili's, which had an unbelievable year in 2025. But we think casual dining can have a solid year here in 26. But it's the casual dining names and some of the fast casual names we cover, like Cava and Wingstop, that we think can have a really nice bounce here, especially in the first half of 2026.
Mike, we got some labor data today, some jobs data. Unemployment rate ticks down a little bit here. I got to think that's important for restaurant companies.
Yeah, labor's been tough for restaurants. We've seen a 4%-ish wage rate inflation in this industry, going back to before the pandemic. Labor continues to be kind of an issue. There's still some talk about restaurants being understaffed right now. So that obviously impacts service levels negatively and hurts the customer experience. So obviously something we look at pretty closely.
In terms of names that you like, and I know we don't do buy, hold, sell recommendations at Bloomberg Intelligence, but the kinds of companies that are best positioned in 2026, what are you looking for?
Oh, yeah. So, for us, we're looking at chains that we think can outperform, same-store sales estimates on the street, with some chains that we think, other analysts are just not bullish enough on. McDonald's is coming up against some really easy comparisons due to E. coli once they report the 4Q and the 1Q. Wingstop, Brinker, these are some of the names that we've written about.
Okay, Mike, thanks so much. Always appreciate checking in with you. Michael Halen, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence, safely ensconced down in our Princeton office. S&P up 30, the Dow up 140, and the NASDAQ up 146. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Major averages higher right now to finish the week. The S&P 500 up 32 points. That's a rise of 0.5%. We're at 69.54 on the index. The Dow Jones Industrial Average up 189 points. NASDAQ 100 up 177 points, a rise of about 0.7%. In the yield space, the 2-year up close to 3 basis points right now, 351. 10's not doing much. That's at 416. Meta set to become one of the world's biggest corporate buyers of nuclear power. So they've struck a series of deals to buy electricity from existing plants and support new reactor projects. Among the agreements, one with Vistra. So that's the best performing stock in the S&P 500. It was up over 13%. You have 9 of the 11 major industry groups S&P 500 higher. Supreme Court strikes down the president's. The court today, the next day they can do that is when tariff exposed like Lululemon. Do this. Did you know Jeep is cutting prices? One of the few car manufacturers cutting prices. A Wrangler Sport S now starts at $42,495.
Oh, that's below average then.
Yeah, it's so they cut it by $1,300 from the prior model year. Rare case there. Most manufacturers are charging more because, in part, because of the tariffs. The average new vehicle, $50,000.
Yes,
dude.
I know.
That ain't happening. We checked the markets. I'm trying to keep my car on the road for like forever.
Oh, here's the story. So had a flat tire, so I take it to Joe's in Manasquan. You couldn't even get into the parking lot. It packed with cars. The guy, he says, my business has never been better than it is today.
Yeah.
Packed.
Take care of those old cars, folks.
Yeah.
We check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. See you next week.
All right, see you next week. Have a great weekend.
Thank you, sir.
Safe trip there, Paul.
Yep.
John Tucker with our Bloomberg Business Flash. We need to talk about what's happening in Venezuela because we started this week coming in, trying to make sense of the forced departure of Nicolas Maduro and what this means for the Venezuelan oil industry. President Trump gave us some hints of basically telling everyone that now the U.S. is going to oversee the sale of Venezuelan oil indefinitely, and he has invited U.S. oil executives to the White House this afternoon to talk with him about these opportunities presented. What does this mean for the industry? What does this mean for investors? Let's bring in Dwight Anderson. Dwight is founder and CEO of Osprey Management, a long-short hedge fund investing in commodities and derivatives. So he is the perfect guy to ask. Dwight, welcome to Bloomberg Intelligence. Thank you so much for joining us. Can you tell us a little bit about what you've heard is happening on the ground now with Venezuela, with oil, and what you think will happen?
Sure. Thank you very much for having me today. So on the ground, well, first off, a lot of it is opaque and there is confusion in terms of the different aspects and conflicting, but we still have sanctions in place. We are working to try and eliminate a bunch of the illicit and illegal imports through sanctions. So in the short term, there's no improvement and even a little bit of a fall in the availability of Venezuela crude. But they are trying to figure out what needs to be in place in terms of governance, in terms of rule of law, in terms of support, in order to get the investment in to start to turn the decline and fall of Venezuela's oil production around. And so that's what the media is going on in D.C., and that's what the other conversations that are occurring both in oil and gas, but also for mining and minerals.
Dwight, I got a real problem with you, I think, today. You got your MBA from the University of North Carolina, and that's a problem to this Duke grad. But then you compound the problem by wearing a Carolina blue sweater today. But I'll try to be a professional, get us through this. Dwight, realistically...
I'm actually just coming from North Carolina where I dropped my daughter off to start college early.
Ah, fantastic.
Field hockey for them.
Fantastic, fantastic. They do an awesome job down there at Keenan Flagler. Dwight, And realistically, you've been in this business a long time. You know a lot of the players here. It just seems like what we know at this point, it's going to be tough to really make a commitment for significant investments, whether it's in, I don't know, the oil business down there, the mining business. How do you, what are you hearing from your contacts?
So we're hearing interest, but caution and concern. You know, you're going to have to resolve the three different groups of debt holders and obligations and their claim to some of the economic rights if you're involved. So whether general debt, China, and very especially on the oil and gas side, the Repsols, Eni, and ConocoPhillips that are owed $20 to $30 billion. And all of them say, hey, we're willing to get involved if we're comfortable on governance, on safety, and that there's some sort of support, whether it's political risk insurance, for us to have long duration investments that we're not going to see a return on probably to the end of this decade or next. And so they're really looking to trying to create an investment environment and support from the U.S. government that gives them comfort for things that won't pay off economically probably this decade.
So what will the big oil CEOs be listing for, or be not pushing for, but seeking when they meet with President Trump in the White House today?
So we've spoken to a few of the different companies. And so one of the aspects is the ability to actually keep the economic profits. If they do produce the oil and gas, how is that going to flow to them when there are other countries like China or companies like ConocoPhillips that are owed capital? So one is just purely what is the economic framework on what they're going to be able to get. And then secondly is really aspect of support from the U.S. government, similar to like OPEC I spoke about, that is there going to be long-term support so that if they make these investments and there is a change of control down there or a change of ownership or nationalization economic interest, that they'll be compensated and insured for that. They don't need subsidies, but they do need some sort of underlying long-term sort of support or guarantee that the property law and rights are going to be supported or insured.
So how are you and your colleagues, Dwight, kind of thinking about the investment opportunities here? Is it too early? Are you trying to make maybe upping a bet on Chevron or something like that may have an inside track? Or are you just kind of sitting back and see how this plays out?
Well, the answer that's clearly is the shipping companies, especially those who have the smaller crude carriers, Aframax, like Scorpio or Frontline, are going to benefit as we're really taking more aggressive stances to eliminate the shadow fleet. So those have to flow back to the legal tankers. And almost definitely there's going to be greater flows to the U.S. on that sort of, and to and from, including naphtha from the United States to there. So they're a clear near-term beneficiary, okay? Is as soon as we're comfortable that there is some sort of a framework to give support for the investment, the immediate beneficiaries are going to be much more the oil service companies and the refiners after the shipping companies. And what really isn't being paid attention to is a critical resource for the U.S. and a critical metal for us is aluminum. And we don't have bauxite, the raw material for aluminum. You know, this was a country that was producing 5 million tons of bauxite that's down to 1 million and has an alumina refinery. That doesn't have the economic complications and debts that oil and gas does. It's critical for us. And so whether it's a Century Aluminum, whether it's a Talco, or whether it's Rio Tinto Glencore, that's probably the easiest and clearest aspect as soon as there is a framework on sort of governance and rule of law there to actually turn around and begin investing to the benefit of the U.S. strategic supply chain.
Really, really interesting stuff. Yep. Dwight, thank you so much for being so candid and for sharing your thoughts on this. Dwight Anderson is founder and CEO of Osprey Management, long-short hedge fund investing in commodities and derivatives, talking not just about the oil industry, but also what it means for hard minerals as well.
Yep, hard minerals, and there's lots of ways to play it. He mentioned the shipping angle as one of the ways to play it. And that's a great point. I hadn't even thought about the shadow fleet, which on the global trade is material. It's a material number, and to the extent some of that goes back to the other shipping lines, that could be a benefit for them. So
I think it's important to get this kind of perspective and contrast it with what we're likely to hear from the White House at 2:30 p.m. when President Trump meets with these oil executives, who he may very well just push towards making a commitment.
Yeah, and that would work for the president, and maybe for some of these companies over the long term that might work as well. So take a look at these markets here. S&P up 40 points, the Dow up 250 points. Both of those about 0.5%. Then the Nasdaq's up 0.7%. We're getting some lift there on the back of the labor data as well. More coming up. This is Bloomberg. Good morning.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Hi, Scarlett Fu, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Boy, this transition to electric vehicles is proving very costly for automakers around the world. We had the big $20+ billion write-off from Ford a couple of weeks ago. Now, General Motors will take another $6 billion in charges tied to production cutbacks in its electric vehicle and battery operations. Let's break it down with Craig Trudell, Global Autos editor for Bloomberg News. He joins us from our London office. Craig, what's GM telling us here about kind of their transition to EVs?
Yeah, I think, this is like a sort of ongoing toll that they're reporting, and I don't know that they're necessarily done. We heard them report actually some months back that, sort of rethinking their production capacity and paring that back in response to the way electric vehicle demand and battery supply was shaking out, that was going to set them back more than $1 billion. So this is, an incremental amount of money on top of that. And there was some warning in the 8K last night that actually, there may be more to come. So, I think this is part of a broader sort of rationalization taking place in the U.S. where, an industry was trying to frustration that was banging the drum in a much different way than the Trump administration is now.
I look at this trailing 12-month performance of General Motors. It's up 61%. And that kind of tells me, hey, you can take as many charges as you want here. I want you to pare back your transitions to EV. Is that kind of what you're hearing?
It's fascinating because on one hand you're seeing electric car leader or at least former electric car leader Tesla taking off and doing so in spite of the fact that their sales are slowing down. Yep. The outlook for EVs in their home market is pretty bleak, and yet you also in unison have sort of the contrarian play taking off in GM. I think it's maybe not quite that simple in that GM does have, I think David Welch's story on last night's news does have, sort of the context that they have quite a lot of electric vehicles available. They're going to continue to have a pretty broad, range of cars. And Mary Barra has talked about how EVs is their, quote, North Star, and that's not going to change. So I think there's going to be a little bit more stick-to-itiveness on GM's part than Ford. And yet, I think this is also an indication that the market is saying, you know what, the way this company makes money is it's full-size pickups and SUVs. The more of those that they can make in this, new paradigm, the merrier.
So I guess, give us a sense of, in the U.S., I think we have an idea that this transition to EVs is going to take longer than maybe we initially thought. That's not the case, it seems like, in Europe. Tell us how the adoption is going in Europe.
Yeah, I think actually last year it may be surprising to people because we ended the year with these headlines about the EU sort of backing off of its combustion engine ban for 2035. That being said, we actually had a nice pickup in momentum for electric vehicles last year. A lot of that was driven by the Chinese manufacturers. I think that is part of where the concern is here, that the local manufacturers in Europe, some of them are doing better than they were, but it is patchy. I think it's also patchy, sort of country by country. But we did see, a roughly 30% increase in battery electric vehicle sales last year, in spite of the fact that a big player in Tesla had a really tough 2025.
That's interesting. Talk to us about hybrids here. I just caved and leased a hybrid for my numbering because he goes to school in California where the gas prices are just ridiculously high. The technology seemed really, the car drove great. And nice between going full EV ICE. How do you think about it?
Yeah, I mean, this was the supposed bridge technology, and the bridge is going for a lot longer than I think a lot of people reckoned. I remember, covering Toyota, being based in Japan for a few years. Toyota taking a lot of heat for sort of clinging to this technology that it sort of pioneered with the Prius, and not sort of jumping with both feet in fully electric vehicles. That has very much turned out to be the play, and I think we're seeing a lot of the excess battery capacity that got built in response to the Biden administration's push for more of a battery sector to be built in the U.S. A lot of that is going to get soaked up by these hybrids, whether they're plug-in vehicles or not. If you can make the bigger pickups and SUVs that are already popular in the U.S. more efficient, you get sort of the best of both worlds. Even if there's a little bit of incremental cost on the front end, these vehicles are going to be much cheaper to refuel and better to run.
All right, Craig, thanks so much. Appreciate it. Craig Trudell, Global Autos Editor for Bloomberg News. He's based in London. And again, General Motors will take another $6 billion in charges tied to production cutbacks in its electric vehicle and battery operations. So again, this transition from internal combustion engines to electric is proving very, very costly for most of the global automakers, including the U.S. OEMs, and maybe take much longer than initially anticipated. So we're looking at the markets. We have green on the screen, S&P up 40 points. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. With green on the screen, the S&P's up 43.6%. The Dow's up 260. That's 0.5%. NASDAQ doing better, up 188 points, 0.8%. 1%. And 10-year Treasury yielding right around 4.17%. That does it for Bloomberg Intelligence. More Bloomberg Radio coming up right now.
This is CBS News on the Hour, sponsored by Pfizer.
I'm Steve Kathan. Makeshift barricades have been removed at the scene in Minneapolis near where an ICE agent shot and killed a woman. City officials want in on the investigation.
The Justice Department has blocked the Minnesota Bureau of Criminal Apprehension from joining the probe into the shooting death of Renee Good. Minneapolis Mayor Jacob Fry.
If you got nothing to hide from, then don't hide from it. Include local experts in the process.
Fry is also upset the Trump administration has suggested his city is dangerous. He says there have only been 2 shootings in 2025.
50% of the shootings that have happened thus far in Minneapolis this year have been ICE.
Michael Wallace, CBS News.
Well, CBS's Gwen Baumgardner is in Portland, Oregon, where 2 people were shot by federal agents.
The Department of Homeland Security said the shooting happened Thursday during a traffic stop targeting a vehicle whose driver and passenger have alleged ties to a notorious Venezuelan gang. DHS says the driver weaponized the vehicle and tried to run over agents, and that the officer who fired the gun feared for his life. The FBI's Portland office says it is, quote, investigating an assault on federal officers.
Luigi Mangioni's attorneys are in court today to try to stop the government from seeking the death penalty against him in the killing of United Healthcare CEO Brian Thompson. Trial lawyer Richard Schoenstein is following the case.
If they can get the stalking charges dropped or establish that the stalking charges are not a predicate for the death penalty, then the defense can get the death penalty removed as a possible punishment in this case.
The U.S. military says forces boarded an oil tanker in the Caribbean early today. CBS's Natalie Brand.
This operation on targeting sanctioned Venezuelan oil continues. This, of course, started well before Maduro's capture, but now we've seen 5 vessels seized after the latest action reported by U.S. Southern Command today.
President Trump said today he called off a second wave of attacks on Venezuela after securing cooperation with new leaders, which began releasing prisoners. Correspondent Jim Krasula's got more on legal action against a major retailer and top soda company.
Walmart and PepsiCo have been accused in a federal lawsuit of a decade-long price-fixing scheme that allegedly involved raising the price of Pepsi products at stores other than Walmart. The proposed class action lawsuit says the 2 companies have had a long-term agreement that gives Walmart preferential pricing on Pepsi products.
And checking Wall Street, right now the Dow is up 270 points. The S&P is up 43. NASDAQ is up 182. This is CBS News. If you want to learn how to ice skate, there's a place where a lot of people will turn out to do the very same thing.
They're hoping more than 600 skaters will show up at New York City's Woolman Rink tomorrow to break a world record for the largest ice skating lesson. The old one of 523 skaters was set in 2014. If you're interested, you have to be at least 10 years old. Sign up on the rink's website. Skate rentals, access to the ice, hot chocolate, and s'mores are all free. Deborah Rodriguez, CBS News, New York.
Austin Peay State University in Tennessee says Darren Michael's been reinstated to the faculty. 2 days after Charlie Kirk's killing, the theater professor posted the headline of a news article reading, quote, Charlie Kirk says gun deaths unfortunately worth it to keep the Second Amendment. And he was fired by the school. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
And on the next episode of The Apprentice, it's Big Oil. Welcome to the Friday edition as President Trump calls big oil executives on the Oval Office carpet today to talk about investing in Venezuela to the tune of tens of billions of dollars. We're going to get the latest from Bloomberg's Tyler Kendall, who's at the White House right now with insights ahead from Mike McGlone at Bloomberg Intelligence. Looks like President Trump broke his own embargo on jobs. We'll explain when we talk to Bloomberg's Michael McKee, and we'll have analysis from our political panel this hour as more Republican lawmakers buck the president on health care and on war powers. It is Jobs Day, so we start with the markets as always. Charlie Pellet has that for us at World Headquarters in New York. Charlie, how are we doing?
Right now, a lot of green on the screen. Best level of the day right now. Jobs Friday, Energy Friday, but not Tariffs Friday. No ruling from the U.S. Supreme Court. Next shot for tariffs, perhaps Wednesday. The Dow, the S&P, NASDAQ, all pushing higher. Treasuries fell. Traders all but wiping out their bets that the Fed will cut interest rates later this month after the unemployment rate for December fell more than expected. Our Michael McKee will have a whole lot more on the Friday jobs report coming up in just a moment. Green on the screen, as I mentioned, though, the Dow, the S&P, NASDAQ, all higher. S&P up 46 to 69.68, gain of 0.7%. Dow Industrials up 278, up by about 0.6%. NASDAQ up now by 196, gain there of 0.8%. But to be sure, S&P right now, with that advance to a record up 0.7, is trading at session highs. 10-year, 4.17%, with a 2-year, 3.52%. Gold up $31 the ounce, back above 4,500, 45.09, up 0.7%. West Texas Intermediate crude now surging by 3.3%. 59.68. This on developments in Iran, and Bitcoin up by 0.3%, 91,497. President Trump will be meeting with energy executives today at the White House to outline his vision for rebuilding Venezuela's battered oil sector. U.S. Interior Secretary Doug Burgum talked about the meeting this morning on Bloomberg Television.
Well, the expectation today is to have a great conversation about the opportunity
to continue President Trump's agenda, which his agenda, of course, has been always about the safety and security, national security of our country. That begins with you can't have national security without border security. You can't have national security without energy security. So that's going to be on the table.
And on hand for today's meeting, representatives from 17 energy companies, including crude producers, refiners, and commodity traders. Among energy stocks right now, Chevron up 1.5%, ExxonMobil up 0.8%, ConocoPhillips up by about 0.8%. Recapping, oil rallying, West Texas Intermediate ahead of that big meeting, 2:30 Wall Street time, up 3.3%, S&P at a record up 0.7%, and your 10-year right now 4.17%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we're on the same wavelength today, my friend, because indeed, Washington and Wall Street meet at this story today, 2:30 p.m. Eastern Time at the White House. Charlie just laid it out for you. The top 17 oil companies are in town. Must have been quite an evening at the Four Seasons last night, huh? We should have gone over there, James, to Bourbon Steak. ExxonMobil, Chevron, ConocoPhillips, you run on down the line, and they're all coming here because, well, we're talking energy here and Venezuela more specifically. And some interesting reporting from CNN that executives, this is what they were talking about at dinner last night. How to head off the president of the United States before he comes to them with the ask to put $100 billion into the ground here over the next 10 years. They have been crafting a plan to present the president when they enter the cabinet room to get Venezuela's output up by hundreds of thousands of barrels a day on conditions that the U.S. lift more sanctions and provide supplies necessary to move the oil. Either way, as the president says, we're taking the oil, and he reaffirmed that when he talked to Sean Hannity last night on Fox. Listen.
We're taking billions and billions of dollars worth of oil, and it'll be hundreds of billions of dollars. It'll be trillions of dollars. We'll be running the oil. We're going to meet with the biggest oil people in the world. They're all coming here. The top 14 companies are coming here. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion.
They got the best bone marrow in the city over there, James? Is that true? Bourbon Steak? Maybe they'll be there after. I don't know. You know who's watching out for him at the White House? Because this doesn't start for another 2.5 hours. Tyler Kendall. She just left the newsroom right before I came in here. She's on the North Lawn right now. Let's bring her in. Bloomberg Washington correspondent will be with us on the late edition of Balance of Power as well. Tyler, are they bringing him in the back door here? How's this all going to work? And how do you fit 17 people? I guess they're using the cabinet room for this?
Well, considering that we had reporting, Joe, that some of these executives wanted assurances from this White House that this meeting remained closed door, I am expecting them to probably go through the side entrance and not the Northwest Gate and walk past all of us here and the press on Pebble Beach, because it is very clear that these companies are facing some big pressure from this administration as this White House is banking on some potential announcements and investments in order to advance U.S. interests when it comes to Venezuelan oil production. Because when you listen to President Trump, he often talks about this need to rebuild Venezuela's economy, get it on more sound and solid footing before there can be any sort of conversation about holding elections or setting a date for a democratic transition. Now, people familiar with the matter do tell us here at Bloomberg News that executives have already made it the case directly to the Trump administration that they are weary about the cost and the time and some of the issues that you were outlining in terms of going into Venezuela. But at the same time, Joe, these same people tell us that a lot of them don't want to say no to President Trump, because keep in mind, the president himself has signaled that he was already talking to some of these companies before he even gave the green light for that operation last weekend where we saw the capture of Nicolas Maduro. And this, by and large, is an industry that has really supported this president and the White House's deregulation push.
Really interesting. The president saying in that interview they're going to spend at least $100 billion, Tyler. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion. The oil companies have not said that, right? Just to be clear.
No, not at this point. And also, there are different estimates and analysis for how much money this is going to take and just how long it's going to take. 18 months from the president is a very ambitious timeline, but it is very clear that these companies have made clear their own concerns and that they need to see some sort of guarantees, including security, physical guarantees, but then also financial guarantees that they are going to put up so much investment and capital. Now, you had mentioned we did get some reporting overnight that perhaps we are going to see a preemptive offer here that would include some legal reforms, including a lifting of those sanctions, and also that the U.S. could provide some of those supplies in order to start getting that oil out of the country. But Joe, at this point, we're going to have to watch closely because this administration has made clear that they are working with the interim government here. Of course, one of the headlines, Joe, that crossed early this morning, President Trump saying that he had called off a planned second wave of strikes against Venezuela, citing what he says is a cooperative Venezuelan government under Delcy Rodriguez.
All right, Tyler, we'll check back with you a little bit later on, see how this meeting goes. Again, it's set to begin a little more than 2 hours from right now. And before the president gets that far, he's got lunch with the vice president. Kind of wondering what's on the menu today as the president talks jobs. And I guess we just today answered a question that I've always had. Does the president get to see the jobs data before it's released at 8:30? Does he get a heads up on that the night before? Never really know how that stuff works. You figure the president can see what he wants. But I guess we now know as we find the headline on this jobs day. Trump posted unpublished jobs data early on social media. While these executives were eating at Bourbon Steak last night, it was around 8:20, he put up a slide on Truth Social, a chart that included figures in the yet-to-be-released December employment. Look at that. Cece put it right up on the screen for you if you're with us on YouTube. That's it. Now, if you were just casually perusing Truth Social, this probably didn't mean a lot to you last night. But if you're Michael McKee, it does. And he's with us right now from World Headquarters in New York. Now, what would have happened, Mike, if you had posted that last night at 8:20?
Oh, I would get my knuckles wrapped if I had posted it and maybe be excluded from some BLS event at some point. If I'd seen it and invested on it, then I could afford to go to Bourbon Steak too. But I don't think the president does get the numbers the night before. Basically, BLS delivers them to the Council of Economic Advisors, the acting chair, Pierre Yarvin, at 6 p.m. on Thursday night, and he then is free to share it with those cleared to see it, which include the president. But what I suspect happened when you look at that chart, it looks like it's a chart the CEA prepared for him to show him how many jobs have been created in the year that he's been president. And he turned around and put it out without realizing that CEA had included the December numbers in there. And you would have had to realize that and back those numbers out to get any value out of it. So I don't think this was a case of insider trading or anything like that. I think the president just wanted to brag about his accomplishments and was mistakenly included.
Didn't realize he was breaking the embargo. It does make you wonder. I mean, he's on the phone in these meetings. He gets the slide. He just kick it right out there on Truth Social. So I guess there'll be no Jack Smith investigation into the handling of the document here, and we just move on. But could we have had a moment of insider trading? Did this lead to any funny business that we know of, Mike?
Not that we know of. There doesn't seem to have been
Not the president himself, but if people saw it out there.
Yeah, no market movement that we have seen. Now, in 2018, in his first term, he posted back then on what was then called Twitter that he was really anxious to see today's jobs numbers because he knew they were going to be good. He posted that before the jobs numbers, and people did trade on that. But there's no law that says the president can't do it, and after all, it's the jobs. It's not like he gave nuclear secrets to the Russian ambassador in the Oval Office, right?
Right. So markets are in good shape today. Speaking of this jobs report, everybody seems to be pretty happy about it. What does it tell us in our last minute here, Michael McKee, about the Fed?
Fed's going to be on hold unless there's some really wacky number in the CPI next week. The Fed will be on hold in January because their argument was we needed to cut rates to put a floor under the unemployment rate and put a ceiling on the unemployment rate. And the unemployment rate is going the other direction at the moment. We don't know if it'll continue, but for right now, there's not a sign that there's a major issue there.
Interesting that the market is taking that so well in stride. Got the S&P 500 up 43 points, more than 0.5%. NASDAQ's up 173. Mike, great to see you. Thanks for walking us through another escapade here in the Trump second term. Michael McKee live from New York on a jobs day, no less. I'm Joe Matthew in Washington, and I'm glad that you're with us, too. We've got a lot more to talk about here with regard to oil. We just barely scratched the surface with Tyler. It's one of these days where we want to spend a little bit of time with Miami Mike McGlone. He's going to be with us coming up straight ahead here. Bloomberg senior commodities strategist with exactly what this is all going to mean here if indeed the big oil executives sign on in Venezuela. This is Bloomberg.
Wall Street. We do check markets all day long here at Bloomberg. Stocks are shrugging off tariff and rate concerns. Bonds are slipping. Stocks are surging. This after the jobs report this morning. The Dow, the S&P, NASDAQ all rallying. S&P up 42 right now to 69.64. That is a gain of 0.6%. The Dow up 278, up 0.6. NASDAQ up 166. The NASDAQ Composite Index up now by 0.7%. NASDAQ 100 Index doing a little bit better, up by 0.8%. Small caps, again, outperforming. Russell 2000 Index of small cap shares up 1.1%. 10-year at 4.16% on this Jobs Friday. Gold up $26 the ounce, 45.04 now, up 0.6%. We've got West Texas Intermediate crude oil up 2.9%. WTI 59.42 for a barrel of WTI. We'll have more on the crude, more on the energy story coming up in just a moment right here on Balance of Power. Bitcoin now down 0.1%. Looking at Bitcoin, 91,064 now on Bitcoin. On a day when stocks are ripping higher, GM shares are trading lower. GM trading down now by just about 3.5%. GM will take another $6 billion in charges tied to production cutbacks in its electric vehicle and battery operations as the financial fallout spreads from the weakening U.S. market for EVs. The announcement yesterday brings the total write-downs from GM's huge bet on battery electric cars to $7.6 billion, following smaller charges revealed in October. Nike and Mattel are among the names moving after the U.S. Supreme Court did not issue an opinion this morning on the legality of IEEPA tariffs. Now looks like the earliest we might hear from the U.S. Supreme Court on tariffs, potentially now on Wednesday. Some of the other stories that we're following this hour, shares of mortgage stocks are surging after President Trump said on his social media platform that he's directing the purchase of $200 billion in mortgage bonds. Companies including Loan Depot, Rocket Companies, and Open Door Technologies are among today's big gainers. Also, oil moving higher as protests escalate in Iran. President Trump has threatened repercussions if demonstrators are targeted. West Texas Intermediate crude oil up 2.8%. 59.37 for a barrel of WTI. And among some of the energy names ahead of the big meeting of executives, 2:30 p.m. Wall Street time, Chevron up 1.7%, ExxonMobil up 1.1%, ConocoPhillips up 0.8%, and among oil service names, Halliburton up 1%, Schlumberger, SLB as it's now known, SLB up 1.7%, Baker Hughes up by 0.4%. And finally, Meta Platforms has agreed to a series of electricity deals to power data centers that will make it the biggest buyer of nuclear power among its hyperscaler peers. I'm Charlie Pellet. That, Joe Matthew, is a Bloomberg Business Flash.
All right, covering the waterfront for us, the great Charlie Pellet on a Friday, the voice of Wall Street and the New York subway. Take my word for it. Charlie will be back in about 15 minutes with the latest on the Friday trade. And yes, I did say that Friday is upon us. The weekend is here. Thanks for meeting us at the threshold on the Friday edition of Balance of Power here on Bloomberg Radio. We're always streaming live on YouTube and saving a seat for you in the studio. If you'd like to join us, search Bloomberg Business News Live. You can watch radio on TV every day around here as we wait for the big meeting on big oil. And as we've told you, that's going to take place about 2:30 at the White House. If you're just joining us, that's the big news today here. The Supreme Court did not rule on tariffs, so everybody just relax for a second. We're talking oil in Venezuela. 2:30 p.m. The top 17 oil executives all rolling into the cabinet room together, as I read on the guidance from the White House. Before the president gets that far, about a half an hour away, he's got lunch with J.D. Vance. They're going to sit down in the Oval Dining Room, and of course, we're always wondering what's on the menu at the White House, particularly in light of recent revelations about the president's preferences, especially when it comes to fast food. So here we meet at the lunch hour on Bloomberg. In a recently resurfaced interview, we learned about this from RNC chair Joe Gruters, talked about the president's passion for McDonald's, describing in a local government podcast. Did you see this? It was kind of coincided with all the stories about his health recently. The order that he made when these two sat down, I mean, you probably have your order, right? I think Tom Keene is an extra value meal, number 2. if my listening is correct. Donald Trump, on the order, he had this is a direct quote, he had hot fries waiting for him, Reuters says, from McDonald's. Then he had a filet of fish, a quarter pounder, and a Big Mac. And this is the great part. He says the president combined two of those sandwiches into one. He did not reveal the names of the two sandwiches combined, but I'm guessing he had the Big Mac sitting there. He put the quarter pounder together with the filet of fish. Just think about it. It's like the fast food version of the turducken. Also new, forget the Diet Coke button. Grutter says he saw the president drinking an orange soda to wash it all down. Yeah, Brendan. Little surf and turf. That's exactly right. All of this coming as we learn, of course, that the president is, he's taken aspirin to keep the blood flowing here and going against his doctor's orders. He's been taking more aspirin than recommended. Quote, they say aspirin is good for thinning out the blood, and I don't want thick blood pouring through my heart. He says, do you understand that? By the way, the calories in that meal, I just was looking at this because producer James and I thought we might go out and try it. You won't be able to eat for the rest of the day. The burger orders over 1,200 calories. The fries bring you up to 1,600 to 1,700 calories, which is pretty much what you need to live through a day. Lunch starts about half hour, everybody. Are we good with Mike? Can he talk to us? No, he can't? Oh, that's fine. Because, you know, we'll be talking about oil once we get out of the McDonald's business here. Doug Burgum actually joined us earlier today on Bloomberg TV and radio, the Interior Secretary, to talk about the efforts that the president is trying to generate here in Venezuela. Here's what he told us. Listen.
The capital is going to come from the capital markets and come from the energy companies. I don't see that these companies are going to need support from the U.S. other than things around security. I mean, if we can provide a secure, stable environment, the resource here is so significant and so large that it's going to be attractive for people to go in and develop that.
Deep tease. The Energy Secretary, Chris Wright, will be on with us on the late edition of Balance of Power at the conclusion of the meeting, okay? So we've got this book ended for you, which means the Chewy Center is Mike McGlone, Bloomberg Intelligence Senior Commodity Analyst. Thanks for running to the camera for us, Mike. We needed to ask you about this because from what we understand, the oil companies are kind of afraid to hear the ask to generate $100 billion over 10 years in an area that may or not be worth the investment. They may have a plan to present him, according to reporting today, that would come with conditions the U.S. lift more sanctions. But just broadly speaking, Mike McGlone, do they want to do this? Is it worth the investment for all this heavy, sour crude?
Well, that's, I think, the key thing, and I have a feeling the Trump administration is going to make them want to do it. They're very motivated for lower prices. We're seeing the methods. And the ask, the ask we get, but I have a feeling it's going to make it more financially secure and also because of risks. I mean, minimize some of the risks. So to me, this is one of those things, it's the ask, but the bottom line for me is there's more supply coming. It's just a question of when and how. Okay.
Is the president not asking them to work harder to make less money?
I doubt that because we know, I doubt that. He might raise in companies and they will go where they be made. And if he pays in companies and they will go where they be made. And if he lives there, that will happen. I think that's part of the deal.
Okay, interesting. The 17 companies that we're talking about in this, and we'll told Valet.
You already got it, Joe. You know that better than I do, actually. Already there, but seems to be focused on. That's going to be repatriated to some extent. The question of when and how, and for me, for the bottom line is you see crude oil popping a little bit today for things in Iran, but to me, the longer term, bigger picture is that supply is going to be coming.
coming and prices going down. As you've always said, over the past year, we're going to be looking at something closer to 40 than we are 60 by the time this is all said and done. But can you describe, to an extent that our listeners can understand, or that I can understand it, Mike, the work that has to be done? What type of infrastructure needs to be installed, and would it take a decade to do it?
Well, that's the key thing. There's a lot of pessimism about the supply coming on. But one thing that's happened in the 20 or 30 years since crude oil production peaked in Venezuela around 3 million barrels a day is that technology is overwhelmingly improved. You can see that in the shale patch. The average cost of production is now $55 a barrel. 10 years ago, it was $75 a barrel. So they're going to come in with this new technology and old wells and just ramp them up. So to me, the low-hanging fruit's going to come out right away. But I'm more optimistic about the technology, and that's the thing we learned about things like vaccines. When it was supposed to take 2 years, and during COVID, we figured out how to do it in a couple months.
Really interesting. So when Landman sits down in the cabinet room and he says, "You want me to go to Venezuela? Do we put the Permian on ice, Mike?"
Well, it's not. That's, I think, part of it. But also, there are going to be pre-existing contracts and things that tilt that way. I don't think it's a pushback in a Permian, but if there's money that's going to be made, it'll expand. It's just a question of how and when. And I think certainly there seems to be going out of the right way. The bottom line for me is President Trump wants lower oil prices, and it looks like he's going to do what he can to get that.
If we choke off China, knowing that this is a global market, does that mean they end up paying more for oil, or are they going to be facing the same prices that we are in the West?
Overall, but the overall price is going down, and the main importer now, or exporter of crude oil to China is Russia. But that's obviously somewhat dicey. But the thing is, a key thing in this case is, what's the best way to alleviate an aggressor in the major war in Europe? Is what's their number one source of income? It's crude oil. Now, we wrote about this 2 years ago. Yeah. You pressure that crude oil down to $40 a barrel, it's going to really shut off the ability for Russia to be an aggressor in the war in Ukraine. And I think that's part of the goal.
Mm-hmm. Interesting. You mentioned the move today. WTI is up about 3% here. I didn't mention Iran, but you did, Mike. That's why?
Yeah, well, there's political unrest on Iran. One thing, Iran, as we know, part of Iran did invade Israel, and that didn't work out so well. So to me, the trend against some of these kind of aggressor countries is going negative, and particularly Iran with a crude oil producer. But the thing to remember is crude oil's beat up. It's a bear market. You get the best bounces in bear markets, but I think most traders are waiting for bounces like this, maybe waiting to see something pop into a 60 handle so they can reset those shorts, and sell forward against and bring on that additional production.
Fascinating. Reset those shorts. Mike, great to see you, and I appreciate it very much. Mike McGlone with us live on Bloomberg, with our eyes on crude oil, just about 2 hours ahead of the meeting at the White House. Right now, shares of ExxonMobil up 1%, Chevron's up 2%, Valero is heading lower. The refiner is down 3.5% as we wait for news from the White House. We'll assemble our political panel next. Yesterday was an important day on Capitol Hill, and we'll tell you why, right here on Bloomberg.